My gut tells me that uncertainty about the path of the economy is extremely elevated, and that the downside risks have increased. The risk is, as we pointed out in our statement, the risks of higher unemployment and higher inflation have risen, but they haven't materialized yet. They really have. They're not in the data yet. So that tells me more than by intuition, because I think it's obvious actually that the right thing for us to do is we're in a good place. Our policy's in a very good place, and the right thing to do is await further clarity. And there's usually things clarify and the appropriate direction becomes clear. That's what usually happens. Right now, it's very hard to say what that would be. In the meantime, the economy is doing fine. Our policy isn't, it's not highly restrictive. It's somewhat restrictive. It's 100 basis points less restrictive than it was in, last summer. So we think it's in a good place, and we think the appropriate thing is for us to wait and see and get more clarity about the direction of the economy. We are going to be looking at the not just the sentiment data, but also the real economic data as we assess what it is we should do. And remember, there will be two effects. One of them would be weakening economic activity, which translates into higher unemployment, and the other would be potentially higher inflation. Again, to say it again, the timing, the scope, the scale, and the persistence of those effects are very, very uncertain. So it's not at all clear what the appropriate response for monetary policy is at this time. And and by the way, our policy is in a good place, so we think we can wait and move when it is clear what the right thing to do is. Really not at all clear what it is we should do.
Hi, good morning. Thanks so much for joining in. You're watching India Market Open, and we're here to set you up for what could be a very interesting day of trade after a very eventful Wednesday midweek. Good morning.
Good morning, Alex.
All right, so let's talk about what you just listened to, which is Fed Chair Jerome Powell essentially shrugging his shoulders to chuckles in that press conference, because he said, at this juncture, we don't know what to do. And in that context, because there's so much that is playing out with the economy, not least of which the import numbers that have come through for the fourth quarter, which has changed the estimates for GDP growth in the US, they've said they're going to pause. So they've kept the policy rate unchanged. They've said that the risk exists for higher inflation as well as unemployment. They've said, and I reiterate what he said, not at all clear what the appropriate response is for monetary policy at this time.
But Alex, to this, what's interesting is, does this also mean that the Fed has confidence that they will be able to balance growth and inflation? In spite of the risks that he's talking about, the balancing act between the two is necessary. And probably the question arises, is there confidence? Because as you mentioned, if you talk about US inflation, that has been moderating as well. I think the last CPI read that was in early 2025 was at around 2.5%. So if they're able to balance it out, great. But if inflation remains sticky or reaccelerates, what happens because the rates have been left unchanged?
Yeah, that's essentially why they have kept the policy rate unchanged at 4.25 to 4.5%. What happened on Wall Street? It advanced on account of a late rally in chip stocks. Asian markets at this juncture have opened a mixed to moderately positive. But let's talk about Wall Street's gains. You had gains of about 0.4% on S&P 500. The Dow gained about 0.7%, and the Nasdaq was about 0.3% higher. Those chip stocks are in focus. Why? Because the Trump administration is set to rescind and modify the Biden policy on AI chip exports. Biden administration had, remember, curbed the export of sophisticated AI chips with the intention of keeping that computing power and the technology restricted to America. Alphabet, and these are a couple of stocks that were in focus, Alphabet sank as much as 7.5% on Apple's plan to add AI-powered search options on Safari, and Disney shares rose about 10% or more on the back of strong earnings in the first quarter. Now, There's another important update. US-China talks are imminent. You saw this based on an announcement earlier in the week, but President Donald Trump spoke about this as well yesterday. He suggested that China initiated those senior-level trade talks. By the way, in case you missed it, because there was so much happening here, US Treasury Secretary and the trade representative from the US are set to meet China official on Saturday in Switzerland. What emerges from that is yet uncertain. In the meanwhile, in China, they've announced a stimulus. This happened yesterday, and again, you might have missed this because of everything that was occurring here in India, but they have in fact cut the policy rate, the overnight rate, by 10 basis points, and they've announced an infusion of liquidity as well. The higher tariffs have already started hurting the Chinese economy, and that is evident in the latest factory activity data that showed a contraction in April at the fastest pace in 16 months. There's one other data point or news point that I want to focus on, and this is amidst this entire barrage of tariff measures that were announced by Donald Trump, and this has to do with the use of the dollar as a reserve currency. Ukraine has said that it is starting to consider a shift away from the US dollar. In fact, it could link its currency more closely to the euro. Where has this come from? Their central bank governor reportedly told Reuters this in an exclusive chat. So that's what we have as things stand right now. To put some of these things into context, we've got Jeffrey Dennis, independent emerging markets commentator, joining us this morning. Jeff, thanks so much for taking the time as always. I want to start by asking you about the chuckles that were in that room when Jerome Powell said, we don't know what to do with monetary policy at this juncture because so much is uncertain. What did you make of that? And if the Fed themselves don't know what to do, what hope do investors have?
Oh, by the way, Donald Trump thinks he knows what the Fed should do, which is to cut rates. But I think that it was a rather kind of simplistic statement and a bit of a surprise that somebody like a Fed chairman would say that. We don't know what to do. I think the important thing he said, which meant he doesn't know what to do, is that there is, as we've noted already, tremendous uncertainty about the economic outlook at the moment, both in terms of inflation and unemployment. So I think what he was saying, until this uncertainty begins to ease, and we see whether inflation is going to move up significantly, which I suspect it will over the next few months, see what happens to the overall economy, the Fed's just saying, you know, we don't have the information that justifies a change in monetary policy. And there's nothing wrong with that. It's just the way he said it was a bit odd, frankly. But I think it's no surprise they kept rates unchanged today. And I think ultimately they will be forced to cut interest rates, although I think the economy will weaken, but inflation will rise. And I think that's going to pose a real dilemma for the Fed.
Jeff, so clearly, you know, the read from here on is, I mean, an interesting point that you made firstly is Powell thinks that he knows what Fed needs to do, but I think it's Donald Trump probably who's dictating the terms indirectly. But does this mean that there is some bit of confidence that they will be able to balance growth and inflation? Because if you talk about inflation, that is moderating to some extent. You at the last CPI read in early 2025, which was at around 2.5%. However, if it remains sticky or accelerates, what happens then? Because the impact it could have on the currency is something that needs to be eyed.
Yeah, I think it's going to be harder and harder as the year goes on, at least in 2025 for sure, depending, of course, how much in the way of tariff policies is increased going forward. Do we get the reciprocal tariffs reintroduced after the 3-month pause? But I think it's going to be very hard generally for the Fed to maintain its dual mandate here of low inflation and decent economic growth. And as I say, I think the most likely scenario here is that growth weakens somewhat from here and inflation picks up somewhat. And that's going to present a real challenge for the policymakers. Now, of course, everybody's talking about the minus 0.3% annualized for GDP in the first quarter. But the really important number in the first quarter was real domestic final sales to domestic customers. And that came in around 3%. And that, in some sense, as Jason Furman, who used to work at the Fed, says, that's like core GDP. So the economy's doing okay at the moment, but the logic would be inflation's going higher, the economy's going to slow, that's going to come out in the data going forward, and that poses a great dilemma for the Fed. I suspect they will cut rates this year, maybe once, maybe twice, but it's not going to get any easier as far as I can see.
Okay. So that's on monetary policy. And incidentally, China has also announced changes in monetary policy ahead of that meeting that they have on trade in Switzerland. At this juncture, we're hoping that some sense prevails and things move in the right direction, but and for global growth, right? But Jeff, the question is, from your perspective, sitting outside India, in this context, would you continue to bet on India amidst that pack, the emerging market pack?
Oh, yes, definitely. And I'll tell you why. First of all, we continuously get regular headlines on China doing this, doing that in terms of easing of policy. An interest rate cut was significant. The reserve requirement cut was significant. But at the end of the day, until you actually see real evidence of the consumer picking up and the property market really starting to rebalance and stabilize, I think the case for Chinese equities is not going to be that compelling. But by comparison, although obviously you've got a major geopolitical issue going on at the moment with the conflict with Pakistan, which is taking a little bit of heat out of the market, I think, at the moment. But I think the outlook for India just frankly looks better because the economic outlook looks good. You've got low inflation. They can probably cut rates again. Oil prices are weak. That's good for India. Whereas the outlook in China is just so uncertain. So for me, India is still going to be, would still, as far as I'm concerned, be a core overweight in an emerging market portfolio, given that also the logic is that this India-Pakistan, interaction, let's call it that, military interaction, will probably not last for long. It will probably not escalate very much, and we can get back to following the fundamentals. But sure, I still like India a lot.
As you were saying that there has been talks between US and China, and in India, if you specifically look at FIs have been biased for the last couple of months. With this increasing talks or increasing possibility of a settlement between US and China, do you think that there could be some FI outflows or FI funds moving from India to China now?
I kind of doubt it for a couple of reasons. First of all, it's really, really hard to get a trade deal. I mean, trade deals are very hard to negotiate. And we are sitting at the moment on very, very high tariffs between the two countries. So how are we going to get those down? What's the deal going to include? What's going to be, are there going to be exceptions, etc.? So I think that's the real issue here. And if we don't get tariffs reduced all the way back to where they were, let's say 10% is a baseline tariff, which I'm sure would help the Chinese market for a period of time. If this is a long drawn out process of trying to sort the tariffs out, I think FIIs are not just going to switch out of India into China. Now, if there's a big surprise and China and the US agree suddenly they're going to take tariffs back to basically base levels, yes, that money will come out of India for a period of time. But I think it's going to be really, really hard given the conflicts you've seen between China and the US on the trade front in Trump 1 and in Biden's term and now in Trump 2 to actually bring these tariffs down enough that it's going to persuade investors that China's suddenly the market you've got to be in.
Jeff, my last question coming to you is in terms of how the markets are perceiving this unchanged stance, because does this tell you that probably we're looking at a prolonged high rate policy, in turn impacting bond yields, which in turn will increase the borrowing cost, leading to an impact on the corporate capex? How do you see this entire cycle panning out?
I assume we're talking about the US here. I think that going forward, the bond yield is going to probably go up. There's a tug of war on the bond yield in the US. Clearly, the concern is higher inflation in the short term, and also the very, very high budget deficit and the the debt position, which could push up bond yields. And pushing in the other direction is potential economic weakness as this trade war plays out. If you were to get a significant move higher in the bond yield, and I think it's not going to be a major move higher. We're not going above 5 or to 6% or anything for the 10-year. But if you were to see a big move, that would affect corporate financing rates, which in turn would hurt investment, which would be another problem for the US economy. But it would also hurt the housing market because mortgage rates would go further up. So I think the bond yield, the bond market is probably trading in a range because there are these alternative push and pulls on the yield, as I say, inflation and the budget deficit on the one hand and weak growth on the other. So I don't think you're going to get a big enough move higher in bond yields to really put corporate financing under pressure, at least under pressure for the reason that bond yields are going up. There may be other reasons why corporate financing may be under pressure because the economy weakens, but I'm not sure I see bond yields really doing that job at this point.
That's an interesting one coming in there. But thank you, Jeff, so much for speaking to us at NDTV Profit. It's always a pleasure to get your views as well. So that's with regards to how the global markets are panning out as well. But another major story that we have been tracking since yesterday is Operation Sindur. Indian forces actually launched Operation Sindur, a precise retaliatory strike targeting terror camps across the line of control in Kupwara and Baramulla following persistent cross-border shelling by Pakistan. In fact, India emphasized that the operation was measured and non-escalatory, aimed at dismantling terrorist infrastructure behind recent attacks. Concurrently, External Affairs Minister S. Jaishankar held a high-level talk with foreign ministers from Japan, Germany, France, Spain, and Qatar, briefing them on India's stance and seeking international support. Now, amidst all this escalating tensions between these nuclear-armed neighbors, diplomatic efforts continue to prevent further conflict. In fact, my colleague Shiv Arul joins us with a report from Ground Zero. Shiv, good morning. Over to you.
We've gotten an update from the Indian Army that ceasefire violations have taken place by the Pakistan Army in Kupwara, Baramulla, Uri and Akhnur sectors. Small arms and artillery guns took place overnight. We were in Uri sector late last night, and while we were leaving, we did hear some small arms fire, which we were told was the beginning of the ceasefire violations early in the night. And late at night is when the big guns start actually moving. Our viewers did see my ground report yesterday of places near the line of control in Uri sector where shells fell on villages. Many people injured, many villages evacuated in that area. So this obviously is continuing even now. Please remember that this is not one-way artillery fire. It's happening in both directions after unprovoked firing from the Pakistan side. It's a very, very tense situation there because unlike small arms fire, shells have range. They can travel, tens of kilometers. They can not only hit civilian areas, but they can target establishments as well. Obviously, the Indian Army isn't a sitting duck there. It's giving it back in full measure. And as I've been reporting, one of the untold stories of Operation Sindur and its aftermath is the huge amount of damage on the Pakistan side that I've been hearing from my intelligence contacts in the Rajouri-Poonch area. That's the hidden story right now. Hopefully there will be imagery, there will be satellite imagery and maybe even an admission from Pakistan about the large-scale damage and a large number of casualties that are being reported, especially in the Rajouri-Poonch area. And remember that Rajouri-Poonch is also a place where India has lost a lot of civilians. There have been horrific images that have been coming in from there of injuries and people being rushed to hospital, including young children. I did see some of that in Uri as well, though the casualty figure is far less. There are no deaths, thankfully. In fact, miraculously, despite multiple shells and mortars landing in at least 6 villages that I visited yesterday. And like the army has just confirmed, that shelling appears to have continued last night. We'll be heading to another sector today to get you more.
Right, and we look forward to that update. Shiv, thanks so much for joining us this morning and giving us that update. Everybody paying attention to what's happening where you're at. In fact, it's not just people in India that are looking at this update and this situation. President Donald Trump weighed in once again. He didn't really change his tone, pretty much reiterated what he had said the first time he made a statement, but listen in to what he had to say.
My position is I get along with both. I know both very well, and I want to see them work it out. I want to see them stop. And hopefully they can stop now. They've gone tit for tat, so hopefully they can stop now. But I know both. We get along with both the countries very well, good relationships with both, and I want to see it stop. And if I can do anything to help, I will be there.
Well, let's take you across what happened in trade yesterday. Well, Nifty was quite volatile in trade, but it remained range-bound between the range of around 24,300 to 24,400 for most of the trading session. Now, volatility was because of the fact that India had launched missile strikes on terrorist hideouts in Pakistan and Pakistan-occupied Kashmir. But if you look at how the trade opened, it opened low at around 24,220, and from there we saw a strong recovery of around 200 points, and Nifty gained nearly 34 points at closing level to close at 24,414. Now this was on the back of strong flows that we have been seeing both from DI and FI. In fact, FIs have been buying for 15th consecutive session, and the total buy amount now stands more than 44,000 crore rupees in the last 15 trading session. Now, despite the geopolitical tensions that we have been seeing, mid and small cap, real estate stocks, auto stocks and metal stocks posted solid gains of anywhere between 1 to 2% in trade. In fact, bearing the Pharma and the FMCG index, all the other indices closed in green in trade yesterday. Some action was seen when it comes to textile, auto and auto ancillary stocks, and this was on the back of the UK FTA deal signing. Stocks like Welspun Living, KPR Mills, Tata Motors, Endurance Tech and Vardhaman Textiles gained anywhere between 5 to 12%. On the other hand, there was Nifty Metal Index, which also rose more than 1% in trade after basically China reduced its policy rate and the reserve ratio, and in anticipation of the US-China trade deal. Tata Steel, Nalco, SAIL, NMDC each gained more than 1 to 2% in trade. Defense stocks, now that is one sector which was down in trade yesterday. In stocks like Hindustan Aeronautics, Bharat Dynamics, Bharat Electronics saw some profit booking, with some also shipbuilders like Mazgaon Dock shipbuilders were falling by nearly 5% in trade. Apart from that, few FNS stocks which were among the gainers, Piramal, Paytm, both on the back of strong set of numbers. BAC again strong set of numbers. Apart from that, it was IIFL Finance and Aarti Industries which were gaining in trade. On the losing side, it was Asian Paints ahead of the fourth quarter numbers. Chambal Fertilizer, Sun Pharma, Hudco, Bajaj Auto. Chambal Fertilizer was an interesting trade yesterday. In fact, day before yesterday, the stock was up around 5-6%, but futures were at a discount of 6%. And yesterday, we saw a sharp fall coming in in Chambal Fertilizer. Largely the cash market coming in terms with the futures discount that we were seeing. Apart from that, it was Sun Pharma, Hudco, and Bajaj Auto that were among the top losers in FNO stocks.
Right, Thomas. I mean, yesterday's day was absolutely interesting because the markets were absolutely resilient, and that's what I think the street has been looking forward to. Though, if you talk about the investor sentiment, there is that cautiousness that is prevailing. There is no direction that the markets are getting currently, and that's what is concerning investors currently. Nifty has been locked in a tight consolidation zone, and this is, I think, for a 6th consecutive session where this consolidation phase has continued. What's happening is you are seeing buying that is coming in select specific stocks at lower levels, though the moment you see an upside, selling starts increasing at higher levels as well. So that game between support and resistance between individual sectors or indices, or if you talk about stocks, that has continued as well. In fact, yesterday's session, what was interesting is that up move that we saw in the broader markets, which were outperforming the benchmark indices, that showed some bit of renewed confidence as well. And in spite of these geopolitical uncertainties that we've been looking around, the index has held firm at the key support levels. Now, neither the bulls nor the bears are actually gaining firm control. FIs have continued their bullish stance because if you talk about the last 14 trading sessions, they've injected nearly over 43,900 odd crores in the Indian markets. And that was the key question that even Somit was referring to with Jeff Dennis, that will the FIs continue this kind of a stance or not? Because though I mean, you can't say that they are irrelevant, but their support is
No,
required
definitely.
in spite of the DIs being so strong.
Yeah.
Very quickly, the range that you should be looking out for in terms of Nifty 50 is 24,600 on the upside to 24,000. That's the consolidation zone for Nifty 50. The support that Nifty has been maintaining is at levels of around 24,250. In fact, yesterday, Kush did mention that a close about 24,400 is something that will come in as a positive. Now, if Nifty breaches 24,300, selling pressure could accelerate from here on, but 24,500 remains a critical resistance level. If we break about 24,500, you could test 24,600 and then 24,650, and after that you're looking at a 24,800 in terms of Nifty 50. Clearly, a break on either side of the support or resistance will give you some bit of a direction in terms of where markets are headed from here on. In terms of Bank Nifty as well, it was interesting because last couple of trading sessions, we didn't see that much of strength in terms of Bank Nifty, but yesterday, some strength has come back in terms of Bank Nifty. The immediate resistance is seen at around 55,000, followed by 56,000. The key support lies at around 53,890. And that consolidation range for Bank Nifty is seen between 53,500 to 56,000. So that's that broad range that you should be tracking. That 2,000 point range has now actually expanded. Lastly, VIX. We settled at 19.06 yesterday. So the elevation that you're seeing is implying some heightened volatility in terms of where markets go. The ongoing market uncertainty is what is being reflected in terms of the VIX. But it's interesting, we've not moved to levels we've seen like 25, 30, 40 kind of numbers. And this is giving you an indication that there could be sharp intraday swings as well, and that will remain a constant threat to understand the directional move for the markets. So overall, neither the bulls nor the bears that are taking control, and that is something that the markets need to wait and watch. Very quickly, let's quickly look at which are the earnings that are being reported in terms of today's session. Whole host of them, but I'll just highlight few of them. You have Aarti Industries, Asian Paints, Bharat Forge, Biocon, Britannia. You have even Escorts Kubota. You talk about Hindustan Construction, Idea Forge. Apart from that, you have L&T from the large names. Pidilite will be reporting numbers as well. Sula and Titan. These are a few of the names, and the ones that are on your screens will be reporting numbers today. So an interesting day of trade for the consumption pack, and that is something that we will be eyeing. Yesterday's session, there was pressure in terms of consumption. Did see a mild recovery, but watch out for this place pretty closely. We did speak about the technical levels, but let's understand what the derivative markets are indicating. Today is weekly expiry. Puneet, what are cues indicating, taking into consideration the kind of moves that we saw yesterday?
Well, thank you for that. So you did mention the levels, so we're going to just go over that. But today, of course, the expiry, we're expecting to trade in a narrow range. Again, a week that's been dominated by earnings, and we'll see that between today and tomorrow as well. Gift Nifty and implied open indicating down 14 points, but largely 24,300, which we've been speaking about this week. We've been above that level consistently, and we could be ending over that, at least for this expiry. Let's also look at the Bank Nifty. The 55,000 level is acting as one of the key supports, but we just saw roughly about 30-point fall from those levels yesterday. So it'll be interesting to see where we go from here, at least in terms of Nifty Bank. Let's also look at the key open interest distribution for both calls and puts. Seeing a heightened interest of calls currently at the 24,500 levels. We've also mentioned the 25,000 level as the key out-of-money call has been something that traders have been taking on, and that's been consistent. Also seeing some interest on the 24,600 level as well. We've also seen some build-up over the last couple of days on the 24,400 level as well, while the maximum put option in open interest has been at the 24,000 odd levels. Seen some increase yesterday at a new level, which is 24,300, at least on the open interest puts, and that's something to watch out for in trade today. Finally, in terms of stocks, how are the stocks reacting? We saw, at least in terms of open interest, gainers and losers both. In gainers, we've seen some short build-up in stocks like Info Edge as well as Hutco. Some long build-up as well in stocks like Paytm. Paytm was also in focus after its earnings yesterday. And on the other side, in terms of open interest losers, we've seen some short coverings across stocks like KPIT Industries, like MGL as well as Coforge. So overall, we are looking at just about a 15 points in terms of implied open on the downside. But again, expecting to trade in a narrow range today.
Absolutely. If anything, yesterday's move at the start was similar. It was pointing to a downtick, and we ended, as Somit pointed out, in the green. So let's see how that pans out at the start. We've got stocks to talk about that have been reacting to earnings, and we've got quite a few to talk about. We'll get you all of that after this very quick break. So do stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back. You're watching India Market Open. We've spoken about the latest updates from overseas. We've told you about what's happening on the border. And we've also spoken about the setup, more or less, for trade today, the key technical levels that you should watch out for. But let's get into stocks now. And there are so many to talk about on the back of earnings. Each of us have got a few to tell you about, and in no particular order of importance. Let me start with Tata Chemicals. A very poor set of numbers by this company. The revenue has increased by about 1% or so, and it has come in below the consensus estimates at 3,509 crore rupees. The EBITDA is down about 26% and come in at 327 crore rupees. That is also below the consensus estimates. A contraction in the margins taking place, that has come in at 9.3%. And there's a net loss which has narrowed, but there was an expectation on a consensus basis of a PAT number of 74 crore rupees. So you could look at a disappointment that is very evident at the start of trade. What has happened in the quarter is that the revenue growth was constrained by pricing pressure across its geographical regions, and it has quite a spread in terms of where it's present. The EBITDA decline was seen primarily on account of lower pricing. The UK soda ash unit closure led to an exceptional charge of 55 crore rupees during the quarter. Now, in terms of the demand scenario, they're saying that they have seen robust demand in Asia, ex-China, and in India as well. And in America, or in the Americas, I should say, except the US, they're seeing a decent demand picture emerging. They're seeing a decline in demand in Africa. So this is the context that they have set. They're saying that the market conditions remain challenging, and the US and Western Europe have witnessed declines on account of reduced demand for flat and container glass. So overall, you're expecting there to be a bit of a weak reaction on the back of what has been a pretty bleak Q4. They say that the medium-term outlook is decent, but the near-term pressure on pricing and on demand continues. Lupin is a positive update. They have announced the launch of, now I hope I get this right, eslicarbazepine acetate tablets. I struggle with these often. What this is a medicine that is used for the treatment of partial onset seizures. There is a drug that exists in the US, and that equivalent drug is manufactured by Sumitomo Pharma. And this drug had an estimated annual sales of $395 million in the US. So it is a positive update. They have, in fact, a 180-day shared generic exclusivity, which is a positive as well. So watch out for this one at the start. The last one is also a positive development, and this is on the back of earnings. It's in the health insurance space. Niva Bupa Health is the name of the company. The premium earned has grown by about 11%. The gross written premium has risen as much as 36%. Strong PAT growth at 31%, coming in at 206 crore rupees. The claim settlement ratio has come in at 93%, but the number that you should be looking at is a combined ratio, which has improved quite considerably. Remember that the combined ratio is a combination of the loss ratio and the expense ratio, and what that means is that if it goes down, it is beneficial for the company. It has come in, if I'm not mistaken, around 267 basis points better than the previous quarter. It continues to be one of the fastest growing companies in the health insurance space and should be watched out for at the start today. Hiral?
Right, so that's with regards to where the three stocks that you're looking at. In fact, today we had an interesting day where all of us wanted to look at similar stocks, but let's look at what I have on my radar. Number one we have is Coal India. If you see in terms of where Coal India is concerned, the earnings have beat street estimates. However, the concerns still remain from here on. The reason why we are seeing this is because the soft demand in the non-power segment and the import pressure, that is what has impacted the top line, and that's the reason why your revenues have just seen a growth of around 2.6% this time around. If you see in terms of the PAT, that has mainly been driven on the back of higher e-auction realizations, cost controls, as well as the JV profits that have come in. So in terms of the profit number, that is up around 13% at 9,604 crores versus an estimate of 8,414 crores. Now, what's helped revenues in the fourth quarter? The 3.5% sequential uptick in sales volumes and the 2.1% sequential rise in the blended realizations. Now, there are a couple of reasons what has dragged EBITDA. So the cost of materials, employee cost, contractual expenses and other expenses, all of them have seen an uptick in the range of around 8% to 37%. So that is what has dragged the EBITDA this time around. And in terms of the JV profits as well, the bottom line was aided on a 75% rise there, which is almost 168 odd crores. The key concern over here is that the volume growth is still remaining a challenge for a Coal India, and the FY25 captive market share, which is at 19% versus 15% last year, they've share lost on higher captive mines as well. So that's the key. Nuvama has maintained a hold. They have a target price of 405. They are indicating that triggers are missing and they need volumes to grow. Earnings growth missing over FY25 to 27 as well on the back of subdued volumes. Citi has maintained a neutral. Their target price is hiked to a 395 from a 390, so not a major one there. Valuations limit downside and they lack visibility on upside triggers. And MK has maintained a buy. They have a target price of 475 and the production and e-auction premiums, that is what they're wanting to normalize as well. In fact, what's interesting is if there is any increase in terms of bond yields in the global markets, the finance cost in future for Coal India could increase as well, taking into consideration their capex pipeline of nearly 60,000 odd crores. And clearly, unchanged rates may allude to steady US demand for coal, supporting the thermal coal prices, and a stronger dollar might actually cap coal prices, impacting the e-auction realizations in turn as well. So it's a double whammy with regards to Coal India. On number 2, I have a Somani Ceramics. It has been a weak quarter. Again, a thumbs down on Somani Ceramics. The fourth quarter has been impacted due to the sluggish market conditions. Revenues are up 4.5%. Margins have also reduced. They've come in at around 8.2% versus a double digit, which is 11%, and a dip in terms of profitability to the tune of almost 32%. Now, the management is expecting the tile volumes to grow at high single to low double digits in FY26. So again, it's a thumbs down on that one. And the company remains focused on increasing profitability and thereby accelerating its cash flow generation. That's the guidance that they've given. Very lastly, United Breweries, a thumbs up. The numbers are above what the street was estimating. Though the revenue is down around 9%, profits have increased by around 19 to 20%. Margins have improved by nearly 135 basis points for United Breweries, the volume growth has been decent, and this is taking into consideration the temporary suspension that we saw in Telangana, as well as the kind of challenges that they've been seeing on the back of the duty structures in Karnataka as well. A 5% volume growth is what you've seen. And the premium segment, which is Kingfisher Ultra, Kingfisher Ultra Max and Heineken Silver, saw strong growth. In terms of the segmental, the premium segment revenues increased 24%, though beer revenues have taken a dip to the tune of 7.5%. Capex around 750 odd crores is what they have announced in a greenfield brewery in Uttar Pradesh, and that will be added by the fourth quarter of FY27. And it will produce both mainstream as well as premium products, which includes Heineken with provision for both cans and bottles. So that's a United Breweries, which is a positive. So these are the stocks that I'm looking at, Somit.
And the three stocks that I have, firstly, I'm starting off with Voltas. It's a thumbs up. Revenues were in line, but EBITDA and PAT were below estimates. So what led to this miss in EBITDA and PAT? It was the EMP segment, which is the project segment for the company, which reported a muted growth and losses yet again. In fact, EMP segment revenue grew just 3.6% on a YY basis, and this is after 9 quarters of solid double-digit growth that we have been seeing, and reported losses yet again, and this could have been because of the bank guarantee related provisioning, and that's the reason the company might have missed its EBITDA and PAT estimates on a consolidated level. But why I'm giving it a thumbs up? Because the UCP segment, which is the unitary cooling product segment or the AC segment of the company, the key revenue generator which contributes nearly 70% to the top line, reported a solid set of numbers. Revenue were up 17% on a YY basis, while EBIT grew nearly 28%. EBIT margins came in at 10%, which was the highest that we have seen at least in the last 2 years, and the market share of the AC segment increased by nearly 30 basis points on a YY basis at around 19%. Also, when you compare it with Voltas, your AC segment, Blue Star's AC segment, their numbers were pretty much ahead of what the peer reported. Blue Star's UCP segment revenue were up 15%, while that of Voltas was up 17%. Margins came in at 10%, while that of Blue Star came in at around 8.4%. Also, Blue Star's margin improvement was just 12 basis points as against 82 basis points improvement that Voltas has seen in the fourth quarter of FY25. Second stock on the list is Dabur, and it's a thumbs down. It was an all-round miss reported by the company. EBITDA margins came in at around 15.1%, which was down nearly 524 basis points on a sequential basis and 150 basis points on a YY basis. India revenue was weak at -4% owing to urban slowdown and inflation. Management expects an average high single-digit value growth in FY26, but then Street doesn't seem to be quite bullish upon that. In fact, this growth will largely be led on the back of the price hike that the company had taken in the fourth quarter of around 3.5 to 4 odd % and a potential demand recovery that could happen. That is what the management is expecting. Now, in the conference call, for the first time, management highlighted the McKinsey strategy. Now, they had employed McKinsey a while back to change the company's strategy, and now they have highlighted those strategy that McKinsey has suggested them. Firstly, they are looking to streamline their portfolio. They're looking to roll back offerings like baby diaper, tea, sanitizer, breakfast cereals, which together contribute just 0.5% of the sales. There are multiple other strategies also which they have highlighted, like premiumization of portfolio, aggressive M&As, bold bets in healthcare and wellness, sustained investment in core portfolios, go-to-market strategy, and cost optimization. But Street continues to remain in wait and watch mode. In fact, Investec says that the narrative is not convincing. MK says that the growth guidance remains aspirational, while Citi says that challenges remain across growth and profitability for the company. And the last stock on the list is Symphony. It's a thumbs up. It was an all-round weight. In fact, revenue was 20% ahead of the consensus estimate. EBITDA was 43% ahead of consensus estimate, while PAT number was 38% ahead of the numbers. The strong numbers were driven by the 48% growth in the domestic business, while the international business also grew nearly 44% on a YY basis. Consolidated margins came in at around 21.9%, which is the highest that we have seen since the fourth quarter of FY21. Now, EBITDA margins remained elevated for the company despite the high marketing spends that we had seen in the fourth quarter, and analysts believe that the strong growth could also be because of some spillover of demand coming in from the third quarter of FY25. Now, what is important to watch watch out for when it comes to Symphony. The company will be holding the conference call today at 12:45, and commentary on demand outlook will be the most important thing to watch out for, because how has Q1 panned out so far will be something that the street would be wanting to know, and that is something that could lead to the share price move for Symphony going forward. And another key trigger for Symphony would be, given the fact that they're looking to divest stake in Climate Technologies and Emco, which are the foreign subsidiaries of the company, and divestment should turn the overseas operations profitable, should improve the return ratios and release management bandwidth. So this is one of the key trigger that we need to watch out for. Any commentary coming in on that front would also be something that the street would be taking positively. Let's also welcome in our guest Amit Goel, technical guest, founder of Amit Ventures, and Chakri Roplier, Chief Investment Officer, Equities with LGT Wealth. Chakri, coming to you first on Voltas, the numbers were pretty much strong if you look at the AC segment. How are you looking at the entire cooling space, consumer durables, be it Voltas, Blue Star, Symphony? Any top picks here?
Good morning. Thanks for having me. Voltas, Blue Star, Symphony also, they all had very good numbers. Their year-over-year growth in revenue has been north of 30%. This was kind of expected in the sense that, the last year was a weak number, and this year expectations of first, a strong summer, second, the companies themselves have underperformed. So the only catch in this whole thing is the weather experts point to a slightly cooler than expected summer, if that is true, but I don't think that will really dent Voltas or Blue Star. Both of them look good because the AC segments of these businesses are continuing to improve.
But would you buy any one of these? Just to follow up, Chakri, good morning.
Yeah, absolutely. We would be biased into Voltas. And Blue Star may be slightly longer simply because it's done better.
Okay. Amit, very good morning to you, and thanks for your patience. What is your view on the benchmark at this juncture? And considering that it is the weekly expiry, how would you approach strategy this morning?
Hi, good morning, Alex, and thank you for having me here. It's nice to be back. Looking at the benchmark, there are mixed signals. We've had a very sharp and tremendous and a happy rally from the lows of 21,800. However, we have kind of struggled to really breach the 24,500, 600 levels, and that seems to be the near-term top, both from a price action perspective as well as from the open interest angle. 24,500 has seen a lot of call build-up, and that will act as a near-term resistance, with 24,100 to 200 being the absolute near-term support, from where the market has kind of given a relief buying seen yesterday also. So it is a very tight range. There is another level of support at 23,850 on the price on the Nifty's chart. So I'm looking at a broad range, and we are right now at slightly on the higher end of the spectrum. So the bias would be slightly negative, considering all that is happening around us. So until and unless 24,500, 600 is taken out convincingly for a couple of sessions, I would not really initiate fresh longs. However, from a derivatives trader, one could always look at trading this range through a non-directional setup.
Right. Amit, good morning. Hiral this side. So that's a range-bound trade that you're alluding to in terms of Nifty. Bank Nifty has been interesting over the last couple of trading sessions, because yesterday there was some strength that was emerging in terms of Bank Nifty as well. What should be the levels that you should be tracking in terms of Bank Nifty, and what should the trade be?
Hi, Hiral. Good morning. So Bank Nifty, if I look at the chart, purely from a price action perspective, 56,100 or 98 to be precise, happens to be the all-time high and the near-term top for us for the time being. Yesterday, what was very interesting is, given the situation, given the political scenario that we are in, one would have expected the market to, kind of give away the supports. However, we have seen some very smart buying, and 53,868, 54,000 has been punched as the near-term support for us. So we are looking at a broad range of 2,000 points. But if you look at the price action of the last few trading sessions on Bank Nifty's price chart, it is what I would term it as a retracement phase. I'm saying that the primary trend continues to be up. However, we are kind of giving away a little bit of it in the retracement phase, and 54,000 would be a good level to go long in the Bank Nifty from a positional perspective.
Not too far away from these levels, all things considered. Amit, what are your picks today? What stocks are you looking at, and what's interesting you?
So I've looked at, again, I mean, the situation is not that we are in a clear trend. So picking directional moves is a little tough. However, selective stocks are showing some technical, bullishness. Hero Motor for me would be the first pick, in which I am seeing that after it has given a low of about 3,400. It has kind of moved up by about 400 to 500 points, and 4,000 also looks to be a level of breakout for us. Given the situation, and from a technical perspective, if you look at the RSI and the MACD levels, they are pointing towards a bullish momentum to continue in this stock. Hence, I would recommend traders to take long positions in this stock at about the current levels. Keeping 3,702 as the stop loss for targets of 4,000 and 4,117.
Right, so those are the topics coming in from Amit. Chakri, let me come to you with regards to the auto space. Now, what's interesting that is happening with the Tata Motors, yesterday on the back of the FTA, you did see a strong move that did come in, the kind of gains that a Tata Motors would see from a JLR perspective. Today, there is anticipation that a deal between US and UK will also be looked at. Again, that to an extent becomes a positive for Tata Motors as well. What should your strategy be with a Tata Motors from here on?
Well, you said it right in terms of, the number of moving parts for Tata Motors. Until a couple of days ago, there was no catalyst. Now there is one, a UK-India catalyst. Second is a potential US-UK catalyst, because JLR had stopped sales to the US. So if that happens, then clearly some amount of volumes, which is about, I think 3-4% of the volumes about 12% will be added back over the next 12 months. So that remains to be seen if this news is true, and if that is true, it would bring back another 4-5% to the bottom line and about 8-9% to the top line. So valuations are still therefore dependent on what happens to the news, if the news is real or not.
All right. So what's the final call on Tata Motors, though, Chakri, from what we know, because it has moved up from those absolute low levels, and then I'll go to Amit as well, whether he thinks that there is a trade here. But Chakri, would you venture out, considering that they've restarted exports from the UK into the US, and domestically you're also just ahead of that demerger that will take place? So how do you approach this?
And that's exactly the place of uncertainty, which is it's been a stop and start of sales of business into the US, into the other key markets. And so that needs to actually stabilize, and therefore it becomes difficult to forecast. But given the good news of yesterday's UK, India, and the potential news of the US, that could be a trading call at best, but I'll leave it to my counterpart. But fundamentally, we'll wait a little bit to see for real numbers to be able to forecast.
So, Amit, I just want to very quickly close the loop on Tata Motors. So it's probably one of the stocks of the day yesterday, at least from the benchmark Nifty, 55% higher. Would you venture out and buy?
I mean, looking at the chart, definitely there is what a technical analyst of my ilk would say, an engulf on the pattern, which is a bullish sign. And the other indicators also point towards, momentum building up. If you look at the RSI also at 58 levels, and the slope is pointing towards the upside. But I would definitely be a buyer in this purely from a momentum perspective and nothing to do with the fundamental view. Here, I would, however, wait for some bit of retracement, given that yesterday we have had an outlier move. So I would, try to pick it up if there is any bit of dip during the first couple of hours, and I will keep a stop loss at about 635 for targets of 730 on this.
So that's the view coming in on Tata Motors. Let's also welcome in Shrikant Chauhan from Kotak Securities. Shrikant, good morning and welcome to the show. Taking into consideration the kind of resilience that we saw in terms of Nifty 50 and the buying interest that has emerged in terms of Bank Nifty yesterday, what should the strategy be with both?
Good morning, everyone. See, like for Nifty, it is like very clear that it is not, I'm going to say it is finding a lot of difficulties to cross the level of 24,500. It is not breaking the level of 24,200. In fact, yesterday when there was like some panic at the opening, market managed to sustain above the levels of 24,200. So one thing is very clear that till the markets are not crossing this particular range on a closing basis, we could see some range bound sort of activity in the near term. On the dismissal of 24,500, I'm expecting market to move towards 25,000 because most of the stocks are reversing from their important support levels or they are consolidating very close to their resistance level. So there is a possibility that we could see the levels of 25,000, but for that we need a very strong dismissal on a closing basis at 24,500. For the Bank Nifty, there also we are seeing range bound activity, but the best part is that Bank Nifty has already corrected to its important support levels. And now again, the Bank Nifty can resume its uptrend. So 54,000 should be the final stop loss for creating any long position on Bank Nifty. And again, we could see the levels of 57,000 in next few weeks. It will take some time. But in the near term, yes, we could see the levels of 55,500.
Right, Shrikant. What would be your top picks for the day?
There are a number of stocks which are very close to their important resistance level, and few of them are reversing after hitting important support levels. So specifically, Divi's Laboratories, which is around 6150, 6100 levels, is very close to its breakout level. And whenever we are seeing some buying interest in pharma stocks, we are seeing specific buying interest in CRDMO stocks. So Divi's looks good at current levels, attractive at current levels with a target of 6,300, 6275, 6,300 on the higher side. And we can keep a stop loss at 6090 for creating trading positions on it. The other stock which we like is BHEL, Bharat Heavy Electricals, which is around 225. The formation is suggesting us that the stock is heading for 250. Eventually, it will take some time. But in the near term, the stock can move towards 235. And we can keep a stop loss at 220 for, again, taking trading position on the stock.
Right, Shrikant. Well, before we slip into a short break, thank you, Amit Goel, for joining us and giving us your perspective on the markets and your top picks. With that, let's slip into a short break and we'll be back with more news on the other side.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
welcome back to India Market Open. If you see in terms of the implied trades, no major cuts that the number is indicating so far. So pretty flattish start that could be on the cards. But one stock that is in focus in today's day of trade is a MRF. What's interesting with the MRF is the kind of up move that we saw in terms of yesterday's session on the back of a strong set of numbers, the margin trajectory, which is seeming absolutely strong. The stock is seeing gains of almost 24 to 25% in the last 1 month as well. Puneet is standing by to tell us more in terms of what brokerages are making out of it. Puneet, are brokerages still alluding to a buy MRF at this price?
Well, definitely, we've seen really strong results come from the company yesterday. Revenues up 11%, EBITDA up 18%, and profits are up 29%. And brokerages have penciled in that this is, a start of a margin recovery going forward. The last 6 to 8 quarters have been really, really poor for all tire companies because of high natural rubber prices, and that's reflected in notes as well. So CLS has come out with a note. They maintain an outperform rating on, something like a MRF, and they've hiked their target price by 30% to 1,68,426 per share. It was earlier roughly between 1,29,000. So a big upside that they're seeing from these levels as well. They mentioned that EBITDA improved 337 basis points on a quarter-on-quarter basis. That's a key positive. They've also mentioned that this could be a beginning of a margin upcycle, as I mentioned, and they've seen that the bulk of the recent commodity correction could, come from roughly about Q2 of FY26. So seeing that margins coming back as well. They mentioned that MRF is an industry leader and a superior capital efficiency should drive its cash flows going forward. We've also had another brokerage note from Anand Rathi as well. They've raised the target price for MRF to 1,65,000 from 1,60,000 earlier. And they've mentioned that the outlook for all the 3 segments of OEM, replacement as well as export is quite bright for the company. And despite, higher revenue increase in FY25, the input cost actually dragged the margin. So they are anticipating that to reverse going forward. They've also said that, they're expecting gross margin improvement led by lower international rubber prices. And the CLS note is interesting because they initiated only in April of 2025. So definitely a big beat there, but positive on Q4 results as well as improving prospect for this industry leader for MRF.
Got it. All right. Thanks so much for that, Puneet. And, I'm tempted to go to Shrikant and to Chakri on this one. Shrikant, of course, I will refrain from doing so because by the time you give us levels, we'll have gone past the market open because we're talking about it in lakhs, right? So, but let me come back to you on that one. We're joined by Vishwanath Mahendra, who's the Chief Financial Officer of Niva Bupa, to talk about their earnings. Mr. Mahendra, thanks so much for taking the time and congratulations on a solid set of numbers in the Q4. We see that the combined ratio has seen improvement. Can you take us through how that occurred?
Yeah, good morning and thanks for inviting me. So let me just give you a context of our results and just remind you, there was a change in accounting in the mid of the year, last financial year, effective 1st October 2024. The multi-year accounts, multi-year policies were mandated to be accounted in proportion. So we have given our combined ratio both on like-to-like basis as well as on previous accounting basis. So if we just compare for whole year, the combined ratio has improved from 99% to 96% in last financial year. And here just to reiterate that lower is the better. Combined ratio accounts for everything, claims, expenses, commission, etc. And this improvement is driven by 1 percentage point in terms of claims ratio improvement and 2 percentage point in terms of expense ratio improvement for the whole year.
Okay. When you're talking about the offtake and your sales at this juncture, what guidance can you give us and what are you seeing on the ground? And in terms of the kind of route through which you're selling, I'm just curious about that. What are the kind of trends that are emerging there? Because seemingly from the gross underwritten, that growth is pretty decent. What are you witnessing on the ground right now?
Sure. So just to start with numbers, so last year on same accounting basis, we grew by 32% in terms of gross written premium for the whole year. And this is coming from all the channels, agency, direct digital, brokers, all other partners. So all channels are contributing to this growth of 32%. And our focus area remains to be retail insurance, which is annuity business, which is more profitable. And we have launched various products. One I can talk about is Aspire, where we are, looking at millennials, because that's one segment which was not buying health insurance traditionally. Second, we also in the last quarter launched a product, Rise, that is mainly meant for middle income group. So what we call as missing middle. So we look at various segments by demographic, by affluence level, by income level, etc. So this growth is coming from all channels and all those segments which were traditionally not buying insurance.
Okay, interesting. Mr. Mahindra, can you give us some sense on the increase in the cost of premium? This is actually something that a lot of people have reported. We've got anecdotal evidence of this occurring as well. So can you give us a sense of, and of course this works in blocks, it works basis age group as well. So can you give us a sense of how much premium have increased?
How much premium? Sorry, I just wanted to understand your question. How much is the increase in premium?
That's right. Premium.
So, yeah, so sure. So in terms of premium increase, our policy is just to pass on medical inflation and some percentage because of change in mix. So we have been revising premium of all our mature products in low single digit. So let's say 7-8% is an increase in premium. And we have experienced medical inflation of around 5% last financial year. And that's been the case, it's been range bound in past also. So 5 percentage point because of medical inflation and 2-3% for other mix changes, increase in incidence rates, etc. So premium increase of, let's say, high single digit is what we do every year, and we would like to continue doing. We don't believe in correcting premium by 20%, 25% in one go.
Right. So in FY25, you have been able to grow your retail market share, and recently you just have launched a new product as well for the middle class and the lower middle class segment in the fourth quarter. So firstly, how has been the response for this new product in the first quarter so far, and what is your target market share for FY26?
Yeah, so our market share in terms of retail health has improved from 9.1% in FY24 to 9.4%, and this is despite 1/N accounting. So we would like to continue growing in retail health faster than market, let's say 6-7 percentage point faster, which should help us in getting to double-digit market share. Let's say I can't comment on timing, but yeah, we are very confident of getting there.
Right. Vishwanath, my key question to you is, from here on, the kind of growth that you're expecting in terms of FY26, the opportunities that you have, and are you looking at a strategic global partner as well from here on to harness that growth opportunity with innovative offerings? What's the stance on that front?
Yeah, so actually, if you see our promoter, Bupa is global giant in health insurance. They are into health insurance, healthcare. So in that sense, we get a lot of expertise from them in terms of product innovation, customer service, claims management, underwriting, etc. So that need is being fulfilled by Bupa globally.
So, but then what's the outlook looking like for FY26? And the trajectory in terms of your ROEs?
Yeah, so if we just look at last year number, our return on average equity was 8.4%, and this has to be seen in the context of the investment we have made in last 3-4 years in terms of distribution, network, increasing number of branches. And we feel in next 3-4 years, we should be able to get to return on equity of mid to high teens. That's the steady state target we are aiming at.
Right. So that's what we should be watching out for as well. Thank you, Vishwanath, so much for joining us on the show. That's the management of Niva Bupa. Clearly a good set of numbers that have been reported. But time for a big brokerage call. In fact, slightly delayed on the back of this conversation. UBS has downgraded our key forgings, and this is going to be interesting with the kind of moves that we've seen on the counter. Harsh is standing by to tell us more. Harsh, what is their stance And what's the target alluding to?
Well, first off, they've downgraded from a buy to a neutral, and they've considerably reduced the target price from 1500 earlier. It's now 680. There's still some upside from here, but there's multiple headwinds. So just let me try and contextualize this. Stock is down 40% year to date. They're facing challenges on multiple fronts. One is slowdown in the CV segment, and the second one is the inventory write-off. Let me talk about the weakening CV cycle first off. The global CV cycle is weakening and is expected to continue to deteriorate. The American Class 8 truck orders also continue to remain weak. Plus, on top of it, there is tariff-induced slowdowns which are likely to weigh in as well. So the trend is likely to worsen, is what UBS is saying. They do not expect recovery despite low expectations, at least in FY26. So that's the first headwind. The second headwind is with regard to the recent one-time inventory write-off. This could adversely impact projections going forward. The discrepancy has been reported in the annual physical verification of inventory, and as part of that, likely a 150 crore write-off is expected. They believe that this is accumulated over the years, and therefore it's going to be likely a one-time impact on FY25, but will also impact the way in which accounting will work for RK Forgings going forward as well. Fund infusion by the promoter to protect external and minority investors may be welcome, but nonetheless, headwinds galore is what they are saying. Medium-term factors dampen growth and profitability outlook. So for FY26 and 27, they've revised and cut their earnings estimates by 17% for FY26, 23% for FY27. And on the back of that, cut that target price as well.
Right. So that's the view on RK Forgings. Looks like it's going to start just a tad bit weak today, 0.4%. But let's take a look at where rates have settled. It's 9-10, and so you've seen enough action at the start and just about flat for the benchmark Nifty 50. The Nifty Bank also about 0.33% higher at this point. The broader market's looking sanguine, and let's see if that continues. That was the case in trade yesterday. The broader market's outperforming in trade. Let's pull up a few of the stocks that we were focusing on at the start, something like a Coal India. Let's see if it is reacting at all. Tata Motors, I think, is up today as well, 3% higher. Coal India is up and about. From the broader markets, let's see if any of the earnings reactions are coming through. Something like a Volta, something like a Blue Star. Let's pull up those two. So both of those. Blue Star not doing too well, but let's pull up Symphony as well. There you go, 10% higher. Very strong set of numbers. So those schooling companies are in focus and should be watched. PB Fintech, let's look at whether it's reacting to the latest development on PB Healthcare. Not too much, because I would think that a large part of this is already known, so maybe not too much of a reaction there. But I'll come to you, Shrikant, on whether or not you're seeing any other opportunities emerge beyond what you've spoken about so far.
No, I think Tata Motors is showing a lot of strength on daily as well as on monthly basis. And whenever we see such type of activity on monthly basis, it support us to take positional call on the stock. Based on its technical formation, I am expecting stock to move towards 850 in next few weeks. It will take some time, but broader formation is suggesting us that the stock is heading for 850 sort of levels. On MRF also, on which we were discussing, there also I am quite bullish, but yes, again, 150,000, 151,000 is going to act as strong hurdle for the stock. But on the dismissal of that, based on technicals, I can see that the stock can move towards the levels of maybe 2 lakh sort of levels. So the recovery which is there in the tire stocks is really encouraging. And if we consider other stocks, then in that CAT looks good. And after that, we can focus on MRF.
So let me get this clear. 2 lakh is a possibility based on the charts?
Yeah, absolutely. Way it recovered and the way it is outperforming to the broader market and the sector, it is very clear that the stock is heading for 2 lakhs.
Okay, Chakri, then the question is, would you buy it? You can afford it. The question is whether everybody listening in can afford one stock at a time, right? So would you buy?
Apollo Tyres, MRF, CET, all of them look good because they all benefit from low raw material prices. Demand has been weak for the last couple of years. Now it's picking up, and therefore, the valuations are clearly on their side. Even after the run-up, MRF still looks good.
Regards to where your tire companies are concerned. But apart from that, let's look at a PB FinTech and see what that counter is doing in trade. PB Healthcare Services has actually completed the first round of fundraise, no major moves on that one. But Srikanth, what are charts indicating with the PB FinTech, as well as if you have to look at the BFSI space, anything that comes to your radar quickly?
See, PB FinTech Policy Bazaar is in the range. It is failing to cross the level of 1700, but on the dismissal of that, I can see the stock can move towards the levels of maybe 2000 sort of level. So overall, the pattern is good, but for the time being, this stock is going to remain in a range. That's the view. From the NBFC space, a number of stocks recovered very well, including Jio Finance, Shriram Finance, Chola Finance. All these stocks are showing a lot of strength. But in that specifically, if I would like to choose anyone, then in that case, I would like to go with Chola Finance, which is currently around some 1575 sort of levels, and again the stock can move towards the levels of 1650 or 1700. So yes, we like NBFCs.
Okay, so Srikanth likes NBFCs. Now that is perhaps going to be one of the talking points at the start today as well, because as Hiral pointed out in her trade setup, there was resilience in the banking space. The Nifty Bank moving high about 0.6% yesterday. Let's see if it lends support in trade today. So the first ticks coming up on the screen. This was expected. Range bound start for the benchmark Nifty 50, about 0.1% higher. Of course, the expectation was of a minor downtick that hasn't come through. The Nifty Bank holding up, gaining about 0.4% or thereabouts. Broader markets, what about that? IT, okay, IT is not doing too much, about 0.1%, but let's pull up the broader markets and see whether the mid-cap index is once again outperforming, and that indeed is the case. 0.6% for the mid-cap index, another 0.8% for the small-cap index. Whether that strength builds through the course of the day is a question that you have to ask. India VIX cooling off just a bit further. Yesterday it heated up in the first part of the session and then cooled off towards the end. This is a further cool off. Let's pull up the heat map for the Nifty 50 and let's see what's moving in trade today. And look at the gainers at the start. Tata Motors, another up move. Srikanth likes this stock. We'll find out what levels he's looking at on the upside. And 3% higher after yesterday's 5% move is quite a considerable move for Tata Motors at the start. Coal India reacting to numbers, up about 2% or so. Axis, IndusInd, Kotak Bank, so quite a few private sector banks up in the top half of the screen. Power Grid is the other stock that is gaining about 0.8% or thereabouts. On the losing end, let's take a look at this. So you have something like a Dr. Reddy's Laboratories, you have Tata Consumer, you have ITC, SBI Life, Maruti Suzuki. So not really too much of a trend, at least in the bottom line of the screen, but you have a few sprinkling of FMCG companies losing. You have HDFC Life that is down about 0.5% or thereabouts, and you have HUL that's also losing about 0.5%. So not too much to speak of in terms of a trend. Tata Motors, a stock to watch at the start. So Hiral, that seems to be the picture at the start. A little bit of resilience in the banking space. IT not doing too much in trade today. What does the broader market look like?
And the other thing that I'm picking up over here is that pressure that is continued in terms of consumption from yesterday.
Yeah.
So if you see for the likes of Eternal, Tata Consumer, ITC, Nestle, HUL, all in terms of the top 10 losers. So I think that nervousness from a consumption perspective is there for a second consecutive session.
Because of geopolitics.
Absolutely. Dr. Reddy's is going to be interesting, and I don't know, I mean, is it the US tariff impact, or it's the IPM data that has come in for the domestic market that will tell us as to how the company has performed there. So I think Varsha will be able to tell us more on that front, and Cipla as well. So I think it's going to be interesting to look at this. But yes, overall 24,400 till the time you're maintaining that on Nifty 50, it is going to be important and it'll be on the positive side. So let's see where that takes us to. But let's quickly look at the sectoral heat map as well and see which are the sectors which are actually picking up. Yesterday, defense was the top losing sector. Today, again, that has picked up to be the top gaining sector with gains of 1% coming in there. Energy, private banks and the PSU banking space in the positive. Oil and gas is also seeing some good moves. There you go. FMCG, the top loser, 0.6% lower. Healthcare, consumption, pharma. That's where the pressure is. You have real estate, which is pretty much on the borderline. Metals is on the borderline. So what is being highlighted right now is Nifty defensive gains of around 0.7%. Now let's quickly look at the stocks in terms of the broader markets as well as the overall markets as well. PB Fintech, that's one of the stocks that we're looking at today, and this is on the back of PB Healthcare that has gone ahead and actually completed a $218 million first tranche of funding, and that stock not seeing a major reaction overall. Apart from that, if you see in terms of brokerage calls, RK Forgings is one where UBS has downgraded and cut the target price. Still, the stock is resilient with gains of 0.6%. MRF is another one. CLSA has gone ahead and hiked the target price. That stock has cooled off, seeing gains of 0.7%. And the Somani Ceramics, you have JM Financial and Asian Market Securities who've downgraded the counter stock, still seeing gains of 0.4%. Moving from there on earnings, Tata Chemicals, a weak set of numbers, has missed estimates. That stock is still trading in the positive, and a Coal India, which we gave a a down, is trading in the positive. So that's interesting moves that we are picking up so far. On the back of earnings, Symphony is another one, strong beat in terms of the fourth quarter, 9% up move, and I think we will need to get Mahima to tell us more as to what's worked on a Symphony. Sonata Software as well. The profit has beat estimates. That the impact is clearly being seen. Niva Bupa, we did speak to the management, and that's an NDTV impact that we're seeing, probably a 10.5% on the back of the commentary that's coming in as well. Blue Star, a 1.5 to 2% downtick. The numbers have beat estimates, but still you're seeing pressure on that one. And a Voltas, a slight miss, but strong domestic growth is what is keeping the stock afloat. Lupin has launched a new drug in the US. They have some months of exclusivity that is coming in. However, the stock is seeing cuts of 0.4%. Jindal Drilling on the back of a contract from ONGC, 1.5% up move on that one. And a Tata Motors, second consecutive session, and this is on the back of the US-UK trade deal that could be on the card soon, and seeing gains of nearly 2% in trade. And to be noted, JLR is almost 30% of Tata Motors' revenues, and US is a strong component in terms of JLR. So that's the reason why you're seeing these kind of moves. So interesting names, Alex and Somit, that we're watching out for. But Somit, any other stocks that are coming to your radar, which probably Alex and I have not looked at?
Well, one stock that has been buzzing in trade is Nykaa. It gained around 2.5% from yesterday's lowest point, and reports suggest that Nykaa might as well be a part of the MSCI inclusion. Chakri, any views on Nykaa here?
On Nykaa, not really, given that the stock still will face lots of margin pressure, and this is not a market which will kind of reward high valuation stocks. So from that perspective, we're still staying away from all the new age tech companies.
Right. And Shrikant, how's Nykaa looking like on the technical front?
Yeah, it is very close to its resistance level, and I think 200 is going to act as major resistance for the stock. So we are expecting stock to trade within the range of maybe max on the downside 180 and 200. But it looks difficult to sustain above the levels of 200.
Okay. Shrikant, any interesting plays in I know, and we haven't spoken about this in a while, I think, but IT is bouncing from the low point today. It's up about 0.5%. Not very big moves, but anything interesting there? HCL Tech up a percent or so. TCS up about 0.6%. Would you buy anything here?
See, if we go through with IT stocks, then all these large cap companies or stocks, they are available at their important support levels. But the recovery is not that encouraging, as we can say, we see whenever there is a dip sell-off in any sector or stock and then it recovers. So that buying interest is not there. But yes, few stocks like Coforge, Persistent, they are showing some strength, and there we are expecting gradual upward activity in the near term. So yes, Coforge looks really good because it is holding above the levels of 7,400 since last almost 10 days, which is something positive. It is relatively performing much better than the sectoral index as well as Nifty. So yes, there we could see some more activity, but again, we need to buy them with a view of at least next few weeks. So it's a positional buy, not with a short-term view, we can look for it.
What about Tata Motors? We spoke about it before trade, and it is indeed the stock of the day for the benchmark Nifty 50 top gainer, up about 2.3% or so. And you said that it's looking interesting. Based on yesterday's move and today's, would you say that it's something that you should buy?
See, at current levels, it is far away from its important support levels of 650. So for short-term traders, it will not reward because it is very close to its psychological level of 700. But if we take positional view on the stock, then I'm very much sure that the stock can move towards the levels of 850 in next few weeks. So it's a positional buy, and the strategy should be to buy at current levels, more on dips, with a stop loss below 650.
Shrikant, how are you looking at a Blue Star versus a Voltas and a Symphony? Because strong moves coming in terms of Symphony in today's day of trade, 3 from the durables pack.
See, the entire space is not showing any signs of any extraordinary strength or reversal activity. All the stocks are correcting from their highs and they are consolidating in a range. But in case if Blue Star falls to the levels of 1500, then there the stock is having long-term support. So around 1500 level, it looks interesting to buy and hold with a target of again 1800. So it's a buy, but buy on dips. For Voltas, again, we need to stay away from it because the stock is finding difficulties to sustain at higher levels. In this space, we like Amber Enterprises, which is around 6,000. And close to 5600 levels, the stock is having excellent support. It is forming some continuation bullish formation, and currently it is available at its support level. So around this level, the risk reward ratio is quite favorable for creating or investing in this stock with a target of again 7,500.
Okay, so that's the view coming in. I want to ask you about Niva Bupa. Shrikant, how do you react to something like this? Because it's clearly reacting to numbers. It's about 11% higher. But if you don't have a position, would you suggest that you can get in at these levels, or would you wait?
See, the stock is forming rounding bottom sort of formation. It means that the stock is going to cross or surpass its previous high of 110 after the listing which we saw on the screen. So possibility of crossing those levels are very high. It is relatively better than the overall performance of the Nifty and its index, so which is positive. But again, we should look for adding stock at current levels more on dips, because the stock is going to spend some more time within the range of 90 and 85. And later on, we can see some activity. So it's a buy, but buy with a view of at least next 3 to 6 months.
Buy with the idea of 3 to 6 months. 90 to 85 is the range that Shrikant is stacking on Niva Bupa. Thank you so much, Shrikant, for joining us on the show and sharing your views as well. So that's with regards to, what the stocks that are moving, your picks that you should be watching out for as well. But let's quickly slip into a short break. On the other side, we'll get you White Capital AMC's Ashish Samaya to talk about investing in the volatile market scenario and what benefits he sees in terms of the FTAs as well. Stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest
Welcome back. You're watching India Market Open, and it's been a bit of a soft start to trade today, but we're holding. And there is resilience that is evident not just for the benchmark, but for the market as a whole, that's seen over the course of yesterday and today amidst very significant developments, both on geopolitics as well as on trade. To give you the mutual fund perspective and how flows have looked in the recent past, we're joined this morning by Ashish Somaya, who's the Chief Executive Officer of White Oak Capital AMC. Ashish, as always, thank you so much for taking the time. Very good to speak with you this morning. We're speaking, I think, just a day ahead of the presentation of the data by the Association of Mutual Funds in India for the previous month, but you'd be able to give us some perspective on how you have seen flows. Has it been resilient? How would you compare it with recent months?
Alex, I don't see much. I don't think there is any big trend change that you're going to witness. If you look at whatever April data that we will get in the next couple of days, and if you compare April data with March, I don't see any reason for anything to change substantially. In fact, I believe that the gross equity flows would actually, maybe increase or maybe in a similar range. So typically, if you see the averages, we end up doing, X of index funds and ETFs. If I just look at equity funds and hybrid funds, we end up doing anywhere between 60,000-70,000 crore of gross inflow and anywhere between, say, 30,000 crore kind of redemption. So that's how the industry ends up between 35 to 45,000 crore of net flow every month. Now, typically when the market does badly, you find that the gross inflow tends to go down, but then there is also a bunch of people who don't want to redeem when markets are bad. So what happens is that when markets are bad, the turnover kind of comes down, the gross inflow also comes down and the redemption also comes down, but the net inflow doesn't get impacted too much. So my sense is that we will be in that ballpark. I don't see any reason, I haven't observed anything which tells me that there is going to be a big change in numbers really.
Right, Ashish, good morning. Hiral on this side. Now, taking into consideration the kind of resilience our markets are showing currently, in spite of the geopolitical concerns, you have US tariffs which are behind us. If you talk about India, UK FTA, that has turned positive as well for a lot of sectors. How should the strategy be from here on in terms of investments, taking into consideration where valuations are?
So, my guess, at any point in time, there are multiple variables which are acting on markets and on investors' actions. But if you ask me, I think in the recent times, the resilience has got a lot to do with the change of our external macro and the change of RBI's stance. Because, if you look at fundamentals, I don't think there was much that was being expected from the last quarter that went by. And, it's in line with expectations. I mean, people weren't expecting a big uptrend. People were just looking at commentary and maybe some positive trend. So from that perspective, I think the results haven't thrown up any major surprise. So I don't think that the uptrend in the market, we saw 21,700, we saw a lot of nervousness. And from there, we are, significantly up from the lower levels. And I would credit this resilience with currency appreciation, and typically currency appreciation is always accompanied by more confidence by the foreign investors, because they always prefer to invest when the currency shows some strength, right? So currency uptrend, interest rates, because obviously when the currency stabilizes, it strengthens RBI's ability to support our economic growth and credit creation and lower rates, liquidity, all of that. So I think the external macro is what might have given, and plus, see, look, a big part, like some 7-8 lakh crores of our industry is hybrid funds. And when yields go down, hybrid funds automatically tend to allocate more money to equities. And I think there is, so the buoyancy in the market is purely because of, my sense, external macro, which is improving local conditions. But on your question on the stance, I would still be wary, just because we're 24,000, I wouldn't extrapolate it up. I believe that from time to time, there will be volatility and there will be downside because geopolitics is not done and over with. And on the other hand, even if you see US, maybe India is close to signing an FTA, but that 90-day moratorium, China, European Union, further likelihood of, things, discussions going back and forth. So I think there is some uncertainty if the US economy is slipping, Chinese economy is slowing down. My sense is that because of the economic slowdown, overall, I mean, at a global level, I don't think we're out of the woods yet. But yes, domestic conditions have improved.
Ashish, you mentioned a couple of things that I'm thankful for. One, you've talked about the currency, and two, you've also spoken about hybrid funds. I'm just wondering, and this is essentially one of the litmus tests that I look at from the perspective of how an AMC is positioning itself. The Balanced Advantage Fund, is it overweight on equities? Is it neutral at this juncture? What is the fund view right now as things stand? And you mentioned that your positioning towards bonds would increase to play duration, considering that yields have come down, and that is definitely a bolstering factor. But what is White Oak Capital doing in its Balanced Advantage Fund?
Yeah, so apologies if I didn't come across correctly, Alex. Basically, what I was trying to say is that since the yields have gone down, right, what happens is it adds more to equity. The reason being that, typically when yields go down, obviously the discounting rates and the valuation that you are able to tolerate for equity, that kind of tends to go up. So what I meant to say is that in our Balanced Advantage Fund valuation models, other than stuff like, price to book adjusted for ROE, we also look at a ratio called earnings yield to bond yield. And when the bond yield goes down, obviously your equity allocation will start to go up. So that's what I meant. On your question, say if you ask a Balanced Advantage Fund like ours, we are at the higher end. Actually, we are more like 62% or 63% in equity. And everybody has different models. But if you ask me, for last couple of years, when market has been very volatile, at the lower end, I have seen 46 or 47% equity. And at the higher end, I have seen more like 63% equity. So, and these valuation models, they never swing for the fences. So I don't think we will ever go to 30%, which is the lower band, or 80%, which is the higher band. Typically, your average exposure has been 55. Right now, we are 62. So, from that perspective, our models suggest that we should be at the kind of say 60-62%. That's where we are. And if you look at multi-asset funds, where the range is from 15 to 45, there also we are just above the midpoint. We are more like 33% in equity. So I think because of yields going down, the allocation to equity has kind of gone up.
Quick question. Given the consideration that there could be a change in strategy and you've been encouraging a mix of asset classes between equity, debt and gold, what should an investor do in terms of their exposure between the three? And two, which sectors have been resilient where you are now allocating fresh funds?
So, Hiral, if you look at it, say, always a moving picture is what helps people to understand. So if I were to give you a perspective, say, when Nifty was, say, 26,200 in the end of September, at that time, our domestic conditions were not as easy as they are now. At that time, we were under pressure for interest rates. We were getting into pressure for currency, right? There was a huge Trump trade playing out. And markets had run up. We were 26,200 plus kind of number. At that time, our models were at, say, 24% in equity, 23% in gold, and the rest was, fixed income. From there, we have traveled now 6-7 months. The gold allocation has gone from 23 to 13, and the equity allocation has gone from 24 to 31. And all of this change is for two reasons. One is because equity valuations came off. And secondly, like I said, you will be able to tolerate higher valuations when the yields come off. So the equity allocation goes up when the yields are actually declining. So this is how the journey has played out from, peak of 26,200, then down by, say, some 5,000 points all the way to 21,500, and then this up move. So this is how the allocations have played out. My sense is that anywhere now in the next, if the market continues to remain like this, the models will start showing that equity needs to be reduced probably. That's my guess. Now, coming to sectors, we are not really a sectoral investor. We are kind of, we are not benchmark and we are not benchmark agnostic. I would say we are benchmark aware. So we don't chase any specific sectors, but yes, if I tell you where we are overweight, that will give you a good indication. So, one is consensus, which is banking, but not just banking. We are overweight, across the capital markets, insurance, the whole financial services, NBFC, the whole space. Then there is healthcare and consumer discretionary. I think these are top overweights. And the fourth one is industrials, capex, manufacturing, etc.
Ashish, a pleasure as always. Thanks so much for joining. I found that breakup that you gave us for the multi-asset very, very interesting. Thanks so much for taking the time.
Thank you, Alex.
All right, we have to slip into a very quick break. We've got more corporate conversations on the other side, so do stay tuned.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest. Welcome back. Now on to this chat with regard to earnings. We have Mr. Kalyan Kumar joining us of Punjab National Bank. Declared its numbers yesterday. Let's quickly get perspective on how the numbers look like and what is in store for FY26. Good morning, sir. First, I want to start off with trying to understand the Bhushan Steel case and where we're sitting at this point with regard to how everything in that case is playing out. I want to first understand what's the recourse available at this point and how are you all planning to proceed?
Thanks, Hers, for the opportunity. First of all, I respect the Supreme Court judgment in this case, Bhushan Power and Steel Limit. Our exposure was rupees 6,286.22 crore and we actually received approximately 3,000 crore there. And the recourses available in the law, our actually COC is the competent committees who takes decision, and the recourses and facilities available in the existing law, they are contemplating further action what they have to take within the permitted time frame as per the law of the land. In that way, I told you our exposure and our things, how it gets evolved. Now, the judgment is being actually they are discussing the judgments, and as things will evolve, then you will come to know about it.
And sir, the Committee of Creditors are having meetings, of course. As part of this meeting and the agenda, how is it playing out? Just give us some perspective on what's happening there.
Actually, I told you, COC meeting has started already. They have started meeting. All the banks, actually, they have already started. Number of meetings already have done. And as I told you, because all the banks will decide there and take all the actually necessary actions which is available under the law of the land.
Right. Sir, let me switch focus to Q4. Now, in terms of the Q4 sequential growth numbers, they look slightly softer. Just talk to us about what has worked for you, hasn't worked for you with regard to growth in Q4, and what's the outlook for in FY26?
Us, actually, we gave guidance to the industry. For credit, we gave guidance of 11 to 12% and deposit 9 to 10%. And we achieved growth of 13.6% in credit and 14.4% in deposit. In that way, we exceeded the guidance which we have given to the market, and looking to the opportunities available in the market and government's support, initiative, and also looking to the macroeconomic scenario, industry outlook, we are actually quite upbeat that our growth, we will going to achieve our guidance which we have given for financial year 26. For credit it is 11 to 12% and deposit again 9 to 10%. We are certainly going to achieve, and I understand from where you are coming, our growth in credit and deposit is less than as of December quarter. It was our considered decision, conscious decision to improve our yield on advances and reduce cost of deposit. In that way, we have actually reworked our portfolio. That's why this growth rate you are observing, it is less, but we have actually achieved the guidance given to the market.
That makes a lot of sense, Mr. Kumar. Thank you for that last piece to kind of clarify. So just talk to us, you're focusing on more higher yielding loans at this point, but margins have contracted significantly. So what's the outlook like with regard to margins and this higher yielding book shift or focus? How should it aid margins going forward? What would maybe, is it a bip or two in terms of better margins?
First, actually, you know, there is 50 basis point reduction in repo rate, and that is 6% now. And this reduction immediately on the next working day, it is passed to the customer. We are having 44% repo linked loan. Immediately, that actually hit on our income starts from the next day of implementation of this rate cut. And in that way, actually, approximately hit of 250 crore in this actually quarter was on our NIM. But immediately we started recalibrating, as I was giving my answer towards your first question. RAM sector, MSME, agriculture and retail side, more focused towards that side. And I am happy to share we have organized a customer outreach program in the month of February, and those outreach program we were able to mobilize good number of leads, approximately 24,000 crore leads in SME side, and approximately 10,000 crore in home loan side, and for SHG agriculture side also good leads were available, and those were actually converted into the business in this quarter. And also this is continuous process. We have opened 1,000 MSME intensive and agriculture intensive branches in all the active clusters in the country, and special products, customized products for those clusters we have prepared, which will certainly give us good spread, good margin to us. Apart from that, low cost deposit, CASA is also very important, where there also in current account we have revisited our products.
Sir, apologies
and,
apologies for interrupting. Sir, measures all look good. I don't doubt that. But where will margins bottom out in this cycle? Because certainly more rate cuts to come. So where do margins bottom? What's the outlook like? And thereafter, I understand your guidance for FY26.
You are right, actually. We expect that more rate cuts will be in near future. And that will certainly impact our margin. As I told you, this time also it has impacted our margin. But I am of the opinion that NIM will hover around 2.8 to 2.9% for PNB. Otherwise, I would have more upbeat, it would have crossed. But looking to considering those things in our mind, we have given guidance of 2.8 to 2.9% for the NIM for the next year.
Right, sir. Sir, switching focus to asset quality, slippages have spiked. Give us perspective on that.
Hers, actually, this slippage, I will say that this quarter, agriculture was an outlier. In December quarter, slippage in agriculture sector was 306 crore, but in March quarter, it went up to 1,400 crore. It is due to change in actually interest application. Earlier, it used to be March and September, but this year we have implemented it on anniversary date. That was the main reason behind slippage, more slippage in agriculture side. I look at it as one-off incidents. It will not be common, but more slippage was towards less than 10 lakhs segment. MSME also, previous quarter it was 829 crore and this quarter it was 995 crore. These two segments, agriculture and MSME, actually played important role in increase in slippage. But I assure you, it is still half of the recovery. Recovery is double than the slippage amount. And slippage is actually 6,390 and recovery is 14,336 crore. In that way, the technological interventions which we have made in slippage, containing slippage part, so many innovative things PNB has implemented, propensity-based collection, and also frequent message to the customers. PNB also triggers. This is very important area, actually, where I can proudly say that our collection efficiency is 94.41% and can assure market that in coming next year also, our collection efficiency also is going to be maintained.
So point taken. So you've breached the 1% ROA threshold. What's the outlook like for FY26? Can you hold the full year ROA at 1%?
The kind of initiatives and point I have shared with you, I am sure that our ROA will be above 1% next year.
Okay, point taken, sir. We'll let you go on that note. Thanks so much for coming in, speaking with us on NDTV Profit. With that, back to you, Alex.
Yeah, well, okay. So there you have it. The management of PNB speaking about a variety of issues, not least of which the Bhushan Power issue, which the street has been looking at very, very closely. But there is a stock that we're focusing on at the start today and within the first hour of trade, and that is KPIT on the back of its acquisition of Caresoft Global Engineering Solutions, which is it has announced the value of the deal at $191 million or thereabouts, and this is a 100% acquisition. We're joined by Sachin Tikekar, who's the President and Joint Managing Director of KPIT Technologies this morning, to give us a sense of what the thinking behind this deal is and what opportunities it presents. Mr. Tikekar, thanks so much for taking the time. Tell us about this, give us context and tell us how it's going to improve business for you.
Absolutely. First of all, thanks for having me and good morning to all of you. If you look at our business, more than 70% of our business came from passenger cars over the years. And it's been our effort over the last 2 years to expand into trucks and off-highway. That's one thing we've been investing in. And secondly, we've also been investing in China as a market. As you know, the Chinese car makers and Chinese truck makers are making quite a splash. So these two areas were important. And from that perspective, we think that this acquisition of Caresoft helps us to deepen our focus on trucks and off-highway, number one. Number two, they've been in China much longer than we've been, and they've been working with some of the new age OEMs there. So that helps us to sort of accelerate our foray into China. The third part, Caresoft technology platform does vehicle cost reduction programs. And it's an incredible opportunity for KPIT to sort of partner with them and help our OEM clients reduce the cost of their vehicle. And last but not the least, what is complementary to us is the manufacturing engineering services. This is something that in KPIT we didn't have much expertise in. And so these are the four things that made the acquisition very compelling. And we believe that this will help us to help our OEMs reduce their cost of the vehicles and also provide much broader holistic solutions beyond software.
Sachin, good morning. Hiral on this side. So when do you expect the acquisition to be EPS accretive? And secondly, how much will it contribute to your revenues in FY26 and then years thereon?
We hope to close it during this quarter, and it will be EPS accretive from day one because Caresoft profitability is the EBITDA is in excess of 25%. So that helps us and to have profitable growth. To answer your question about how much it would add to our top line, it depends on when we'll have the entire deal sealed and revenues integrated with ours. So we'll be in a better position to answer that question in a couple of months. Hopefully, with our quarterly earnings call, at the end of this quarter, we'll be able to provide more clarity. But we do believe that it would be in the range of 40 to 50 million US dollars.
And Sachin, the other question is in terms of the acquisition multiple. I mean, it is at a premium to the past ones that you've done as well and on a trailing basis. And if I have to compare this acquisition, it is also at a premium to the acquisition that HCL Tech had done of ASAP and Intech that was done by Infosys. Just to understand, why this kind of a premium valuation?
So let me just put a context. Usually, if you look at most of the acquisitions, they are about at the 10 to 16%, 10 to 16 times, in terms of the multiples of the EBITDA. Caresoft Engineering Services EBITDA is in excess of 25%. So if you look at the overall value, it's at around 15 times of the EBITDA. However, there is a more than 10% variable pay. So if you take out the variable pay, which is based on performance, to exceed the goals, then it's in the range of 12 to 13 times of the EPS. So we think that given what we gain in terms of the depth and breadth in our offerings to our clients, we believe that it's a great acquisition for all the stakeholders, not only for our clients, but also for our shareholders and employees.
Sachin, you mentioned, and okay, I've taken that point on valuations, but you mentioned the contribution to revenue likely to be in the ballpark of $40 to $50 million when it does come through on an annual basis. I'm just wondering, this is not a significant deviation from the sales that was achieved in FY24. If I'm not mistaken, those entities managed sales of about $51 million. Why is it that they're not growing as fast as you yourself, perhaps?
No. So let me just clarify. And that's why I said the revenues for our financial year will know only on the date of the closure. And it depends. So if you lose one quarter, even though there is growth in this business, we won't be able to take the entire growth in KPIT for this financial year. So we do believe that this business will grow once the entity is fully merged with KPIT in line with KPIT's growth rate. We don't think that there is going to be a deviation there.
Okay, no. That clarification is appropriate because then you're talking about 3/4 of contribution to your revenues. I understand that.
Approximately.
Yeah. Thank you so much, Mr. Tikekar, for joining in. Wish you all the best with this new acquisition and look forward to the clarity that you will probably be able to provide in a couple of months.
Absolutely. No, thanks for having me.
Pleasure. All right, time for a short break. On the other side, we'll bring you Pallav Banerjee, who's Managing Director at Pearl Global Industries, to talk about the implications of the UK-India FTA, which was signed amidst quite a bit of fanfare. So do stay tuned for that.
That's huge. That is a biggie. It's out of it.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture?
Welcome back. You're watching India Market Open. Let's quickly just pull up Nifty 50 as well as Bank Nifty right now as we speak. Currently, you're trading pretty much at the lowest cuts of 0.2% coming in there. In fact, we've broken 24,400 in trade. 24,350 is the next level we should be tracking in intraday session in today's day. Bank Nifty as well. Let's quickly pull up that one. There you go. 0.2% higher, but no major moves coming in on this front. So we are going to be in wait and watch mode. That is what is the indication that we're picking up so far. But moving on, you have your agrochemical companies that are in focus, and this is on the back of the anti-dumping duty that has been initiated by China. Let me head across to Varsha to understand more. Varsha, what is this anti-dumping duty that China is talking about? When are they going to be implemented, and which are the companies they impact, and to what extent?
Thank you for that. So normally we see that, India imposing anti-dumping duties on Chinese products, but this time China has imposed anti-dumping duty on one of the agrochemical which is used as an insecticide. Now, Chinese investigation found that India was dumping this product, cypermethrin, which is an insecticide, and this dumping caused material damage to its domestic insecticide industry, and a causal link was established between dumping and the damage. Now, talking about the duty margins, anti-dumping duties will be effective for 5 years, and duty margins will range from 48% to 166%, and this has been already initiated yesterday. So Wednesday is the period where anti-dumping duty will be started. If I were to talk about the company specific and which of the stocks will be in focus, you have Make Money Organics, which has a duty of around 62%, Bharat Rasayan Hiranba Industries, and UPL, which has a duty of 166%, will be impacted the most, and other Indian companies will also have 166% of the duty. China announced this anti-dumping duty on May 7, 2024, and a preliminary ruling of dumping and damage was actually issued on Jan 7, 2025, and the provisional anti-dumping measures have been placed since Jan 8, 2025.
Right. Thank you so much, Varsha, for getting us the details. You're not seeing a major reaction that's coming in on any of the names that have exposure to this one, but Sharda Cropchem, which is at the day's highest levels. So interesting moves opposite direction is where the stocks are moving. Moving on, the India-UK free trade agreement is said to actually supercharge India's textile sector, now granting duty-free access to the UK market. We have Pallav Banerjee, MD at Pearl Global Industries, joining us. Pallav, good morning and welcome to the show, and a pleasure to speak to you as always. Clearly, the FTA that has been signed seems to be a positive, and textile industry is the key beneficiary, and that was clearly visible in terms of the stock reactions that we saw in terms of yesterday's session. Firstly, if you could explain to us what would this mean for the sector and in terms of Pearl Global as well.
So yes, with this FTA, India comes into the same playing field like with some of the other countries like Bangladesh, Cambodia, Vietnam, Turkey. So all these countries had this advantage which India did not have. And UK market definitely is one of the, I think apparel is the largest that we are, what we are shipping to UK as of now in terms of all of the products. So I think that is poised to get some kind of, good significant gain as this FTA will come into effect.
Can you take us through some of the some of the numbers as they stand, and good morning to you, Pallab. Thanks so much for taking the time. What is the kind of revenue contribution for you geographically currently in the UK, and do you see that moving up considering that it becomes more lucrative for you to participate in a bigger way?
Oh yes, of course. Because we have already in the UK market, historically we have been doing about 250 crore plus business in the UK market. Primarily we have been shipping because Pearl as a company, we do ship from many other countries. Like we have factories in Vietnam, Bangladesh, Indonesia, India and Guatemala. So primarily the shipments have been going from Bangladesh and some from Vietnam and also from India. With this effect, this FTA coming into effect, India sector gets a huge boost. And the kind of advantage, the two kind of advantage we can think of. One would be that the product which had a cost innovation factor from India now becomes much, much more competitive. And the margin pressure that would come, like when a company who is importing, let's say, have a choice either to import the same product from Turkey or Bangladesh or from India, whereas on those two countries, or like even for Vietnam, they don't have to pay that duty. So naturally, the cost burden share was always coming onto the vendor side as well, this tariff difference. So now that advantage of this 10 to 12%, depending on which product we are shipping, comes in our favor. So both in terms of growth as well as better margins, both kind of improvements we'll see in our business as well as I'm sure like the other Indian exporters who are shipping to UK market.
Right. Pallab, one question I have is with the exposure that you have in terms of Bangladesh and Vietnam, the ongoing crisis in terms of Bangladesh was taken into consideration as a tailwind for Indian textile sector. Plus, you're talking about the China Plus One strategy as well. How are you placed then in terms of the exposure that you have to Bangladesh? Will you be shifting, manufacturing from Bangladesh? And if so, how are you playing that entire dynamic?
Yeah. So you see, like specifically, if you speak about UK market, almost 50% of their total apparel imports is coming majorly from three countries: China, Bangladesh. Both are around, I think, 20%. I think China is plus 20%, whereas Bangladesh should be about 17-18%. I think in that range, and followed by Turkey, which is about 8 to 9%. So between these three countries, almost 50% of the UK market share is there. India was following them. India was at around 6% of a total, you can say about $24 billion of imports that of apparel that is going into UK. So I think at this point of time, most of the Western economies are, talking and thinking, and also we are seeing certain actions to decouple from the China. So that gave rise to this China Plus One, and which has really accelerated with President Trump coming into his second term. So that's something like we are seeing as a direction overall in the Western economies. So if that continues, I think that's a major gain that would happen. Bangladesh, fortunately, for the country, for Bangladesh, they had a duty-free access because of the LDC status to UK. And that is going to continue till 2029. They will get that benefit. So a lot of dependency of these UK customers are there in Bangladesh. So really to decouple it overnight or very fast, I don't think that will happen. But yes, there is an awareness among these customers to de-risk from Bangladesh. That means may not decouple, but de-risk. You understand that the difference. They will try, if they have one particular category where they feel that there's overexposure and they're buying a lot from Bangladesh, they would like to spread that into other countries as well.
I'm also
those kind of fringe benefits will continue to get.
Yeah, but just to answer what Hiral asked you, and to give us a sense of how your own manufacturing picture will change, Pallab. And I appreciate that you've explained to us what the overarching scenario is. But considering that it's now more lucrative to manufacture and export out of India, what does your manufacturing footprint look like in the near term? And from that perspective, the add-on to that is, if it is indeed going to result in a larger share of India in the overall manufacturing pie for you, does that require you to spend on capex and bolstering capacity here?
So we, as a company, we have been forecasting and strategizing for it for last couple of years. Not only for UK, but we feel that there's a huge opportunity that is coming into India for the garment sector, and apparel sector. So as a result, as I speak, like almost we doubled our capacity over the last 1 or 2 years in India. And so we have that advantage at this point of time, because some of these UK customers and some of the other customers also who were de-risking and decoupling from China and Bangladesh have been talking to us to increase the share in a country like India. And that has been ongoing discussion. So naturally, we have been doing the capex. And as I speak today, we have that additional capacity which is available. How I see the UK market will play, most probably that will become 2x or 3x immediately in this next 1 to 2 years. And talking about specifically of Bangladesh, there could be some shift, but I don't see a major, I don't have to decrease my Bangladesh share to gain my India share. So what you have to understand is we have been investing in this UK market for a long time. We do have a well-established office with our designers, marketing, merchandising staff in London. And that works very closely with some of our strategic customers, various customers, the big names of UK. And they have been pushing us, like if this FTA happens, what are the benefits that they can get from India? So these things have been under discussion for some point of time. In fact, too much of a long of a time, because we were told that by 2022, Diwali, this is supposed to come. And it took some extra time. Of course, this kind of FTAs are not easy to sign, and it takes time. And unless until like what US is teaching us at this point of time, that things can be very fast as well. So this have been in the work. So what we will see over the next few 1 or 2 years is that there is significant growth in the UK market share from our India operation. And Bangladesh would love to maintain, because Bangladesh has been a good performer for the UK market.
So,
what you have to understand is that
Pallab, all in all, what I would want to ask you over here is, taking into consideration the quantum of your revenues that come in from rest of the world, we're at around, previous year is around 950 odd crores. Your first 9 months of FY25 is around 800 odd crores. And overall, total revenue around 3,277 odd crores so far. Will your rest of the world revenue contribution increase from here on, taking into consideration the tailwinds that you're seeing in the UK market from India, from Vietnam, from Bangladesh, if all the three fire to your advantage? By how much and how margin accretive will it be?
So as I said, we are looking forward to double the kind of UK share that we have at this point of time. And that's primarily from India and Bangladesh. You have to also keep in mind that our total sales that happens from all the region is across many other regions. We do, our US is a bigger market. Similarly, Japan, Spain, these are bigger market than UK. So naturally, what we see is that we will experience growth in the overseas sales as well, and a significant growth in the India sector as well.
Last question from my side is, in terms of US, what is your exposure to the US markets, and anything that impacts or benefits if the trade tariffs come into play?
So overall, from a company perspective, the goods that is landing and going into the market of USA is about anywhere between 45 to 47% of our total revenue. And what we feel is that India, like as President Trump and his cabinet have been speaking often, that India would be one of the first, bilateral trade agreement that they would sign. And we are very hopeful that most probably we will be restricting ourselves to the baseline tariff of 10%. Yes, he has been hinting that there will be other countries which may have some additional tariff over and above the baseline tariff, but it will be significantly less compared to what he had declared on 2nd of April. So that's where we stand as of now. And from the customer point of view, we have a very strong foothold. And most of these customers are talking to us in the long term, and they are booking their capacities across the globe.
Pallab, just to, and not to belabor the point, but just so that we understand and your investors understand as well, currently around 10% of revenues from UK, you see this doubling. Is that clear?
For us?
Yes, for you.
Yeah, the overall revenue is less than 10%, but yeah, I'm seeing it doubling.
Less than 10% means how much?
So we are in that NDA period at this point of time specifically, but I can talk of the historical reference. If you see our trends, UK has been almost about 6 to 7% of our total share of business that we do. So that we expect to double at this point of time.
Right.
How this percentage will shift will depend on the other markets as well. We are seeing a significant rise from markets like Japan and Spain as well at this point of time, apart from US.
Pallab, I really appreciate that you've taken the time and also that you've spent the time explaining the implications for you, and wish you all the best. Hope this deal gets signed and the implications come through faster than you've had to wait. You've had to wait for 3 years for this to come through. I see the happiness on your face of this deal being signed.
Yes, you see, the most important part is that once you start working with any market, there are many finer nuances that you understand. The design, the work ethics, the kind of, the need that they have in the factories and all. So we feel that we have been investing on it for such a more than 10 years now in that market, having our own office. We invested that and we have been taking the benefits, but there's an opportunity to really, fast forward it and things could be much better.
And drive that home.
The focus that we had for ourselves, that gets fast forwarded.
Yeah. Thanks so much for joining us and wish you all the best.
Thank you. Thank you so much for having me.
All right. Let's talk about more implications of this FTA and what's building on the trade front, because understandably, a lot of countries getting into bilateral agreements. This is a new age that has been heralded, one can argue, by the change in the White House that you saw earlier. Manpreet Gill, the CIO of Africa, Middle East and Europe of Stancy, is joining us this morning. Manpreet, thanks so much for taking the time. Brave new world, you can call it. And amidst that, I think a lot of people looking to have conversations with India. What did you make of the announcement of the FTA? What are the implications? And do you expect that more such deals will come through?
Good morning. Indeed, brave new world. I think since November, I think trade has been sort of the top of everybody's agenda. Look, I think there are two ways to look at some of the recent trade deals. You could argue that the UK-India FTA, for example, has been in the works for some time. But I think what's really giving these trade deals more impetus is just the environment we're in, given what's changed, from a US policy perspective. So I think implications are, trade deals are a positive, right? I think it's hard to argue against that. But I think why they look interesting at this particular point in time is that when I take a financial market view, there's obviously been a lot of doom and gloom driven primarily by worries about just how much of a hit economic growth in India, in the US and elsewhere, how much of a hit to growth we'll take from the tariffs that have come through. So the more policies that are able to sort of offset that, lean against that, the better we're likely to be. So in that sense, I think FTAs are likely to be well received, but just how many more there are, what sort of form they take, there's likely to be a lot of focus on that. And I think particularly what sort of deal is likely to come through in the US and how the US sort of forms trade deals with key trading partners. I think that's really the key focus from a market perspective.
Right, Manpreet, that's an interesting point to make. But let's talk about the domestic market as well in terms of what's happening. The FTA, yes, a positive. There are some concerns with regards to US trade tariffs. You're talking about the geopolitical situation in the country as well. And with all of this said and done, you have valuations to some extent which are compelling. Which side of the boat would you advise an investor to go? Time to hold back or time to start deploying?
I think when it comes to Indian markets particularly, I think we're more in the camp to use these opportunities to start deploying within reason, right? We're big fans of diversified portfolios, and that diversification, of course, is more important than it's ever been in this environment. But within that context, to your point, right, yes, there are always a lot of things out there to worry about, and we're in an environment where we need to keep a close watch on trade deals, geopolitical risks to ensure none of them worsen to the point where it would be prudent to change views. But having said that, and having said that, there are always risks to keep in mind. The other key element, which you brought up very well, is what's in the price. And the fact that we've seen in Indian equities, perhaps more so than elsewhere, the pullback started much sooner, well before April. And that's left Indian markets in arguably a much better position from a valuation standpoint in terms of pricing and some of that slowdown, some of the risks. So that's why we'd rather be a buyer than a seller when you take a domestic investor's perspective. And even from a global investor's perspective, one of our views has been, look, there's been a huge focus on US equities alone in recent years. We think we're in an environment where it makes sense to diversify to Europe, to Asian markets, including India. So those to us are the positives. It's not about ignoring the risks. I think we still need to close watch on them. But on balance, we just think we'd rather be buyers than sellers.
That you're saying that because that sort of builds into the narrative that we've heard over the last few weeks from international investors as well about moving away from Wall Street and looking for opportunities around the globe, and specifically talking about India. Manpreet, how closely are you watching the currency scenario play out, and how much of a bearing will that have in the way that you deploy funds in the near to medium term?
Well, I'm so glad you brought it up, because I've often been one of those advocates of following currency markets and arguing we don't follow currency markets enough as equity or bond investors. I think the big picture context and why we think is important is, the dollar is quite a big driver of flows into emerging equity markets, including India, right? And obviously, since 2021, 22, the dollar's been holding quite strong, and that, if anything, has been a headwind. But if we are starting to see that getting chipped away to some degree for a variety of reasons, that on its own is a positive for emerging assets. We initially saw a bout of dollar weakness against the majors. I think what we've really seen in recent days is some dollar weakness start to emerge against major Asian currencies. Look, this is just a week, but I think in the bigger context, if that has one roadblock or headwind to foreign investor flows into EMs like India, some dollar softness, even if it's just softness, not necessarily a big downtrend, can be an additional positive, an additional tailwind, which feeds into our view that it's no longer about a US equity-led view alone. It's about having equity exposure that's spread across regions, including in Indian equities.
Okay. You mentioned bonds as well, and I'm just wondering whether there are opportunities that you're spotting, and I will keep this short because most of my viewers are, in fact, interested in equities. So, quick answer here. Do you see opportunities in India bonds?
We do, and I think even for equity investors, having some diversification into bonds and gold is reasonable. We've always been of that view, right? And the opportunity today is that, an environment where we've been worrying about, moderately a slower growth, more risky environment, that's where bonds can play a key role in an equity portfolio, not only in terms of the returns on their own, but also helping buffer the overall volatility. An allocation to bonds and allocation to gold is what almost allows you to take a little bit more risk without, having to increase the volatility to the whole portfolio quite a bit. So yes, we still think it's a good time to hold some bonds, particularly when, the RBI is biased towards cutting rates. That's always a tailwind.
So the only reason that I kept that short because the tax treatment on bonds is not the most favorable for the Indian investor currently, and so therefore it doesn't make sense if you're paying that much tax on it, right? So, but speaking about equity and to drive home the point that you were making, and there are opportunities, could you distill that for us and tell us, because if you're talking about the move over the last month and a half, Manpreet, the catch-up that has taken place in the Indian equity markets has been pretty red hot. And so from that perspective, a lot of the opportunities that might have been visible even a month and a half back have evaporated very, very quickly. And so if anything, the argument is that we're neutral in terms of valuations as things stand right now. We're not too expensive, we're not too cheap. So where are you seeing pockets of opportunity?
I think there are a couple of different perspectives I'd bring there, right? I think one is, looking at the nominal price, yes, it's easy to say, look, if we're back where we were at the start of April, is that a good thing or a bad thing? I'd argue the price level does not tell you as much as, look back into fundamentals does. Because yes, the prices have rebounded, but it's the valuation number, the fact that we're not back to elevated valuations, that to me gives me a little bit more comfort. Because let's not forget, the whole debate was, when have markets sort of priced in, growth sort of moving to a positive but somewhat lower level than where we were last year? And you could argue that process has already occurred. The other one, of course, is, look, we do need to think in terms of scenarios, right? Because, and that's not India specific, but at a global level, if I look at the US scenario for a moment, our base case is still that we start to get trade deals, we start to get growth stabilize, and that's of course good for equity markets. But there is obviously that concern about, what if this growth slowdown extends further than we'd like? Those kind of factors do have some sort of drag on onshore markets. I think one way we're trying to address that is through our sector calls, because one rotation we made, and this is mainly a top-down call, is we sort of closed our preference for infotech in onshore Indian equities and replaced that with healthcare. That's arguably a more defensive approach. We're trying to reduce exposure to trade-sensitive, US growth-sensitive sectors and raise more exposure to a relatively more defensive sector. But that's perhaps an example of saying, look, we would like to stay invested for a continued equity rebound, especially when valuations still don't look like a hindrance. But how do we build a little bit more balance into that, a little bit more caution? I think that's the way we are addressing it from an investor perspective.
So Manpreet, taking into consideration the India-UK FTA, how positive would you be in terms of the auto and the auto ancillary space, taking into consideration the opportunities that I know you can't talk stock specific, but for the likes of a Tata Motors or a M&M, which in a way for the Indian players like a Maruti and a Hyundai are slightly on the back footing with the kind of cheap imports that could come in, right? So your sectoral perspective, would you bet on auto as well as auto anch?
Look, I think there's an absolute and a relative angle here, right? Because, no disagreement with what you said. If you take a sector perspective, is the FTA likely a positive catalyst? Most likely, yes. But I think when we think about our own sector perspectives, we're trying to almost identify top-down where we like to get the best relative performance. So looking beyond just the FTA itself, because one is the sectoral specific impact of the FTA, but what we're focused on also is the bigger picture macro implication of the fact we've got one FTA and the likelihood that maybe there are more in the pipeline, and particularly keeping an eye on any deal with the US. Our sector preferences from a ranking perspective, we'll still put consumer discretionary more broadly. I think that feeds more to domestic growth. That looks interesting as an international investor. And financials, which we think is a more unique story. And like I said, third is sort of looking at healthcare for adding that defensive tilt. I think in terms of relative preferences to the way, or rank ordering the way we look at it, those would still be the three areas we focus.
Manpreet, what's your reason for being positive in terms of consumption? Reason being is there is pressure in terms of consumption right now, in spite of whatever is being announced in terms of the budget, the income that comes into the hands of the people. Urban recovery is something which is not happening. Rural is picking up. So what is your thought process behind consumption as a bet?
So I think it's really sort of trying to balance what the current news flow and what recent data tells us, and trying to balance that with what we think is in the price and the forward-looking path from here. Because without disagreeing with anything you said, I suppose the two offsetting factors we balance that with is one, how much of that is now well known and possibly in the price, and second is which direction our policy catalyst is going. So yes, we had obviously the budgetary support, that's from the fiscal side, and increasingly so more room to provide support from the monetary side as well. So when you balance those factors up, you sort of say, look, would you rather be a buyer rather than a seller? I guess it comes to the same question.
Well, point taken. Manpreet, thanks so much for joining us this morning. Fascinating insights, and thanks so much for taking the time.
Thanks so much.
Right, that brings us to the end of this edition of India Market Open. It's been an absolute pleasure bringing it to you from the entire team that put this show together, from Hiral and myself, of course. Do stay tuned. There's lots more coming up. And Ask Profit is up next. So keep your questions ready.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands.
Welcome to NDTV Profit. I'm Mahima Vachrajani and with me is Puneet Jhaveri and you're watching Ask Profit. Before we move on to the queries and interesting management conversations lined up for you, let's take a quick look as to how the markets are panning right now. Well, markets have been resilient since yesterday. The Nifty 50 right now is trading flat, up by about 0.1 odd %, but the broader markets are doing well in trade today. Both the mid-cap 150 as well as the small-cap 250 have gains of about 2 odd %. Let's also pull up the overall Nifty heat map and see what stocks are buzzing in trade today. We have likes of is that M&M? Okay, no. Tata Motors. Tata Motors, which is up by about 2 odd % in trade today. There's Asian Paints also buzzing ahead of its earnings. Kotak Mahindra Bank up by about 1 odd %. Coal India on the back of its earning up by about 1 odd %. SBI up by about 1 odd %. Trent is also doing well in trade today, up by about 1 odd %. Eternal is down, seeing pressure of about 2 odd %. Yesterday also facing about 1 odd % of downtake. Tata Consumer down by about 1 odd %. Maruti also down by about 1 odd %. There's ITC also languishing in trade. It's down by about 1 odd %. Let's pull up the advanced decline ratio and see what that chart is indicating right now. Of course, it's the broader end of spectrum which is doing well. There you go, 1800 odd advances versus 380 odd declines, and that gap throughout the trading day has been widening. So interesting to watch out that, because both the mid cap 150 as well as the small cap 250 are seeing gains of about 1.5 to 2 odd %. Let's pull up the sectoral heat map and see what sectors are doing in trade today. There you go. There's Nifty Media up by about 1.5 odd %. There's Nifty Defense also doing well in trade today, up by about 1 odd %. We have Nifty PSU Bank, Nifty Energy, Nifty IT doing well. Nifty FMCG languishing down by about 0.9 odd %. Consumption is also not doing very well. Nifty Pharma down by about 0.6 odd %. Nifty Auto down by about 0.3 odd %. Let's pull up the constituents on Nifty Defense and see what are the counters that are actually kind of buzzing and leading that gains of 1 odd %. If we can pull up Nifty Defense, till then let's also see what are the other counters that are doing well in trade today in terms of the overall Nifty market. There you go, BEL seeing gains of about 0.3 odd percent. Let's also pull up some other counters. Mazagon Dock doing well, HAL doing well, Cochin Shipyard up by about 1.5 odd percent. Also pull up the BSE 500 if we can and see what counters are buzzing at the broader end of spectrum. There you go, Jindal up 12%, Apar Industries up 10 odd percent. Symphony on the back of its earnings doing very well, above about 10 odd percent. Significant beat across numbers and all earnings. KPR Wellspun Living on the back of UK FTA seeing gains of about 6 odd percent. CCR Products down by 3 odd percent. Some profit booking there after earnings. Arkin Chemicals down by about 2.7 odd percent. Polymedicure is also down by about 2 odd percent. But Puneet, M&M is in focus. What's the deal there and what's happening exactly?
Definitely. After earnings for Mahindra & Mahindra, we've seen that positive momentum continue for the counter. The other one I want to also mention is Tata Motors as well, because that is one of the key beneficiaries of this UK FTA. Yesterday also the stock was up almost 3 to 4%. Again up 2.7% today, and we've also had a City note on the company today. They mentioned that they could see a 40% correction in terms of prices for Land Rover in India because of favorable pricing as well as lower taxation essentially that India would offer UK. Currently I think the cars are taxed at 110% in India. That could come all the way down to just 40% for importing the completely built unit. The other one I want to just highlight is of course Shriram Pistons as well, on the back of results, almost up 13% on Q4 earnings as well. But there's also one more stock, Mahima, which is GCPL. We've seen the earnings come out yesterday. What were some of the key highlights?
Right, so it is buzzing on the back of its earnings, and numbers were largely in line, margins lower than normative range, but the commentary coming from the management is quite positive. In terms of the consolidated volume growth, that stood at 6%, and I had the chance to speak to Sudhir Sidapati, who is the Managing Director and CEO of GCPL, and Asif Malbadi, who is the CFO of GCPL, whom I spoke to. Listen into the conversation.
See, our priority is a company volume growth, not value growth. We price to recover costs and not price for growth. Our idea is to get more penetration in more years. So whatever the price growth is, that's the price growth. Our hope is that we can move from big single-digit volume, which we had last year, to high single-digit volume. This is what we would like to do in FY26, which means a little bit more growth. And then that's what we're aiming for.
Right. And in terms of margins, you did mention in your press release this time that they were below normative range. But from what I understand is that, we were discussing earlier as well, that palm oil prices have now started to ease. That it's not the case how it was 2 months or 3 months back. How are you seeing margins improving, let's say, from a longer term perspective by FY27? What is going to be the normative range in which margins will be at? And secondly, what will be the levers that will be auguring the growth? One thing is, of course, palm oil prices going down, but what are the other levers that you think will augur the margin growth?
Sure. So I think as a company, we've delivered a strong margin profile of 21% at the company whole level. And these are on the higher side of the range which we've historically done. So we are in a good kind of shape in terms of the overall shape of margin. Within that, the India margins have been mildly lower. They've been around 150 bits lower than a normative range in last quarter, primarily coming on the back of the palm oil prices that show up higher. We're seeing early signs of palm oil reduce. There is a possibility that palm oil prices will be subdued over the next few months, and hence more towards the latter part of the year, we should see margins improve and get back into normative range. We are not worried because these are not structural, these are short-term fluctuation in commodity prices, and hence we're quite reasonably sure we'll get into.
Got it. There was one interesting trend that I observed this time when FMCG earnings were coming out, and that was coming out from the commentary that these companies are giving. Just wanted to understand if that's the trend that you've also observed. It's something that the managements are saying that this time we've seen more growth in terms of lower end of products rather than premium products. And I wanted to understand, because you are very well penetrated when it comes to rural markets. Is it the trend that you are also observing, and do you think that there is a structural shift there that we are observing?
It's an interesting question you ask, and the answer, I'm thinking through the answer as you speak, because over the last couple of years, it's been the reverse, where it's been the market that has been premiumizing.
Right.
Have I seen a change in last quarter? Not discernible, but it's also fair to see that the kind of growth that we saw in premium, or the difference between premium and mass, have probably come down in the recent past.
Correct. Right. And in terms of your overall home care business that has, spurred this quarter, do you think that this growth is sustainable? And going forward, what is the kind of outlook that you give for your entire home care segment?
See, home care segment has three categories in it. Air care, which has seen secular growth and will continue to see growth. Laundry, which has seen recent growth over the last 1.5 years, but I think that will continue. And household insecticide that did extremely well in Q4, but hasn't been doing well for many years. I hope household insecticide was aided a little bit by the season, which is we had a slightly early summer in North India, etc. So, but despite that, it did well. I hope that continues to do well in the quarters to come.
Okay. And in terms of, you did announce 700 odd crore of capex in your presentation. How are you going to deploy that, and what's the overall ROI that you're expecting out of that capex investment?
So these are capex investments which are done to support growth from a multi-decade perspective. So we've set up 2 new factories, one in Bordia, one in DN. And while the first phase of the factory commissioning has happened, there are expansions in the factory which are going to be happening over the next year and a half. So the capex is towards that. One setup, they actually support many years of growth. So let's go.
Okay. And in terms of your pet care business, I believe that you are, betting big on that. What's the outlook like? I wanted to understand as to how big the market is, one thing. Plus, what's the kind of growth levers that you are observing in that particular market? And what's the outlook like from a longer term perspective? Not FY26, from 5 years down the line, what is the kind of revenue growth that you're expecting? And how much of a revenue contribution in terms of your total revenue will that business be?
So it's hard to predict numbers in the future, but I think the underlying reason why we entered the pet care business is that it's a category with a long runway of growth. Only 1 in 10 Indians own a pet. And even those who own a pet, only 4% of what they feed the pet is packaged food. The rest of it is home food. So there's obviously a lot of runway of growth in this category. It's a category that we kind of understand. So we've got an informal joint venture with Brokerage Agroweb, which is a sister company, which is going to make the product for us, and we're going to sell it. And we've created a new company called Brokerage Pet Care with a CEO who's running it. And so we think it's a large runway of growth. And as a group, we have reasonable capability to win. The category today in India of pet foods is 5,000 crores. But if you take, let's say, a country like China, it's $20 billion. So, in India, if it is $600-700 million, in China, it is 30 times the amount. So there is only a matter of time before, like in anything else, India becomes China. So I think we want to ride this long runway of growth up it.
Right, and one last question on your international business. Indonesia did see only 1% in terms of constant currency growth, but the overall MENA business is recovering. You also did mention that some of your capex will be allocated to a new factory that you want to set up in Indonesia, if I'm not wrong. What's the outlook like in terms of how recovery will take place in international business?
So I think firstly, when it comes to the Africa and Middle East and the GOM business, we kind of actually had a profit reset in that program. It was single-digit EBITDA margins. For the last 5 quarters, we've been consistently growing both absolute profits and margin. We brought the business to 15% margin. So it's a strong shape of the business. We do see that business actually kind of grow quite well, and we don't see the need for too much capex there. We adequately kind of provided for the capacities to take that growth. When it comes to Indonesia, over the last 2 years, we had a CAGR growth of around 9% on volume. So it's been 2 solid years of volume growth. We do believe that there is a lot of potential in terms of the long-term potential to grow. And typically these investments in terms of new plants come in with a bit of a 5-year, 10-year horizon to kind of support growth. We believe that it's the right time to kind of set up a new plant to kind of take care of these future growth.
All right, so that was the management of Godrej Consumer indicating what FY26 looks like, plans with respect to their pet care business as well as how international business will fare for them. All right, moving on to the Ask Profit segment of this show. We're joined by Shahina Mukaddam, independent market expert, and Kush Bora, founder of kushbora.com, joining us now. Welcome to both of you. The first question is from Shankar, who's writing in from Bengaluru. He's holding 900 shares of RCF, that is Rashtriya Chemical Fertilizer, at an average price of 133. He wants to know the outlook for the next couple of quarters. He wants to book profits once the stock goes about 25% of his acquisition price is something that he's aiming at. Kush, I'll come to you quickly on this one. Let's say 3 or 4 quarters down the line, is 25% achievable on something like an RCF?
Hi, first of all, very good morning to you, China, and all the viewers. Well, this is the Ask Profit segment of the show. I was quite interested with that line. But yeah, Ask Profit is the show, isn't it? So yeah, that's what I'm getting at. So nevertheless, as far as RCF goes, the stock's been in a bit of a consolidation. There is resistance around the 140 and the 145 zone. So I would suggest it's not a bad idea to perhaps book profit. The reason being that, if you look at the likes of Chambal Fertilizer, one stock that we've time and again had a buy call on, has been doing rather well, steady uptrend on this one. So if I were to pick something in this segment, I would actually exit RCF and look at Chambal Fertilizers, perhaps even a Coromandel, but Chambal Fertilizers is on top. So the good thing is that he's still in a profit on this one. So might as well take money off the table and switch to Chambal Fertilizers.
Got that view, Kush. The next query that we're getting is from Rahul, who's writing in from Shimla. He's holding KPIT Tech at roughly 1,141 rupees per share, holding 100 shares there. He's looking for a view on a long-term suggestion on the stock. Stock has just seen some correction after, the quarterly earnings. But, Shahina, let me come to you on this. Earnings largely look in line. They're also estimating growth going forward. How do you expect KFIN to perform, at least on the fundamentals?
On the fundamentals, I think it will do much better going forward. They recently acquired a company in Singapore, which actually enables them to expand their global reach. And while it is an expensive stock in terms of pure valuations. So I would say you can continue to hold. The results were also a bit disappointing, given the fact that it is linked to the overall market and the performance of the indexes. But at the same time, I would say you can hold with a stop loss close to about 1,100.
Okay, so that's the view with regards to where KFIN Tech stands. Also, viewers who are tuning in, you can also call us on the numbers that are flashing on your screen right now, on the lower band of the screen. All right, the next question is on Cummins India. Pratap from New Delhi is holding 1,000 odd shares, bought at 365 a piece, and wants to have, again, a long-term and fundamental view on this particular counter. Shaina, I'll again come to you on this one. What's the view like for Cummins India?
Yeah, so Cummins India, it's like a mixed bag in terms of the performance. At the same time, I think, one can continue to hold if one is looking at a medium to longer term. Basically because I think the business going forward, it looks to be better. So you can hold with a target close to about 2,900, not too much of upside, but you can hold for now.
Got that view, Shaina. We have a first caller of today. It's calling from Chennai. Aditya is on the line. Aditya, good morning. Welcome to Ask Profit. What's your query?
Yeah, good morning. So I'm holding about 1,000 shares of Vedant Fashions, Manyavar.
Okay. And are you looking for a long-term view on the stock, Aditya? Hi, Aditya. Yeah, we've actually lost him. But Shaina, actually, let me come to you first. We don't know if the caller wants a long-term view, but we've just seen the results actually come out yesterday. Not so much to write home about. Growth has been faltering for the company. How are you viewing Vedant Fashion in terms of fundamental performance going forward?
Yeah, so the numbers were a bit disappointing, both in terms of the revenue also, and in fact, EBITDA was lower. So it has been a disappointing number. At the same time, I think it is better for us to focus going forward on the export potential with the trade agreements between UK, US all coming into fore. So I would say you can hold. You can hold currently. After the stock has corrected, I think if you hold it. You can hold it with a stop loss close to about 710. If you're a very short-term investor, then you can look to exit.
So that's the view with regards to where technicals are, overall the fundamentals are concerned for Vedant Fashion. But in fact, Puneet did mention about Vedant Fashion earnings, and post the earnings, the stock did see a significant amount of tanking, and this was because the overall net profit was down by 12%. Margins also significantly reduced to 45% from that 48% mark. Cost of raw materials inched up quite significantly, and other expenses also were up by 20%, and that's kind of reflected in the stock performance since the earnings came out. All right, the next question is on Hudco. Rohit is writing in and has 1,000 odd shares bought at 280 a piece, and wants to know as to what should be the next course of action for him. Kush, on the charts, from a longish period perspective, what's the view like?
We might suggest an exit on this one. It's incidental that today on our advisory, we've released a short call on Hudco with lower targets of 210 and 206, stop loss around the 280, 220 resistance zone. I think there is some consolidation happening with a negative bias. Even on the higher side, you'll find resistances around the 230 to 45, 230 to 235 zones. So all in all, it's not auguring so well just yet. There were a couple of moves that came about, but that rally fizzled out at the 200-day moving average, and now the stock is down again on the back of fairly decent volumes. If you see yesterday and today also how things are shaping up. So at the moment, things don't seem to be going its way. So I would rather suggest an exit on Hudco.
The view coming in where technicals are concerned for Hudco. Our next caller, Ishwar, is calling in from Andhra Pradesh. Ishwar, a very good morning to you. How can we help you? Hi Ishwar, can you hear me? Okay, I think we seem to have lost him, but we do have his query. His query is on Canara Bank. He's holding 1,000 odd shares at 92 a piece. We have one more viewer who has written in and wants to know about Canara Bank. He's bought at the levels of, we don't have his level, 92. And wants to know, so both of them have bought at the levels of 92. I believe I'll take the technical view as well as fundamental view on this particular counter. Shaina, I'll come to you first. What's the view like?
In terms of valuation, Canara Bank is pretty attractive. It is just about 0.8 times price to book. So I would say, and it is one of the better performing banks. Balance sheet has, improved in terms of NIMs. They're expected to remain stable. So I would say you could hold. You could hold with a target of close to, I would say 100.
And Kush, what's the view like where technicals are concerned?
So I think from a very near-term perspective, the pressures could perhaps remain on because, some of the PSU banks have had a rally, but again, they've fizzled out. And as far as the pecking order goes in the PSU bank, in the PSU pack, there's SBI and then there's Canara Bank and then there's everyone else. So from that perspective, I think, you could continue to hold. I can understand why this 92 level has been, a level where the stock being bought by a couple of them has been the recent low. But you could see some sort of sideways consolidation. So my suggestion would be to keep a stop loss near the 89 mark. That's where the 50-day moving average support will come in. But on the way up, you could look at targets of 97 and then about 100, as even China concurred. But my suggestion would be to keep exiting as the stock rises and keep sailing the stop losses higher. You could see some time, some sideways consolidation. Hence the momentum might be missing in the likes of Canara Bank and some of the other PSU names.
Got the view, Kush. The next query actually is on stock Anupam Rasayan in the chemical space. This query is coming from Rajesh Maheshwari from Indore. He's holding roughly 125 shares at 852 rupees per share, and it's a long-term holding, but he's also wanting a short-term outlook as well. So let me come to both of you. Shaina, let me come to you first. A chemical stock has been doing decently in terms of quarterly earnings. How do you view the same?
Yeah, so the numbers, even if you saw the last quarter, were pretty good. So expecting a good set of numbers. And I think the overall sentiment for chemical stocks is better now that China is sort of, facing a lot of difficulties, and India should actually gain on that. So I would say it's a hold at current levels.
And sorry, just let me get Kush's view also. Kush, 26% year-to-date movement on the stock. Do you see any further upsides on charts?
Well, it's not a bad setup. I'll give you that. But what's happening is that from a very near-term perspective, the stocks actually just hit the overheated territories on the daily setup, and hence some profit booking cannot be ruled out. So if he's quite active, when it comes to trading, it'd not be a bad idea to book partially right now, say about 50% or so, maybe a little less, and then re-enter, close to the 890, 895 zones, as and when you see some sort of profit booking, which eventually might come in. It's had 5 weeks of gains, which is quite a healthy sign. But I would book partially and then re-enter at the 890, 895 zone. Also, this is a view if he's a very active trader. If he's a long-term investor, then he should continue to hold. On the upside, you're looking at targets of 955 and about 995 in the coming couple of months.
Okay, so that's the view with regards to where Anupam Rasayan stands. All right, our next question is from Vipul Seth, who's holding Bayer Corp Science 15 shares at an average price of 5,581. Wants to know whether he can accumulate more, sell or book loss right now. He's sitting on a loss of roughly 13,000 odd rupees right now. Shaina, he wants a fundamental view on this one. What's the view like?
I think if he's a short-term investor, he can actually switch. There are better stocks available in the sector. But otherwise, I would say the overall sentiment, as I said, for chemical stocks overall is better. And especially exports to Europe should actually pick up. So you can hold if you're a long-term investor. And maybe you can hold with a target close to about, you can hold with a target close to about 4,800.
Got the view, Shaina. We are actually getting a next caller in from Kolkata. Avi is dialing in for a stock query. Avi, good morning. Welcome to Ask Profit. What's your query?
Hi, good morning to everybody. So my query is, actually I've got 1,000 shares of Northern Capital bought at 173.37. So I want to know whether I should hold it or exit.
And do you want a long-term view on the stock, Avi?
Yes, the plan was at least 1 year, but now looking into current situation, there is so much of uncertainty.
Correct.
I'm just confused at the moment, what should a person like me do?
Fair point, Avi, because we've seen correction as well in the microfinance as well as the mid-tier banks. Shaina, let me come to you first for a fundamental view. From a buying price of 173, stock has gone up to 208 now. Do you suggest holding on to this new listing, or to avoid it, sell it for a viewer?
In terms of valuation, it's not too expensive. It's one-time price to book. At the same time, that I think it's a small cap. So I think in this current market, it is better to stick with the larger corporates. So basically, I would in fact stick to the larger banks also in this sort of a market. And even if you're looking at the MFI space, I think it's better to be with the larger players rather than, the small cap companies. So I would say a switch.
Okay, so that's the view with regards to where Northern Capital stands. Our next caller, Raju, is calling in from Andhra Pradesh. Raju, a very good morning to you. How can we help you?
Yeah, good morning. My query is regarding Anantraj.
Okay.
I own 100 shares at the price of 460.
465 or 460?
Yes, 460.
Okay. And
my query is about I want to hold this for next 3 years actually. So is it good to accumulate more or?
Okay. Okay, got your point, Raju there. Shaina, I'll quickly come to you on this one. There was a time when there was a significant momentum seen in this particular counter on the back of data centers that, it's trying to build in. What's the view like from a 3-year perspective? Should one continue to hold the counter?
It looks decent, at least for the current period, at least for you can review it after maybe 6 months, 1 year. They are done pretty well in the last quarter. And at current levels, I would say that you can hold, but do keep a stop loss. Keep a stop loss close to about 440 because, it could correct in the shorter term if you're say a 6-month investor. But for the medium to longer term, you can review after a year.
Got that, Shaina. Shaina and Kush, please stay on. We'll just take a very short break. More stock queries on the other side. Stay tuned to Ask Profit.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Welcome back to Ask Profit. We are getting another query on from a caller. Mohan is dialing it from Warangal. Mohan, good morning. Welcome to Ask Profit. What's your query?
Good morning, sir. Good morning, sir. Very good morning, sir. I want a query on Tata Motors.
And do you want a long-term view or a short-term view on Tata Motors?
Short-term view for 6 months.
For 6 months.
Is it right time to buy in this market price? And just now it is quoting now, I think,
right, 697. Correct.
596.
Yes. Since the short-term 6-month view, let me go to Kush. Kush, on the fundamentals, there is a lot to talk about. Getting impacted from US tariffs, the UK FTA is a positive. Is the chart suggesting any positive price move on Tata Motors?
So we've had a breakout yesterday where the 675 resistance zone for the last 5 to 7 trading sessions was taken out on the back of very decent volumes. But I'm afraid from a very near-term perspective, I think you have to wait for the 700, 705 zone to be taken out. There's a gap that was created around that level. It's coming to be filled in just now. Plus also you see some call conditions around the 700 mark that will act as a bit of resistance. So while the near-term trend does look positive, I would suggest just wait up for some time, let the 700 and 705 supply zone be taken out, be cleared, and then you can perhaps go and buy. Otherwise, what could happen is that you could either see some sideways consolidation or perhaps the stock dip a little for investors who've been holding it on for some time now and haven't really seen any kind of profits on this. So while the near-term structure, as I said, is turning positive, wait for the 705 mark to be taken out on a closing basis, and that's when you can consider. Even after that, from a 6-month perspective, the risk-reward ratio will be fairly favorable for targets of 755 and about 790 and 675. That resistance level will now start acting as a support and hence as a stop loss.
Okay, so that's the view with regards to where technicals are concerned for Tata Motors. Our next question is from Sai Karthik, who's writing in all the way from Dallas. He's holding 1,000 odd shares of Bajaj Healthcare at an average price of 521 and wants to know the prospects from a short to mid-term perspective. Kush, I'll come to you again. What are the charts indicating for Bajaj Healthcare?
Very interesting moves on this one, actually. The stocks run up quite a bit, then seen some profit booking and is now trying to find a base near the 510 zone. I would suggest, taking a position at Bajaj Healthcare. My only suggestion would be take a small quantity because the volumes on the way up aren't really as strong that will suggest that everything's in the clear and the stock is now ready to soar to 625, 640 odd levels. But nevertheless, there are early signs of base formation near the 505, 510 mark. So yes, you could start accumulating the stock at this level, and as I usually suggest, add more as the stock goes up. So in this case, your stop loss will be at the 510 mark. On the way up, you're looking at the first target at about 595. Once that is taken out, even a 640, 640, 645 zone will also come into play. But this is one stock that you'd want to accumulate as it goes up and not average on the way down.
Okay, so that's the view with regards to Bajaj Healthcare. Our next caller, Santosh, is calling in from Hyderabad. Santosh, a very good morning to you. I believe you have a query on IRCON. Hi Santosh, can you hear me? All right, we seem to have lost him, but we do have his query. Santosh is holding 650 odd shares of IRCON at 189 a piece. Shaina, I'll come to you on this one. What's the view like? Should he continue to hold?
I think he should switch at current levels because if you see IRCON in terms of their operational performance, it has been a bit disappointing. It is, it is a small cap and of course it's government owned PSU. But at the same time, I would say that, in terms of operational performance, it's been a bit disappointing. I would say a switch. There are better quality stocks available in the PSU space. Even something like a defense, I think as a sector would look better at current levels.
Got the view, Shaina. We have a next query on WhatsApp. Tejas Sheth is writing to us from Mumbai. He's asking for a question actually on Easy Trip. He's holding 10,000 shares at just 18 rupees per share. Kush, let me come to you on this one because we've seen all kinds of negative fundamental news on this counter, management changes, venture into unrelated businesses. And on the charts, does it suggest any kind of positive price move so that if need be, our viewer can exit the stock?
So, Puneet, I think the only positive that is seen in the price action and hence on the chart is the fact that the stock actually stopped falling. It's gone into a sideways consolidation. I think which you could take as a first positive sign for the stock to actually start gaining ground. Now, at the moment, what I could suggest is have a stop loss at the 11 mark. That's the 11 to 11.5 is the zone where the stock has taken support at multiple times. So I'm suggesting that as a strict stop loss because if things were to go south, then you could see much lower levels on this one. But for the last 2.5 months, for the most part, the stock respected the 11.5 zone. Once that is held for some more time, I think investor confidence might return and the stock might go higher. But my suggestion would be to start exiting at intermediate levels of about 14, 16, and then perhaps closer to the 18 mark. Not sure if, in the coming, weeks or months time, the stock would actually go to his buy price of 18. So my suggestion would be keep a tight stop loss at 11 and start exiting at, slightly higher levels. In that case, your loss will actually start reducing from the current level.
Okay, so that's the view with regards to where Easy Trip stands. Our next question is from Naman, who's writing in from Kolkata. His question is on his question is on InfoEdge, and he wants to understand both fundamental as well as technical view on this counter. I'm not sure if there's an X split today. Shaina, if you are aware of this, is that correct? Is there an X split for InfoEdge today?
There is a split. One sec, I'll just check. I think the split is 7th of May. Yeah. So basically, that would fall into effect. That is, old value is 10 rupees, split to 2 rupees. So that would be there. Of course, the stock is actually moving up because there are a number of positives that are coming in. So I would say this stock is a hold at current levels. There's a lot happening and one can hold at current levels.
Quick technical view on this, Kush?
Not a bad setup. It's just that, on the higher side, about 1450 odd, the stocks made, triple high kind of a formation where there is some resistance. But I think on the whole, the moves and the recovery on this one has been fairly sharp. Yes, you could continue to hold. Stop loss on this one is close to the 1330 mark.
Got a view, Kush. We have a next caller from Bengaluru. Murli is dialing in with a stock query. Murli, good morning. Welcome to Ask Profit. What's your query?
Good morning. Thank you for taking up my query. I bought Free Cement at the 10 shares at the rate of 30,545.
Okay.
Now I am incurring a loss of around 11,000 rupees.
And
There are two options. Just I want to confirm, take your advice. Whether I should add more considering the good results of Ultratech, Kambuja and ACC, or should I switch over to Abbott India, which is available at a similar price level,
Okay.
which is also equally a solid company.
Got it. Let me go to
So that they are
Shaina.
different industries. Yeah.
Got the view, Murli. Thanks so much for dialing in. Shaina, let me come to you because, the cement space prices were very, low over the last year. They've started, increasing all players. Do you suggest our viewer to stick with Shree Cement? He's currently holding 10 shares at 30,545 per share.
Yeah, I think it's better that he continues to stick to this stock for now. Basically, volumes, as you also mentioned, are improving. And I would believe as the averages realizations go up, they should do better going forward. So I would continue to hold and keep a near-term target of close to about 31,000, and then you could review it again.
Got that view, Shaina. Now, the next is a WhatsApp query from Hyderabad. Naga Kumar is writing in for a question. He holds 100 shares of Eicher Motors purchased at 5,500. He's asking a view on that stock and also asking if any negative view, if he should switch to Tata Motors. So, you answer the Tata Motors part. Let me come to Shaina, to you back because of a fundamental view on Eicher Motors. Do you suggest sticking with this counter?
As of now, Tata Motors does look like a bit better than Eicher because of, what is happening on the tariff front, and Eicher would be impacted in a bigger way. Tata Motors is a positive, as we're hearing, in terms of they're starting to again export to the US market. And so to that extent, it looks like a better shorter term view. But if you're the long term investor, you could continue to hold. You could hold with a stop loss close to about 5,000.
Okay, so that's the view with regards to where Eicher Motors stands. The next question is from Satyan. He wants a view on Supriya Life Sciences for the next 1 or 2 odd years and wants a fundamental view again. Shaina, I'll come to you. What's the view like for Supriya Life Science?
I think I'll pass this question.
Okay, Kush, then any view with regards to where charts are concerned? What's the kind of support and resistance that you're observing?
At the moment, the stock is at the 200-day moving average support, near the 640 mark, but it's really not got anything going for it in the sense that, for almost all of this calendar year, it's stuck to a broad range of about 610 on the downside and a slightly higher one, which is about 770, 780 on the upside. If he does want to make this range play, then the risk-reward ratio is fairly favorable. So with a stop loss around the 610 mark, you could consider a long position on Supriya Life Sciences. 685, 690, that's your first target. Once that is taken out, you could still stand and continue holding this for the 750, 770 zone as well. But it's a range play, and you could see the stock spending some more time in this band. So momentum might be missing, but from a range perspective, the risk reward ratio seems favorable.
Well, that's the view on something like a Supriya Life Sciences. The other question is, the other query which we have is again on WhatsApp. Ashutosh is writing in from Pune. He's purchased 30 shares of JK Tires at roughly about 300 rupees per share. He wants a view of a longer term view to, for any kind of returns. Shaina, let me come to you on this again. All tire makers, have been impacted because of high rubber prices. Do you suggest staying with this counter of JK Tires or switching to any other company in the tire space?
No, in fact, tire companies are coming out with decent numbers actually, and basically the raw material prices are going down, crude as well as natural rubber, synthetic rubber, they're the main raw materials. So, after a bit of a disappointing last quarter, numbers are expected to be better in this quarter coming forward, the March quarter. So I would say you can continue to hold JK Tires. You could hold it with a target close to about 360, and you can keep a stop loss of close to about 310.
Okay, so continue to hold is the view coming in on JK Tires. Next caller, Shiva Kumar is calling in from Bengaluru. Shiva, a very good morning to you. How can we help you?
Good morning. I would like to enter Bharti Airtel.
Okay.
Is it the right time to enter Bharti Airtel, and how is it technically poised, and what is the target you are placing it for another 2+ years?
Okay, 2+ years. Got it. But since you want a technical point of entry, I'll take this up with Kush. Kush, is this the right time to make an entry into something like a Bharti Airtel?
It is, Mahima. In fact, it's just the other day, about 2-3 days ago, that we released a long call on Bharti Airtel, on our advisory as well. The reason being that, this stock has, negated or averted, any kind of pressures that were there in the market and has continued to rally higher. We've seen, good build up on this one, in the last about, 15 odd sessions, also some profit booking, but the recovery was also rather strong on this one. A couple of technical parameters that could perhaps suggest some sideways consolidation is that the 1900 mark is proving to be a bit of a resistance, and then there is this negative RSI that is starting to develop, which could suggest that the stock could consolidate for some time. But since his view is about 2 years and longer, I think he should very well continue to hold, or in fact he could go ahead and add at the current level and even accumulate as long as the stock remains between the 1850 to 1880 zone, which it is at currently. From about a 2-year standpoint, I think 1990, 2050 are the targets that we could look at, and a positional stop on this one comes much deeper, closer to the 1775 mark. So on the whole, the stock has done well, continues to impress, and also let's not forget that Bharti comes with a certain degree of margin of safety. So with the kind of volatility that we're seeing closer to home and across the globe, I think Bharti makes a good buy at this level.
Got the view. Question on fundamentals as well, expecting a decent results from Bharti Airtel in Q4. The next query is again a WhatsApp query from Purna Chandra Rao is writing to us. He wants a view on Birlasoft, which is the IT major. Shaina, let me come to you on this. He's already holding roughly about 1,000 shares, bought at 450 rupees. He bought this 3 years ago. So what's your view currently on this stock? Stock generally trades at a lower price to earning multiple compared to its other mid-cap peers. Do you have a positive view on Birlasoft?
Yeah, actually, the stock had corrected a lot after the very disappointing Q3 numbers, where we had seen both the revenues and as well as the profits coming off. But I think, overall, the sentiment is improving and they are moving towards the $1 billion revenue. So I would say it's a hold at current levels.
Okay, so hold is the view coming in on Birlasoft. All right, our next question is from Anish, who's writing in from Hyderabad. I'm not sure, Shahina, if you have a coverage on this one because it's a recently listed company, Aether Energy. He's got 46 odd shares and got the IPO allotment and wants a view on this particular counter. Should he continue to hold?
I would say it's a risky bet because there's a lot of competition coming in this segment and, they are making losses. So I would say, take any upside that you can get and switch.
Got the view, Shaina. We have another query from Bangalore coming in. Sunita Rai is writing to us. Best level to enter Bank of Maharashtra as well as Bank of Baroda. Those are the two queries. Shaina, let me come to you on this. Bank of Baroda results were a little iffy to say the least. NII fall in this particular quarter. Do you have a view? We've heard your view on Canara Bank. Any of the views on Bank of Maharashtra or on Bank of Baroda?
Bank of Maharashtra looks decent at current levels, given the fact that valuations are quite decent, attractive, and even the numbers I expect are quite good. So Bank of Maharashtra balance sheet also improved substantially. If you see the quality of the net NPAs, they have absolutely improved. So to that extent, Bank of Maharashtra looks like a better bet. And Bank of Baroda, of course, is the larger one. And for the longer term investor, you can look to add at lower levels, but at current levels, I would say it's an avoid.
Okay, so that's the view with regards to where both of these banking counters stand. Shaina and Kush, it's time for the rapid fire segment. You know the drill. Keep answers as short as possible and we'll try to throw as many questions as possible at you. The first question is on KRN Heat, a newly listed company. Shaina, what's the view like? The person wants to know, should he wait to enter or should he enter at the current levels?
He should wait to enter. Wait.
Got the view, Shaina. The next query is from Anil from Bangalore, asking a view on Vodafone Idea. Kush, does the chart suggest any positive momentum on Vodafone Idea?
Avoid.
Okay, the next question is from Tamil Selvan, who's writing in from France. He wants to know on Chola Mandalam Finance, what's the view like? It's fairly a short-term view. Kush, what's the view like on the charts?
You could continue to hold or even consider adding more stop loss near the 510 mark, and on the upside you're looking at 1620 and 1660 as target.
Well, next query is from Prakash from Bangalore, asking a view on Apar Industries, priced 7,200, holding 150 shares. Shaina, do you suggest holding the stock going forward for Prakash?
You can hold with a stop loss of 4,300.
Okay, the next...
6,000. Yeah, you can hold with a stop loss of close to about 6,000. Yeah.
Okay. The next query is on SpiceJet. The person is holding 45 odd shares. Should he continue to hold? Shaina, your view?
I would say it's a switch to Interglobe.
Well, next question is, specifically which we are getting in is on Paisalo Digital, not a stock that we speak about a lot. Kosh, anything on the charts suggesting any kind of view on Paisalo?
Some consolidation, but not enough to suggest a very strong buy yet.
Okay, Piyush Raj wants a view on Coal India. Shahina, your view from a longer term perspective?
I would say switch.
Next question is on IRFC. Kush, anything on the charts suggesting a buy on IRFC?
No, not yet. And the stock's seen some pressure. So once it crosses the 127 mark, perhaps then, not at the moment.
Well, Kush, Shaina, thank you so much for joining in, giving us a whole host of views on both these stocks as well. But we have a management right now as well. And, Mahima, before we go, Blue Star came out with its quarterly earnings yesterday. What were some of the key highlights?
Right. So in terms of the numbers, earnings did beat estimates. April has been soft for them, but overall demand is expected to rise in May and June. Numbers were something that did beat estimates. In terms of the overall revenue, it was up 20 odd %. The EBITDA was also up 15 odd %, and in terms of margins, they stood at 7 odd % and net profit was up 21 odd %. In terms of the segment revenue, electromagnetic projects did perform well, around 30% growth year on year, and the overall unitary product segment also grew by 15% year on year. And we are joined by Veer S. Advani, Chairman and MD at Blue Star, who is joining us now with more details as to what the future of the company holds and how quarter four panned out. Mr. Advani, before I move on to the details as to how Q4 has panned out, your view as to how the overall earnings were in terms of FY25 as well as Q4. Was it up to what you expected, or there was something better on the cards?
So thank you. Thank you so much for having me. I want to say that we are extremely happy with our results for the year. We crossed 12,000 crores of total income. We were able to grow our EBITDA by 32% to 876 crores. Actually, the EBITDA margin improved from 6.9% to 7.3% on a full year basis. And the carry forward order book is also at an all-time high. We grew that by 10% to over 6,000 crores. So most of our financial objectives have been met. Of course, Q4, we could have hoped for a little better. I think that, we did well overall. Revenue grew 21%, EBITDA grew 15%. So slight erosion in EBITDA margin from 7.3 to 7%. But we're not concerned about that. That's more to do with the mix of business. You would have seen in the standalone Q4 that our segment one electromechanical projects has grown by about 30%, much faster than our unitary products business has. So it's really a mix of business issue rather than it being any structural change. So very good overall. Of course, March was a good month. Again, there was a lot of buying of room air conditioners by the channel in anticipation of some shortages in compressors. So that did help Q4. Billing, you did open by saying that April has been a soft month for the industry. We know that there's been rains all over the country, so not the best start to the new year, but we continue to be optimistic.
All right, Mr. Advani, in everything you said, I'll go one by one in terms of each segment that you talked about, that is your UCP as well as electromechanical projects. For UCP, UCM, the margins were overall slightly lower than what the street was expecting. I want to understand, because overall in that particular segment, margins have been under pressure. So I want to understand as to what is the next growth prospect there? Is there a scope of improvement going forward? And if yes, what are the levers?
Sure. So, segment 2 for us is our unitary products business. So their EBIT margin was actually quite good. For the full year, it was 8.4%. For the standalone quarter, again, it was 8.4%. Full year improvement was 7.8 to 8.4. So we've done better than last year. There has been some economies of scale and leverage coming on account of the higher volume. Overall volume, you would have seen, grew by about 22%. So it was reasonably good. I think that you do know that this segment has two businesses in it. It has our room air conditioner business and it has our refrigeration business. So actually, for the last year, the refrigeration business has not done as well as we had hoped. There were regulatory challenges in that business. There was also some soft demand from FMCG, ice cream, etc. So we would have wanted better outcomes from our refrigeration business. Had the refrigeration business grown at the rate we expected, you would have probably seen segment 2 revenue growing by about 5% more. From 22%, we would have probably shown about 27%. And EBIT margin would have been higher by about 0.5%. So we'd have been closer to 9%. So we're quite happy with the margin profile. Going into the new year, of course, whenever it's a soft summer, you sometimes see pressure there. The only difference in the new year now is that while there is inventory in the channel, naturally, there isn't that much inventory with manufacturers, because unlike in the past, we're all manufacturing in India, so we're able to control our production quite efficiently.
Right. So is that the same case for your electromechanical projects as well? Because it's been a strong quarter for that segment, but overall margins are still slightly under pressure. So what do you reckon? Is there a growth prospect there, or margins will continue to remain at the same levels that they are right now?
So we closed the year at 8.2% margin in for segment 1. Q4 was 7.6%. I think that our outlook for segment 1, so volume growth has been strong, order booking has been strong. Even as we go into the new year, we're quite happy with order inflow. Government spending is back. There's been very strong spending by the manufacturing sector, by the data center sector. So these look good. Of course, with this India-Pakistan issue right now, there may be some cooling off on some private capex, but we still are optimistic for the full year. So I think outlook for that business is good. From a margin profile point of view, I don't think there's going to be margin expansion there. I think we're happy with the margin levels that we're able to get right now.
Mr. Advani, good morning, and thank you so much for joining in, sir. It's Puneet this side. Just one question I had on inventory. Specifically for you, we were at multi-year lows in the same time last year. How are the inventory levels now? I'm sure they are above the current level because we've seen steady increase over the last 3 to 4 quarters. How are the inventory levels as of now for the industry and for you, if you can quantify it?
Yeah, so inventory is important. So you know that the channel bought in advance in March in anticipation of compressor shortages. So there is a heavy amount of inventory in the channel. We estimate at an industry level, there's about 2 million units of additional inventory in the field than there should be. So that inventory level does need to come down. We're still hopeful that, IMD is still forecasting a hot summer. So even though we've had a washed out April and a slow start in May, we're still optimistic that the rest of the summer should be okay. So with that, we will see tertiary sales picking up. We'll see channel inventories coming under control. As we said, as I had mentioned, because we are all locally manufacturing, I don't see an inventory pile up of finished goods with the manufacturers. We may be holding raw materials and components, but that's actually fine because very frankly, even if it is not a very hot summer, given the demand, the latent demand for the category of room air conditioners, we will still expect the industry to grow by 15% over the year. If it's a hot summer, then we do better than that 15%. And that's what happened last summer as well. So I think inventory levels are well within manageable levels to do that 15 to +% growth for the year.
All right, so that's the way with regards to Blue Star and how Q4 and FY25 fared and what FY26 holds. Mr. Advani, thank you so much for joining us and giving us all those insights, and all the best for FY26.
Thank you. Thank you.
All right, with that, it's a complete wrap on this edition of Ask Profit, but stay tuned. Know your company on the other side, so stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Hello and welcome. You're watching KYC, and today we're going to look at Alembic Pharma. They've come out with numbers for Q4, but outside of that, doesn't look like a very enthusiastic set, and it's a stock which hasn't given returns to investors, and therefore if you're an investor, becomes extremely crucial for you to understand what to do and what the outlook also suggests, and therefore we will break this down on KYC and get a management interview. So four factors that I want to know with regard to the company. I want to first start off with US tariffs. US tariff around 30% odd with regard to the top line of the company comes from the United States, and I have Varsha Chandani joining me as well. So just quickly introducing her. But so US tariffs, that's going to impact the numbers for Alembic Pharma for sure if that were to come through. There's also a higher quantum of US FDA inspections which are going to come along. So both of those are big risks, if at all we can call it that. And we will try to analyze whether those risks are real or not, especially with regard to Alembic Pharma. Now the India pharma market outlook, for Alembic in particular, the numbers have not been good, and we'll talk about that. And therefore, what's the outlook like from the domestic side of things? One is there is headwinds on international, but even on domestic, the numbers don't seem too good. The third piece is with regard to margins. Now, margins have softened sharply from nearly 30% in FY21. They are down to 15%, and therefore the question will be, can they recover? And we'll try to answer that as well, because we're not seeing that recovery as of now. And last off, just with regard to outlook on pricing, both US as well, more US than domestic, but pricing will hold the key or one of the factors as to whether the margins will actually recover or not. But let's not delay this further. Let's talk about Alembic right off the bat. I'm going to start off with what the company does. It does two things. One is it looks at formulations, and then it looks at APIs, which is active pharmaceutical ingredients. Active pharmaceutical ingredients, as Varsha never stops reminding me, is something which allows every pharma company, every manufacturer of medicine, with the key component of that medicine, with the key repair, right? So the key component of repair of a crocin for a headache will be its API. So just to kind of dumb it down for people like me, Varsha gives us this example. Now, the company has 3 R&D facilities and 5 manufacturing facilities that it operates out of. Now, let's look at how the company has evolved in terms of segments. This is how the growth for the India business revenue has been. It's just gone up from 1930 crore to 2,340 odd crore. So really no growth, at least on the Indian side of things. They've recorded an 8% growth even for Q4 with regard to India, and it's the 20th in the India pharmaceutical market. It holds a 1.5% market share. Now, in terms of the market share increase, there's plenty of bandwidth available, right? But can they actually do it? Well, it's not visible, at least on the numbers as of now, and that's what you need to know as one of the key risks. Now, this is with regard to how the US business is evolving. So if India is not doing well, can US do well? But that also doesn't seem to be the case, at least with regard to the numbers that you're seeing on your screen. And this is one of those reasons as to why the company is not also giving returns where investors are concerned. But Varsha, why don't you talk to us about products? Because that will give us a flavor as to whether the future outlook looks better or not.
Yeah, so Harsh, starting with US business. Now, for this quarter, the US business grew 20%, which is actually good. Considering the history that a company has. So 4 products were launched in Q4 and taking to total of 163 products which have been commercialized. And they have 15 products which are under pipeline and which is expected to come in FY26. So this is the key thing that one should watch.
But last year as well, Varsha, for context, they launched 14 products.
Yes, and
so
I think
this year it's another 15.
It's another 15 products.
So again, the question will be, can growth kick in?
So now, as per the con call, so they are expecting, double-digit growth when it comes to every segment of theirs. Okay. Your India business or, your API and your US business as well. Now, we need to wait and watch whether management will walk the talk or not.
Sure.
And, their ongoing capacity expansion in oral solids will meet rising demand when it comes to, US and ex-US market. Now, coming to their animal health business. Now, it's a very small part of business, but it has grown from 232 crores to 430 crores. And they operate in livestock, poultry and companion animal segments. And the 3-year CAGR growth in this animal segment is 24%. Now, the point is you're seeing this double-digit growth because it's a very small segment for them and a new segment for them. Let's talk about their API business. Now, we all know that there's been pricing pressure when it comes to the API business, and company is no exception there. And that's why you're seeing kind of degrowth when it comes to API business. But in Q4, they reported almost 4% growth, which was led by increase in volume. So please note that there has been pricing issues, and pricing issues are actually going on, and that's the reason we are seeing some little cool off when it comes to API business. But yeah, there was a volume growth.
And they filed 5 products in Q4 FY25, and the cumulative filings takes to almost 140. And their continued focus is on cost efficiencies to remain competitive, and capacity expansion projects are under process when it comes to API business. So overall, these are the key segments where company performs, and the main highlighting segment over here would be the US business, which actually grew 20%, and India business, where the growth has been tampered of like 8 to 10%, and this should go beyond 10% when it comes to India business.
Yeah, sure. So that's how we look at the businesses. Now, to give you perspective again, and very broad level perspective, 70% of the business comes from US and India. Am I right, Varsha? And if I were to break up the business as a whole on a product basis, formulations is around 80% and API is just about 20%. So that's the broad breakup on how the business is. But let's go across, look at our parameters and look at how the numbers are stacking up. We've seen individual businesses and how those numbers are looking. Now let's look at it from a broader perspective. Income statement, balance sheet, return ratios, cash flow. That's how our rating parameters as always stack up. Shareholding, street cred, street coverage and valuation. So that's all our 8 rating parameters as you would call it. Now let's first start off with the income statement, and I'll take it across to Varsha who will handle it.
Yes, thanks for that. And now, so if you look at the income statement, there you go. So now the growth has not been that good for the company. Now there are key reasons why company had faced challenges. So one is the challenges in the oral and respiratory baskets were due to higher base in previous years, and which had actually impacted the overall growth for the company. And there were market challenges when it comes to India business, and that's the reason why it is growing only 8 to 10% due to subdued performance in certain therapeutic segments, which has actually impacted the overall growth, and that's the reason you're not seeing that kind of good growth when it comes to overall financial statements. The US business remained challenging due to competitive intensity, and that has been reflecting in the in the numbers. And of course the impact of pricing erosion on certain products and competitive landscape have affected profitability, and that's the reason there was a time when company used to enjoy 18 to 20% of margin, but that has been tapered off, and that has come to 15%, which company expects to go to increase the margin, but they're going to take time when it comes to 20% of margin. Now API market was actually experiencing volume growth, but prices were still falling, and that's the reason the end product prices have gone down, and that has affected the sales for the company. So overall, Harsh, I would say because of the pressure in APIs and because of the pressure in India business and US business, we are not seeing that strong financials that was expected.
Fair point, and I want to quickly pull out the margin graph as well. It's an interesting one because, Varsha, what we've seen is from FY18 to FY21, margins have gone up, and margins were always above 20%.
Exactly, yeah.
Thereafter, after margins have crashed, they found it very difficult to recover. So they've recovered from the FY23 level in FY24. But thereafter, they've really struggled to improve it any further.
That's because of the pressure, pricing pressure, product pressure, and US pricing erosion that has affected these kind of margins.
Correct. So all of those factors impacting, and we did highlight in what we should know about this company, whether pricing is actually improving and whether margins are actually recovering. And we'll ask, or rather we have asked the management this question. So you will get an answer and some flavor with regard to margins. But this is a key piece to look out for where Alembic Pharma is concerned. One is the top line growth and the other is margins. If either or both of these recover, you could well see a very strong performance on bottom line as a result of that, and warranted the margins to go up because they have traditionally been above the 20% mark. So if you look at that number, traditionally been above 20%. So no reason why it shouldn't go back up. Whether it can or not is really the question. Let's look at the balance sheet now, and nothing much to talk about here. Borrowing number is roughly 1250 odd crore. They've done some bit of capex this year, which should kickstart in terms of contributing to numbers from next year onwards. The capital is fairly strong compared to the debt. It's around a 5,500 crore in terms of the equity shareholders funds, and in terms of the market cap as well, 17,000 crores. So a thumbs up on that count. Decent amount of cash on the balance sheet as well. Varsha, cash flow.
Yes, so now look at these numbers. In FY24, they had a cash flow from operation of 803 crore. But in FY25, it's only 88 crore. And the net cash flow, if you see, it's a negative when it comes to FY25. Now, let's see the reasons why sudden, drastic change when it comes to 24 versus 25. One of the reasons is they have been building inventories as they've scheduled multiple launches. And that's the reason. So, even US inventories are also high, and they have to keep backup APIs. That API is the main salt. So they have to keep a backup APIs and other products, and that's the reason you're seeing higher inventory, which has actually impacted cash flow, because your cash is stuck in inventories, number one. And they also build up inventories on the anticipation of the good launches, which are actually expected to come in few months. And having said that, management is expecting this inventory to taper off over the few quarters. The second highlighting reason why you're seeing only 88 crores of cash and net cash flow as a negative, because of the receivables. So if you see, for a long time the receivable days have been around 70 to 80 days, but now this time it has gone up. Now because there were some new launches where the collection days are little higher, and that's the reason your cash is stuck in receivable days. But they are expecting this to normalize and go back to their normal level, which is about 70 days. Now these are the main two reasons, Harsh. Your cash is actually stuck in inventories and receivables, which has impacted your cash flow, but management is expecting this would taper off in near future.
Interesting. Okay, so that's with regard to cash flow. I would want to see that cash flow number for FY26. We're giving this a neutral, hoping that that cash flow number for FY26 shows some bit of improvement, if not too much. Let's look at return ratios, and both, as expected, return on capital as well as return on equity are showing a downward trend, and that is because of that margin erosion that we've seen, which has been sharp. You see how your return on capital is now come off from that 20+% to just about 11%. Can it rebound will be the question. For the moment, you're not seeing any visible rebound. Varsha.
Yes, so I would actually talk about, Harsh, over here, shareholding pattern. Yes. So when it comes to promoter holding, almost 70%, and they've maintained that, so skin in the game, good thing. And FIIs, kind of a decent stake when it comes to FIIs, but DIIs, it's almost 16.5%, and public has almost 10%. So overall, this is a good thing, good skin in the game, good FIIs and DIIs exposure. So overall, a good rating when it comes to shareholding pattern.
Okay, excellent. Let's look at street cred, therefore. It's not done too well on exchanges, at least. Over the last year or so, the returns have been very muted. It's been a tough kind of an environment for it. In fact, the last 5-year absolute returns is just about double digits. So not even a 20% return that we've seen, something like a mid-teens return over the last 5 years. What you want to see is better returns and that turnaround, but we're not seeing that. But what could well happen as a result of this is, because the stock hasn't done too much for a very long period of time, if you could start to see a turnaround, the stock could move up. So that is the possible positive, but for the moment, it's all looking grey. So therefore, we'll give this a thumbs down. Street coverage?
Yes, so there are 7 buys, 5 hold and 1 sell when it comes to Alembic Pharma, but the return potential, if you see, it's about 10%. So I won't say that great, but I mean, buy holding of 7 and sell holding of only 1, I think that's kind of good thing, not as bad. But yeah, upside, I would say only 10%. Maybe, street is expecting that companies should post a good results when it comes to financials that we have been seeing.
Yeah, and there could well be that upside if that were to play out. But Varsha, I think you're better placed even to cover valuation. So why don't you do that?
So exactly. So if you see now, Alembic Pharma is trading at, if you see the trailing 12 months P, trading at 30x, but Oro Pharma, Zydus Life Sciences are trading much below, like almost 20x. Sun Pharma I can understand because the company is going into specialty segment, and
Correct.
that's the reason, one of the reasons why market is giving a premium, and of course Sun Pharma kind of management that a company has. So I would say Alembic Pharma kind of little overvalued compared to Oro, Zydus and Sun Pharma trading at 36x. So yeah, valuation kind of.
So we've given it a neutral. Therefore, let's quickly look at all the parameters, sum it all up. There you go. That's how it stacks up. Not a very impressive performance per se. A couple of green shoots, and if you're looking at even the next, yeah, absolutely. So nothing much to be too enthused about. It's just about a 4.5 on 8 on our KYC rating. Now, in terms of outlook, Varsha, if you can quickly sum that up for us, what's the outlook like so that we can go to management thereafter and hear it from them?
Yes, so basically they are developing specialty drug pipeline for India, and they are also exploring opportunities when it comes to injectables, which is a new area for them. And they are expanding when it comes to product portfolio in US, and also strengthening presence when it comes to Canada, Latin and Middle East. And they are expecting double-digit growth when it comes to your India business, US business and also API. But overall, US business is one thing that you need to watch out, and of course company going into injectables, and they're coming up with peptide block also, that is the semaglutide or GLP products or the diabetes products, which are the key things to watch, Harsh.
Okay, so all of that on the roadmap, but let's hear it straight from the management. We spoke with the managing director of Alembic Pharma, Mr. Shaunak Amin, both Varsha and myself, and here's what he had to say regarding growth prospects going forward. Listening to the first piece of that conversation. In fact, the first piece of that conversation was more with regard to how tariffs and US FDA could impact the company. Listening.
Yeah, so I think maybe I'll just take a few extra minutes to go through a couple of the things that have happened in the US, which is ex-business related totally. So obviously one is, with the tariff side of things, I think at this point, we don't have a clear directional view on this. We're talking to our US partners all the time, and they haven't given us any indication in terms of whether they'd like to pick up some extra stocks at this point in view of, any impending tariffs that might be put in. I think we're quite confident that both the governments are talking to each other, and it seems to be, progressing, but we don't have a directional view on this today. I mean, to the fact that whatever Q4 growth we saw in the US, there's no element of pipeline stocking or or customers picking up extra stocks in lieu of any impending tariffs that might be coming in. So that's on the tariff front. The second bit, what you're talking about, is on the executive order that Donald Trump has signed in terms of looking at self-reliance from a US drug supply chain per se. So when you look at that, I think it's more you got to look at it in a total context of pharmaceuticals, where generic is a small component from a value point of view, though from a volume point of view, very large component. The feeling we have and the sense we get is, I think this order has been targeted, or it's been put forward from more of a global perspective, which includes innovators as well as generics. But the sense we are getting is that directionally it seems to be tilting towards the innovators rather than the generics at this point in time. But like I said, we have no firm view on this. The third bit, in terms of onshoring manufacturing in the US, which is a part of this order, I think at this point in time it's too early to speculate on onshoring the US. Yes, it's a universal truth that to manufacture anything in the US, let alone pharmaceuticals, is significantly more expensive than it is in a country like India. So that obviously is a reality of life, not just for pharma, but for all sectors per se. So keeping these things in mind, at this point in time, we don't have a directional view on this that I can come out and say, look, we're working towards something, or we see either direction. We're quite neutral on this. Now, coming to the FDA inspection front, so, a benchmark, a landmark, a part of what Alembic has always done is we've been very high on our FDA and regulatory compliances. our track record, I think, is one of the best in the industry per se. And that's been a strategic initiative since the last 10 years that we've been working on. So in view of the higher FD inspections coming in, we actually welcome this move, and we're quite happy and we're quite ready to face any inspection at any time. So we view that as a positive for the sector.
And Mr. Amin, I want to also understand how pricing is evolving at this point. That's been one pressure point, especially US pricing. How has it shaped up in Q4, and what's the FY26 outlook that you can give us?
Yeah, so I think how it's shaping up is it's become quite stable from where we were a year and a half ago. So we see this as a stable environment per se at this point in time. Going forward, we hope that we expect the pricings to stay the same. We don't see any further erosion coming in at this point. Does it go up or not? I think it's hard to say. We have some new launches lined up this year. So I think hopefully a combination of one-time purchases plus some new launches plus some stable supply of running products should help us, maybe best case scenario, help us move the margin a few notches. But like I said, it's like I said, we don't give a forward guidance on these things.
Right. Hi, Mr. Amin, Varsha this side. Just wanted to understand basic financials. You know, the operating margin, which is at 15%, this has been in the range of 13 to 15% in the last 3 years. So what is the scope of expansion when it comes to your margins in FY26? Can we see maybe 50 basis point or 100 basis point increase when it comes to margin, because you're coming up with your peptide plant as well, which will help in the expansion of products, and of course you talked about the product mix as well.
Yeah, so I think on the margin front, if I recollect clearly the last time I was here, I think we were quite clear that we want to move to a 15 kind of a scenario, and we're quite comfortable with 15 at this point in time. In terms of moving up, yes, we have an in-house, obviously a cost optimization project running that's been running for the last year and a half. We expect this to continue. Directionally, we're trying to work towards a higher margin profile. But at this point, I think we're quite comfortable with 15 also.
What is it, Mr. Amin, that it's going to take to get that margin more towards 20? What's the headwind that you're facing, and what change will likely drive that? So I'm just trying to understand.
Yeah, so I mean, if I go into historically when we were at this 20% plus margin for a fairly long period, it was a combination of two things. I think the plants were heavily optimized at that point. We only had one US FDA formulation facility and a couple of API facilities which were running at full capacity at that point in time. So our ability to, get a product out very efficiently was high. We expect that to happen over time as the new products do kick in and the new plants do start getting filled up. So that's one part of it. The second part of this, obviously, launches. Right launches can really change your profile for a period. So let's see. We have nothing in the horizon that I can confirm or talk about today, but I think we have a robust pipeline of products. So we expect something to happen maybe in the next year and a half.
Mr. Amin, on the US segment, which grew 20%, you had a very strong growth when it comes to US. Now, I'm assuming this is on the back of the new launches that you have done. But quarter on quarter, I believe there's a dip, despite you did almost 4 product launches this quarter. So what's the outlook when it comes to US business in FY26 and number of launches expected there?
Yeah, so I think quarter to quarter is a wrong basis to say whether it's moving up or down, because it's just hard to calibrate it because of new launches or because of how product moves or how the supply chain moves. So that's at this point not. I think directionally we are okay. It will keep moving in this direction. I would not want to look at it over a single quarter. I think you look at a couple of quarter trend. I think that should be the more indicative process.
See, I mean, this mid-teens growth when it comes to US business in FY26, because 20% you did this quarter.
Like I said, this quarter was a mix of stable volumes plus a few launches. We don't give a forward guidance, but I would say you can make a trend over the last 4 quarters, and I would say we're quite comfortable to maintain that directional movement.
And Mr. Amin, in terms of top line growth, you've guided for mid-teens there too. Now, and in terms of domestic as well, no substantial pickup that we are seeing. We're seeing a 10% kind of growth. What will be that lever which will catapult the growth on a slightly higher trajectory, both when it comes to the India business as well as the US business?
Yeah, so obviously I think on the US side, new launches plus optimization, I think we expect that to continue. On the India side, I think it's more about execution and operational efficiencies that's going to drive it. We made a large investment, a technology backbone investment in the last year and a half, and we got a big data analytics package put on top of that to help us really get out the efficiencies. And as you're aware, India is an execution challenge for any segment, irrespective of the category. So we expect a lot more data to help us, dig out these efficiencies and really help us, add to our top line growth in the India business, even if the market is going to be quite, sober in the coming year.
Okay, so that's of course the conversation with regard to Alembic Pharma, and we've tried to break it down the best we can. Of course, investors, hopefully all of you found this extremely helpful. But with that, we're out of time. From Varsha, myself, all of us who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
That's huge. That is a biggie. It's on.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Benchmarks trade in a tight range amid the border tensions. Nifty and Sensex are largely flat. Broader markets, though, outperform frontliners. Up move continues for Tata Motors. Share jumps as much as 9% in 2 days, topping rupees 700 mark as India and UK enter into a free trade agreement, which will reduce tariffs and may make vehicles more affordable. Then we have earnings candidate Niva Bupa signing in trade as company's Q4 net loss narrows, accompanied by double-digit rise gross premium. Stock is up more than 10%. Q4 is expected to be muted for something like an Asian Paints with modest growth, while rising gold prices may boost Titan's revenue and profit, driven by strong jewelry sales and high double-digit growth forecasts. An all-party meet on Operation Sindur is underway. Defence Minister Rajnath Singh is briefing all political parties on India's strike on terrorist bases in Pakistan and POJK. Hello and welcome to NDTV Profit. You're watching Markets at 12. My name is Niva Bupa, and let's just take a quick look at how markets are faring. You have the Nifty 50 trading fairly flat, but with a negative bias. If you look at the advance decline ratio of the market on the Nifty, you have 33 stocks declining while 17 are advancing. In terms of some of the counters that are dragging on the Nifty, you have Eternal or a Zomato down about 3% in trade, followed by a Tata Consumers seeing cuts of almost 3% as well. You have some weakness coming in from a Maruti Suzuki, a Cipla, and ONGC as well, all down over 1.5%. On the gaining side, however, you have Tata Motors that is in focus yet again, up over 2% in trade today. It's also followed by an HCL Tech up almost 2%, and even Titan showing some strength, and this is on the back of a good Q4 expected for the counter. You also have Adani Ports, Tech Mahindra, and Trent trading above 1%. In terms of how the sectoral indices are performing, you have the Nifty Media, which is the top sectoral gainer of today. It's up 1.8%. Some of the counters that are leading this trend is a Z Entertainment, which is up almost 4% in trade today, followed by a Network 18 and a Nazara Tech as well, seeing gains of 1 to 3%. You also have Nifty IT, which is showing a strong show today, up 0.7%, followed by the Nifty Banking Index, which is up almost 0.2%. Something that's not doing so well and continues to drag is a Nifty Healthcare Index and a Nifty Pharma Index as well. The Nifty Pharma down about 0.7% right now. Something that's not doing so well, you have 16 constituents of the Nifty Pharma currently trading in the red. Cipla, Divi's Laboratories, Aurobindo Pharma are some of the top losers on the Nifty Pharma Index. You also have some weakness in the Nifty Metal, Auto and Realty pack. Next, moving on to the broader markets, they are outperforming, and it's actually the small cap 250 that is outperforming up over 1%, while the Nifty mid cap is trading 0.4%. But joining us on the phone line is Parag Thakkar, Head Fund Manager at Fort Capital. Welcome to the show, Parag. I wanted to ask you up first, how should an investor, kind of look and what his or her strategy should be in markets currently, given that domestic tensions with neighbors are high and there's a lot of global uncertainty that still creeps in?
Thanks a lot for having me on the show. Am I audible?
Yes, you are.
Yeah. So basically, after this recent rally in the Nifty, and of course, as you rightly pointed out, the tensions around at the border and on the global level of trade tariffs and all, I would say that you have to be bottom up, stock specific and sector specific. That should be the strategy going ahead, because one big rally has already happened.
Got it.
And market is showing huge resilience to all the negative news, so one cannot be very negative also on the markets.
Got it. So right now, are you more inclined to the large cap space, or do counters in the small and mid cap space look attractive as well?
So basically, I'm market cap agnostic right now after this recent rally, which is caused by FII and domestic institutions buying in last 2 months in large caps. Till 2 months ago, definitely large caps were better choice because they were offering value due to FII selling. But now that in February, mid caps and small caps crashed, and after that, there's no big follow-up buying which has happened in mid caps and small caps. I would like to be sector and, as I said, stock specific. For example, with a disclaimer, I'm saying that I'm overweight on cement in the portfolio, and I continue to like cement stocks significantly because of the pricing discipline which has come, and some of the companies which might reduce debt also in this cycle. So I would be very positive on. So basically, in mid cap and small cap space also, particularly cement is a sector which I like.
Okay, I'll come to the cement space because that's something I want to talk to you as well. But I want to highlight the textile space that is buzzing in trade today as well as yesterday. Pull up something like a KPR Mills or even Arvind Fashions, Welspun Living, Trident. They all saw strong moves in trade yesterday, and KPR Mill up over 7% today. And this is all on the back of the potential opportunity that the India-UK FTA opens up for duty-free textile exports. Now, wide range of Indian products will receive duty-free entry in the UK. The FTA is expected to boost exports in the labor-intensive sectors as well. Parag, how do you, do you think there's a play here in the textile space?
So we have a huge opportunity in textile industry in terms of both in US and Europe. Currently, our home textiles are getting more exported more to US, but of course, there is an opportunity for companies like KPR Mills, as you rightly pointed out, which is a high quality company. Once this UK FTA also is signed, and so because it will attract lesser duty in UK, and so it will open up more opportunities for them. And it is already a very recent company with about 20% ROC history from last many years. So I would say that, but of course, valuations have now become a little bit I would say expensive. So, so that is only the problem. And you know, all these treaties and all will take some time to get implemented. Before that, we'll get another opportunity to buy. So I would say that I'll not chase the momentum at this point of time, but the opportunity is large.
You said valuations are slightly expensive. Are there any current picks that you have in the textile space where the risk reward stands favorable on the reward side despite maybe valuations being slightly higher than the historical average?
No, so some of the names which you highlighted are good, no doubt about it. Whether it is KPR Mill kind of garment manufacturers, Gokul Das kind of garment manufacturers, or home textiles, all these are good names. But as I said, we don't chase the momentum, and sometimes market runs on narratives, and we don't chase the narratives. As a principle, we don't chase narratives.
Now I want to talk about the cement space, and we've seen prices improve. We actually had an MK note come out today which says resumed the coverage on the cement space, and they do expect multiple tailwinds in favor of the space. Parag, we've seen muted pricing. You've seen improvements. Do you expect the kind of marginal improvements that we're seeing every month to continue, or can we expect like a significant bump up in prices?
So basically, see, as I told you, after there was a big consolidation in the sector, there was the expectation that price hikes will be happening. It has happened in East in January, February, March, as reflected in the results of Eastern companies. Somehow, some price hikes happened in North also. But I think after 1st April, what we have seen is there has been a decent improvement in the prices in South. And this was a region which was laggard from last 5-6 years actually because of oversupply. And now that the price hikes are happening, the very good genuine business companies like Remco, and with a disclaimer that I own Remco and India Cement, which are South cement companies in our portfolio, and it has been bought from long-term perspective. So, so I will put a disclaimer there. It is not a trading buy, but I would say that these companies will benefit from increased EBITDA because of higher price realization. And as I keep saying, that good companies always try to do good things during bad times. So when the times were bad, I think the companies like Remco have started reducing debt by selling their non-core assets also. And on one hand, this pricing benefit will give them tailwind to further reduce debt, and they are increasing capacity at the lowest cost per ton, which is $35 per ton. They are adding capacity by 25% to 30 million tons. So I would say that all this combined in a long-term 2 to 3 year view, these companies look like minimum 50 to 60% you can get in this kind of companies.
Got it. Parag, I wanted to ask you, we saw, since late 2023, around 64 million tons per annum of capacity being acquired. Are there any trends that, maybe the pace of consolidation in the sector will now slow down because, the kind of likely candidates, there are very few in the space?
Absolutely. So the very weak players got bought out first.
Yeah.
And then, of course, we saw some of the good players like Orient Cement also getting acquired. Ambuja Cement in its recent call had put emphasis that we are going to grow organically more now. So I would say that you can say that 1 or 2 acquisitions can still happen, but more or less it is done. And hence the pricing scenario is improving. And plus, of course, the government spending, which was not there last year, with April GST collection of 2.37 lakh crores and RBI's dividend coming in June, July, I think government spending should be enough. The Pradhan Mantri Awas Yojana is gaining momentum in some of the states like East and all. Amravati project will boost demand of cement in South. So I would say that the demand environment looks okay. and it will gradually pick up. If we have normal monsoon again, rural housing will pick up in second half. So I would say that the tailwinds are there, and this is a sector which is where if you increase the prices, your profitability improves significantly. And remember, most of the players in the industry were generating very low ROEs. So it was a need of our for them to keep investing in the business. Also, you need profits, right? So basically, this price hike was due very much. It got delayed, but now it has started to happen.
Got it. The next, sector I want to focus on is the oil and gas space. We've seen the OMCs, report their Q4 numbers. So I want to talk about that first. You've seen the companies beat, the EBITDA estimates, and we've seen them, even in the refining front, beat the benchmark. But your LPG losses still remain at highs. You have around 10,000 to 18,000 crores across IOCL, BPCL and HPCL. Is the OMC pack something that looks attractive?
So they look attractive, but generally as a policy, we don't invest in these companies because there are so many moving parts here. As you rightly said, government policy, oil prices, there are so many moving parts that you have to buy it grossly cheap. And right now, after the recent rally, I would, again, as I told you, I would not chase momentum again. But of course, if the oil prices continue to be below 65 and if government allows them to make good marketing margins, the stocks are stocks can still see some upside. But as I said, we don't own OMCs in our portfolio and we don't intend to buy after this move.
What about the gas counters? I mean, maybe not an MGL in Q4, but something like an IGL. It did see, its EBITDA expand 5% on a quarter-on-quarter basis. Even the unit EBITDA has seen some improvement, and they are expanding geographically. Does the gas space look more attractive?
No, so basically, see, again, here also there are many moving parts, right? Government reduced that APM gas allocation to them. And after that, we have seen IGL taking some price hikes, which will protect their EBITDA. So again, I would say that these are the areas where you have to be very nimble, agile, and you have to then sell also very quickly once the thesis actually turns. So I would say that these are great franchises, I would say IGL and MGL, good ROC businesses, good net cash balance sheets. But after the recent thing which government did, that they reduced that APM gas allocation to them, I would not be a buyer in them.
Got it. And lastly, Parag, I want to ask about something like an ONGC and Oil India. I mean, I keep on, you've seen volume growth and production that has been missing for a while. Currently, even the oil prices are not in favor for the oil exploration companies and gas prices are packed, but there's still a lot of bullishness in terms of, brokerage ratings on the counters. Why is that so? Is there still some strength in something like an ONGC or an Oil India, or is it purely just based on cheaper valuations?
So, see, they are good dividend yield plays. Plus, the contra investors like like me or some other fund managers would always see value when the oil prices are down, right? When oil prices are down, you have to buy ONGC. You cannot buy it when it recovers to $80-85 because by that time the stock price would have gone up. So I would say that it offers it's a good contra value buy where the dividend yield is very good, where the production is, as you rightly said, production is set to increase, and that is why some of the brokerages are also bullish on ONGC because after a long time you are going to see increase in the production.
Got it. Thank you so much, Parag, for talking about all the kind of spaces that we mentioned today, and we hope to speak to you very soon.
Thanks.
Well, moving on, the focus is now on the consumption space. Asian Paints and Titans are expected to announce their earnings today. While Asian Paints is expecting margins to remain under pressure, Titan, on the other hand, is anticipating strong growth in their jewelry business, fueled by rising gold prices. When we have Mahima joining us to tell us the details.
Right, so I'll start with Titan first. Revenue growth, of course, on the back of rising gold prices. Margins might stay under pressure, is something that the street is expecting in terms of financial estimates. Revenue may rise around 9%. EBITDA may rise 13%. Margins may be at 9.9 versus that of 10.6 earlier. Net profit may rise around 9.8%. In terms of Q4 business update that the company did post, CaratLane sales are expected to grow by 22%. Standalone business to grow at 25%. Emerging business sales to grow at 7%. iCare to grow at 19%, which is a big win for Titan. Watch and wearables to see a growth of 22%, and jewelry sales overall expected to grow up by 25% on the back of rising gold prices. Now, what can you expect? Strong growth in jewelry, lower studded mix impacting the overall margins, rise in buying of gold and gold bullions, and a commentary on that. CaratLane outperforming, that's been the story in the past few quarters as well. Recovery in eye care business, and the key things to watch out for will be commentary on their emerging business, especially their new stores with respect to Taneira. Like-for-like growth trajectory going ahead and for this quarter as well. And lastly, margins outlook. In terms of Asian Paints, well, yet another quarter, disappointing quarter for Asian Paints. Fall in urban demand will put pressure in terms of their revenue growth. Margins will be under pressure on the back of inflation. Revenue may fall around 1.3%, EBITDA may fall 7%. EBITDA margins could be at 18.2 versus that of 19.4, and that is the lower end of what the management has always guided. Net profit may fall around 15.6%. What to expect? Subdued demand to put pressure on top line. Margins under pressure, and this is likely on the back of higher spends, ad spends as well, because Birla Opus is giving tough competition to Asian Paints. And it's not just Birla Opus, but peers like Berger Paints is also giving competition. Likely to underperform peers is something that the street is expecting. Key monitorables will be FY26 demand outlook, commentary on price hikes and outlook going ahead, and overall competition impact and commentary on that will also be something to watch out for. So these are the two things that the two companies that are expected to post their earnings today, and this is something that you can expect from both Titan as well as Asian Paints.
Thank you, Mahima, for giving us those details. Titan and Asian Paints, both of these counters are reflecting to what is expected on the street on the back of their Q4 results. Titan in the green, while Asian Paints slightly under pressure. But moving on, we talk about a Coal India, which did report its Q4 numbers. It's traded, it's at its day's lows, and but is trading with a positive bias, and this is because the earnings did beat estimates, but concerns about volume growth still remain. Now, the soft demand on the non-power segment, import pressure did impact our top line slightly, but we did see an uptick of 2.6%, and there was a strong profit growth which was driven on e-auction realizations, cost controls, as well as profits from joint ventures. Now, in terms of concerns, volume growth still remains challenging. The company's FY25 capital market share is also being eaten away by higher mines. But in terms of your top four numbers, revenue was up 2.6% on a quarter-on-quarter basis. EBITDA, however, saw a 4% downtick, and margins did contract to 31.2% versus 33.4% last quarter. But we've seen a net profit expansion of 13% to over 9,600 crores, which beat the street estimates. Now, what helped revenues? One was a 3.4% quarter-on-quarter uptick in the sales volumes of the company, and a 2% uptick in the blended realizations of the company, which stood at 1,702 rupees. However, what dragged EBITDA were higher costs on a quarterly basis. You've seen cost of materials rise 21%, employee costs rise 8%, a 12% rise on the contractual expenses, as well as a 37% uptick in the other expenses. But net profit, we did see the share of the joint venture profits of the companies rise 37% sequentially and stand at 168.73 crores, which aided the bottom line. In terms of the brokerage reviews, you have Nuvama, which maintained its hold rating, target price at 405 rupees. The brokerage is saying that the triggers are missing and the company needs to grow its volumes, and earning growth could be missing over FY25 and 27 because of these low volumes. Citi also maintains a neutral rating. They have, however, hiked the target price of the company to 395 rupees. They expect limited upside in the e-auction prices because of the coal inventory in the system, and valuations, however, limit the downside, but there is lack of visibility on any triggers on the upside side. Lastly, you have MK, which is the most bullish out of all the brokerages on a Coal India. It's maintained a buy rating, and they expect the production of the company to reach 820 MT in FY26 versus 781 metric ton in FY25. And one of the key reasons why they are bullish is because valuations remain undemanding. Well, that's what we have on something like in Coal India. But moving on, sources are telling NDTV Profit that the Minister of Commerce, Piyush Goyal, is set to meet Export Promotion Council on the UK FTA. Now, my colleague Rishabh joins us with more details. Rishabh, what are you picking up?
Right, Meka, what we've learned is the fact that there is a key exporter meeting that is scheduled to happen between 3 and 6 p.m. today. We expect the Commerce Minister Piyush Goyal as well as the various secretaries in the Commerce Ministry to come and sort of brief all these various export promotion councils, about 14 of them that come under the Commerce Ministry, on the various opportunities and the sort of next leg of growth that these exporters can tap on, given the fact that that finally after 3 years the UK-India FTA has been now formalized. Though such a meeting is routine, it is crucial because UK is in talks with also the US, is what we're hearing. This is a very, very historic deal that India has also cracked with the UK. So very, very important deal with regards to that. What exporters are also seeking to gain from this meeting is more clarity, right? A full document of the FTA is not out yet, so the exact contours, how one can tap this opportunity, if there'll be a streamlined portal that might open up for exporters, all of those questions are up in the air, and that is something that now exporters and various industries, from steel to engineering goods, from pharmacies, from the pharmaceutical industry to sporting goods, all of them can now tap this opportunity with regards to the UK FTA. Separately, on the Commerce Ministry side, what we're also hearing is the fact that the CIM, the Commerce Minister Goyal, might also be headed to the US in the week of May 19th for advancing the BTA talks, the bilateral trade agreement talks with the US. So that is also something that might come up in today's Export Promotion Council's meet.
Thank you, Rishabh, for giving us those details. But why we have you with us, the Competition Commission of India, or the CCI, has also tightened its grip over e-commerce and quick commerce platforms by introducing stricter rules against predatory pricing and zero pricing tactics used by players something like Zomato, Flipkart, Zepto and Blinkit. What can you tell us about this?
Correct. This comes after the CCI issued a notification yesterday. What they've basically done is they've notified the regulations for determining the cost of production. Now, once the cost of production is determined, the CCI will be able to have a better grip on whether platforms, including e-commerce as well as Q-commerce, whether these platforms are actually indulging in predatory pricing or deep discounting. Now, this has been an issue that has come up at least over the past year or so, with the Confederation of All India Traders, basically brick and mortar stores versus the e-commerce and the quick commerce biggies that have come up. We've seen how e-commerce and quick commerce have changed the way urban consumption is happening, and that is something that CCI also has a very keen eye on. So what we'll also know is that rather than describing sector-specific metrics now, the CCI will be able to track predatory pricing on a case-by-case basis. And that is something that is very important now with the CCI approaching and sort of tightening the news around whether or not these quick commerce and e-commerce platforms get a free rein in terms of deeply discounting and hurting your mom and pop neighborhood stores.
Thank you, Rishabh, for giving us those details. We now move on to my colleague Neeraj Shah, who spoke exclusively to market expert and Alchemy Capital's Hiren Ved to understand where he is finding value amid persisting geopolitical uncertainty. Let's hear on what he had to say.
No, I didn't say IT services because we don't have the big IT companies, but we certainly have exposure to some mid-sized companies and some product companies which we haven't sold down in this. We have only added to our IT exposure.
Nice.
Because I feel that, these, too often have I seen these narratives which keep changing every 6 months, right? So it's not, it's just that we are being very selective where we want to put our money in IT. It's not, certainly not in the big mega caps. So that's as far as IT is concerned. I think broadly speaking, if you tell me post-COVID, right, if two things have remained largely consistent in the way we've seen the opportunity set and our portfolios, one has been a set of consumer companies that are more discretionary in nature, more aspirational in nature, right? So as India becomes more wealthy and the consumer becomes more wealthy, he aspires to buy things which are more premium. And which are the companies that could benefit out of that? On the lower ticket side, we have seen tech disruption, right? We've seen great entrepreneurs that have benefited from the digital stack that India has built, which has enabled companies like Zomato and Paytm to even come into being, which was unthinkable of, let's say, 10 years ago.
Sure.
Right? And it took a little bit of time to grasp, what they were trying to do and whether they can build a business of enduring value. I think some of them have proven. I mean, valuations apart, I'm not talking valuations were crazy in 21, 22, and then they went to the others, swung to the other end of the pendulum, and now, we're somewhere in between. But I think these companies, what I really feel excited about is that, and which is what I talked about, that for now, after a long time, we are seeing fresh entrepreneurial blood coming into the Indian business ecosystem and willing to build world-class leading-edge companies. I'm happy that the best food delivery company is not from the house of Tatas or Ambanis or Mahindras or any of the old conglomerates, but it is a first-generation entrepreneur.
And with that, that's all the time we have on this show. But do stay tuned to NDTV Profit. Lots more lineup on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered.
Hello and welcome to Profit Buzzers right here on NDTV Profit. I am Puneet Zaveri. With me is Varsha today. And let's first look at how the markets are doing first, because we've seen, the index largely start in the red. It's still, currently down about 11 to 12 points. Just some marginal gains. The day's low actually was 24,373. it is critical to stay above the 24,300 level, and that will be something to watch out for, because today is of course the expiry day, so we are expecting to trade in a narrow band. But let's look at the contributors today, because we've seen some split between the sectors as well. Within banking, we've seen some gainers on ICICI Bank, but HDFC is also the biggest contributor on the negative side for the Nifty as well. Some other stocks that are in focus, L&T, we are expecting earnings today as well. It's largely decent numbers, and we'll address that during the show. Positive gains on Reliance as well. Let's also look at the sectoral heat map as well, because we've seen sectors like defense do very well in trade. That's also the second most gainer, up 1.7%. We've seen the Nifty Media do very well as well, 1.91% as of now. On the other side, Nifty Healthcare just seeing some pressure, as well as Pharma. And autos actually slept in the red now. It was in the green in the morning, slept in the red as of now. Finally, let's look at the mid-cap, small-cap, as well as the BSE 500, see if the broader markets are kind of outperforming or underperforming the index. Currently in the green by 0.3%, at least on the mid-cap 150. Small cap as well, actually being one of the biggest gainers today, 1.14% up. On the broader market side, we are seeing a lot of stocks moving in trade on the back of earnings as well as news flow. Symphony is one of them, up 9.3%. A lot of focus on Symphony today as well, because, and we'll address that with Mahima in the show, on earnings as well as what's happening with the overseas subsidiaries that were loss-making. KPR Mills is up. We've also seen Gokaldas up as well. And Amber Enterprises has now come up 6.5% on the green. We've also seen, essentially the textile companies like KPR Mills up. Welspun Living is the other one that's up today. Gokaldas is also up on the back of the UK FTA that India has signed on. On the negative side, seeing some pressure on stocks like Eternal, Devyani International also down as well as Siemens. I just want to pull up a couple of stocks. Just wanted to check first on Shriram Pistons. Company reported a stellar set of earnings yesterday. We've seen the growth momentum of that stock. It's up 16% now. Had seen some correction back in February because of the market corrections, but largely very positive today. That's one. I also wanted to just check on MRF as well, because while the stock was up 4% when the earnings came during market hours, just slipped in the red right now, and we'll address that during the show as well. So largely a lot of stocks in focus. We'll look at Blue Star among others, and Symphony as well when you talk about that show. But largely today, we're seeing positive momentum, at least in the broader market stocks, because of earnings as well. But let's now get you an expert voice on the market. Ashish Sumaya of White Oak Capital believes that the market resilience is led by external macros. Listen in as he lays out some of these macro factors to watch out for.
We saw 21,700, we saw a lot of nervousness, and from there we are, significantly up from the lower levels. And I would credit this resilience with currency appreciation, and typically currency appreciation is always accompanied by more confidence by the foreign investors, because they always prefer to invest when the currency shows some strength, right? So currency uptrend, interest rates, because obviously when the currency stabilizes, it strengthens RBI's ability to support our economic growth and credit creation and lower rates, liquidity, all of that. So I think the external macro is what might have given, and plus, see, look, a big part, like some 7-8 lakh crores of our industry is hybrid funds. And when yields go down, hybrid funds automatically tend to allocate more money to equities. And I think there is, so the buoyancy in the market is purely because of, my sense, external macro, which is improving local conditions.
Well, on that note, let me also invite, Avinash Gorashakar, who is the Director Research at Profit Mart Securities. Hi, Avinash, good to have you. Just wanted your view when it comes to market. A lot of stocks are actually buzzing on the back of earnings.
Yeah, I think good afternoon. I think markets are definitely in a wait and watch mode. I think, apart from the geopolitical factors, I think, if you look at the broader index, I think it's been showing a very, tepid kind of movement. But I think specific stocks, if you see where the quarterly numbers have been good, the management commentary has been quite solid. I think markets are obviously, betting on these kind of companies. So I would say that, we really don't know what would happen in the next few days as far as the, India-Pakistan front war is concerned. But I think very clearly, I think markets are betting on earnings momentum. Wherever the numbers are good, the trajectory is positive, and where the outlook is going to be good for the next 12 to 15 months, I think earnings are going to decide finally re-rating of these companies. So I would say that, this is a good time to look at good quality companies, in an environment like this, if provided the investor has a slightly medium to long-term view.
Right, got that view that earnings will decide the re-rating of these companies. But on that note, Blue Star slipped over 1% despite beating Q4 earnings estimate with 20.8% of revenue growth, while Voltas saw a slight miss even after 108% of growth in profit and strong domestic market, with margins up and unitary product shining, which cooling giant will dominate. Let's bring in Mahima for a comprehensive comparison.
Right, so in terms of both of these companies, that is Blue Star and Voltas, both came out with their earnings post-market hours yesterday. And Blue Star, of course, did beat analyst estimates on most of the fronts. Voltas did miss estimates slightly, but overall good domestic demand has led to good set of numbers this quarter for Voltas. Now in terms of how financial numbers fared, in terms of revenue, Blue Star saw a growth of 20% and did beat analyst estimates, whereas Voltas saw a growth of 13% and slightly missed the overall analyst estimates. In terms of EBITDA, the overall growth for Blue Star was at 15%, again beating analyst estimates. Voltas did grow at a 70% pace, but still missed estimates slightly. In terms of the net profit growth, for Blue Star it stood at 21%, slight miss there. But in terms of Voltas, the growth was at 108%, but the street was probably expecting a slightly more uptick in terms of its net profit, so a slight miss there. In terms of the overall margins, not much margin improvement in Blue Star. It was hardly 30 basis points, but Voltas saw a good uptick of margins by about 250 basis points. In terms of how segmental revenues fared, the electromechanical and AC segment, Blue Star saw a growth of 30%, that is almost 74% of its revenue. Voltas has significantly lesser share of the overall electromechanical AC segment, where it saw a growth of around 3.6%. But in terms of the unitary cooling product segment, Voltas saw a growth of 17%, which has a larger share of revenue for Voltas, and Blue Star saw a growth of around 15% when it comes to their unitary cooling products. So this is the overall view as to how Q4 has panned out for both of these cooling giants. Of course, we'll have to wait and watch as to how the investor call also takes place for both of these companies.
Well, thanks for that, Mahima. Avinash, good afternoon. Thanks so much for joining in. Good speaking to you again. Just wanted your view on both these stocks, because we've seen earnings largely very positive for both these companies, but I think because they've come on the same day, market not reacting very positively and maybe confused with the reaction. How are you seeing earnings for both these companies?
No, I think, Puneet, numbers have been, in line with market expectations. I think even the outlook going forward for this current financial year looks pretty solid, because, both companies, Voltas as well as Blue Star, they operate obviously based on the heat cycle in the country. And I think this time, current year trends clearly indicate that April to June quarter also equally will be a very solid quarter for them. So my sense is that, maybe the markets today are little lackluster, and that's the reason the markets have not taken these results, in a very strong manner. But I think going forward, hopefully as the numbers for April and June come out, I think you'll see a further kind of re-rating and some sort of further buying interest. Of course, both the stocks, Blue Star as well as Voltas, they are fairly valued. So I think markets would now be penciling a stronger growth for FY26. Within this space, Symphony has also come out with pretty solid numbers. Symphony operates in the cooler space. I was just seeing their numbers. They have also reported very strong numbers. So the trend is positive, and I would not be surprised that over the next, say, 8 to 12 months, you could see a significant amount of buying interest even from these levels. So I think net, numbers have been good, but market reaction has been very tepid. But that doesn't mean that the stocks are not going to go upwards. I think you have to give in some more time, considering that now the markets are volatile, slightly uncertainty has pierced in the market. So these factors have actually, obviously not fully, markets have possibly not fully discounted these numbers. So net, I think we are positive and constructive over the longer term.
Avinash, actually you took my line of Symphony, because I was just introducing Symphony, because Mahima is still with us, and let's see what are the details when it comes to Q4 earnings, when it comes to Symphony. Mahima?
Symphony definitely a beat across its financial metrics in terms of the overall growth driven by strong 48% growth in the domestic business. Overall, the rest of the world business also grew by around 44 odd percent. The consolidated EBITDA margins stood at 21.9%, and this remains highest since Q4 FY21 for Symphony. In terms of EBITDA margins, they were elevated despite of the heavy marketing spends that the company has done this quarter. Strong growth was also owing to some spillover of demand from Q3 for Symphony, and better penetration in semi-urban and rural areas has led to this kind of growth. They've also launched 17 new air coolers this particular quarter. In terms of the numbers, revenue was up almost 47%. EBITDA was up 87 odd percent. Margins improved by 475 basis points to 21.9%, so almost 22% odd there. Net profit was up 90% almost for the company. In terms of recent updates, and management did mention in their earnings as well, they plan to exit KPIT Technologies and Impeco, which are their two international subsidiaries. Divestments should help overall Symphony in turning overseas operations profitable, plus sharp improvement in return ratios, that is ROC and ROE is expected, and this will probably release the management with more bandwidth to focus on their core business. In terms of outlook, management has said that they have continued focus on the semi-urban and rural areas and continued focus on modern trade as a channel as well. They are building on initial success of adjacent categories of kitchenware, and overall USA markets remains highly attractive for them, and they are aiming to leverage that as well. So this is the overall view as to how strong Q4 was for Symphony.
Well, thank you so much, Mahima, for all the details. Let's shift our focus to Godrej Consumers. Is gaining over 0.5% after releasing their Q4 numbers. We spoke to the management to understand the company's growth projection and strategy. Listen in.
See, our priority as a company is volume growth, not value growth. We price to recover costs and not price for growth. Our idea is to get more penetration in more years. So whatever the price growth is, that's the price growth. Our hope is that we can move from big single-digit volume, which we had last year, to high single-digit volume. This is what we would like to do in FY26, which means a little bit more growth. And then that's what we're aiming for.
Right. And in terms of margins, you did mention in your press release this time that they were below normative range. But from what I understand is that, we were discussing earlier as well that palm oil prices have now started to ease. That it's not the case how it was 2 months or 3 months back. How are you seeing margins improving, let's say, from a longer term perspective by FY27? What is going to be the normative range in which margins will be at? And secondly, what will be the levers that will be auguring the growth? One thing is, of course, palm oil prices going down, but what are the other levers that you think will augur the margin growth?
Sure. So I think as a company, we've delivered a strong margin profile of 21% at the company whole level. And these are on the higher side of the range which we've historically done. So we are in a good kind of shape in terms of the overall shape of margin. Within that, the India margins have been mildly lower. They've been around 150 bits lower than a normative range in last quarter, primarily coming on the back of the palm oil prices that show up higher. We're seeing early signs of palm oil reduce. There is a possibility that palm oil prices will be subdued over the next few months, and hence more towards the latter part of the year, we should see margins improve and get back into normative range. We are not worried because these are not structural, these are short-term fluctuation in commodity prices, and hence we're quite reasonably sure we'll get into.
Right. Avinash, let me come to you on Godrej Consumer. Numbers in line, but EBITDA margin is expected to come to normal levels. How are you seeing these numbers, and what do you expect from the counter?
No, I think numbers have been in line. I think margins of 21% compared to 22% has been in line with what the street expectations were. But I think clearly, I think the company still is targeting for slightly higher single-digit numbers. I think what the market would be happy is, I know if the volume growth is at least in double digits, hopefully we have a good monsoon, rural demand picks up, and even urban market consumption picks up, because I think a lot of consumption related buying is expected now from the April to June quarter. I think whatever budget has announced, plus whatever RBI cuts have been announced, I think the consumption kind of trend would be more visible in the next couple of quarters. If the company is able to maintain a close double-digit growth in the volume, kind of category, then I think that would further re-rate the stock. See, as of now, there's no major trigger which I would believe, is the near-term trigger to re-rate the stock significantly. Although numbers have been better, slightly better than what the street expected, but I think some more improvement, if it could come in the next quarter, that is April to June, that would be a kind of positive thing I would be looking forward to. But nevertheless, I think, this is not a bad number. It's a decent number, but I think re-rating could happen post the June quarter of FY26.
Got the view, Avinash. Another stock in focus is Niva Bupa after the company reported 11% growth in its premium earned. We spoke to the company's CFO, Vishwanath Mahindra, on the quarter gone by, as well as the outlook going forward. Listen in.
So premium increase of, let's say, high single digit is what we do every year, and we would like to continue doing. We don't believe in correcting premium by 20%, 25% in one go.
Right. So in FY25, you have been able to grow your retail market share, and recently you just have launched a new product as well for the middle class and the lower middle class segment in the fourth quarter. So firstly, how has been the response for this new product in the first quarter so far, and what is your target market share for FY26?
So our market share in terms of retail health has improved from 9.1% in FY24 to 9.4%, and this is despite 1/N accounting. So we would like to continue growing in retail health faster than market, let's say 6-7 percentage point faster, which should help us in getting to double-digit market share. Let's say I can't comment on timing, but yeah, we are very confident of getting there.
Right. Vishwanath, my key question to you is, from here on, the kind of growth that you're expecting in terms of FY26, the opportunities that you have, and are you looking at a strategic global partner as well from here on to harness that growth opportunity with innovative offerings? What's the stance on that front?
Yeah, so actually, if you see our promoter, Bupa is global giant in health insurance. They are into health insurance, healthcare. So in that sense, we get a lot of expertise from them in terms of product innovation, customer service, claims management, underwriting, etc. So that need is being fulfilled by Bupa globally.
So, but then what's the outlook looking like for FY26 and the trajectory in terms of your ROEs?
Yeah, so if we just look at last year number, our return on average equity was 8.4%, and this has to be seen in the context of the investment we have made in last 3-4 years in terms of distribution network, increasing number of branches. And we feel in next 3-4 years, we should be able to get to return on equity of mid to high teens. That's the steady state target we are aiming.
Well, that was the management of Niva Bupa stock reacting very positively. Avinash, let me come to you. We've seen decent results from iLombard in terms of health insurance as well. They've increased their retail share. We've seen a miss by Star Health, and now Niva Bupa again reporting positive results. Do you have any particular picks amongst, the standalone as well as, the general insurance player amongst these three?
No, I think, our choices would be obviously be the large cap player, ICICI Lombard, because, in terms of geographical market share and their positioning of their products, they are very well positioned. I think, obviously the stock has run up, but our sense is that somebody who wants to take a long-term view and put up a portfolio of, insurance players, then I think ICICI Lombard could be the best category in the large cap. Niva Bupa has also come out with very decent numbers. I think these numbers, if they are sustained, and if the management commentary fructifies that, they do get a double-digit market share in the retail space, then I think definitely even this stock looks to be quite attractive. But again, these stocks have to be looked upon from a longer-term point of view. Quarter-on-quarter kind of growth expectation from these kind of businesses is a little difficult. And I would say that, investors should also look at these companies by looking at their annual performances and not only one quarter numbers. So maybe the second quarter may be moderately better maybe not as strong as the previous quarter for Niva Bupa. But I think definitely at these levels, the risk reward definitely looks attractive, from a 12 to 18-month time frame.
Risk reward looks attractive. Well, the next stock which is in focus is PNB. Now the bank posted its Q4 earnings and the margins contracted while the product mix has changed. And we spoke to Kalyan Kumar, who's the executive editor of the company, about how will all these factors and margins be reacted and how this will look when it comes to the overall picture of the bank. Listen in.
First, actually, there is 50 basis point reduction in repo rate, and that is 6% now. And this reduction immediately on the next working day, it is passed to the customer. We are having 44% repo linked loan. Immediately, that actually hit on our income starts from the next day of implementation of this rate cut. And in that way, actually, approximately hit of 250 crore in this actually quarter was on our NIM. But immediately we started recalibrating, as I was giving my answer towards your first question. RAM sector, MSME, agriculture and retail side, more focused towards that side. And I am happy to share we have organized a customer outreach program in the month of February, and those outreach program we were able to mobilize good number of leads, approximately 24,000 crore leads in SME side, and approximately 10,000 crore in home loan side, and for SHG agriculture side also good leads were available, and those were actually converted into the business in this quarter. And also this is continuous process. We have opened 1,000 MSME intensive and agriculture intensive branches in all the active clusters in the country, and special products, customized products for those clusters we have prepared, which will certainly give us good spread, good margin to us. Apart from that, low cost deposit, CASA is also very important, where there also in current account we have revisited our products, and segment wise for startup customers, for mid segment customer, or for large customer, we have customized our products in current account. We expect that more rate cuts will be in near future, and that will certainly impact our margin. As I told you, this time also it has impacted our margin. But I am of the opinion that NIM will hover around 2.8 to 2.9% for PNB. Otherwise, I would have more upbeat, it would have crossed, but looking to considering those things in our mind, we have given guidance of 2.8 to 2.9% for the NIM.
So 2.8 and 2.9% is the guidance for the NIMs given by the company. But Avinash, now margin pressure and cost control, are the key areas to watch out when it comes to, upcoming quarter. But just wanted to have your view on PNB, plus if you can give your view on Canara Bank and also on Bank of Baroda.
Yeah, I think, as far as Canara Bank of Baroda is concerned, I think numbers were slightly below expectations. Again, we don't know what was the reason for the higher provisioning, but I think numbers were definitely a tad below what the street expected. As far as, PNB and Canara Bank is concerned, I think PNB, as management clearly mentioned that, if further rate cuts come in, then I think obviously their margins could come under pressure. Most importantly, even today the return on asset is just about 1.4, 1.45%. So I think, for these kind of stocks, my sense is unless we get a better trajectory in the ROA and the ROE, these are not going to be banks which are going to go up in a hurry. And although the absolute profitability at the net level has improved, I would say that the selling which we have seen today is largely because the markets are not very sure as to whether the ROE and the return on asset would change significantly over the next 6 to 12 months. That is going to be the key, issue for both these public sector banks. That is for Canara as well as for PNB. So I would say that these could at best be in the current scenario, unless we see a very good jump up in the April to June quarter number and some very strong credit growth and disbursals, these stocks are not going to go up in a hurry. So at best they could be market performers. So we continue to be structurally positive on these PSU banks, but we expect better numbers. Only then some big re-rating can happen.
Avinash, just a follow-up on that. Do you expect the similar view on something like a UCO Bank as well? Because we did speak to the management. They are affirming that they will expect to cross the 1% ROA mark in this year despite pressure on NIMs. So do you have a similar view on something like a UCO Bank as well? Just to round off the public sector bank conversation.
Yeah, exactly, Puneet. Initially, I think we are more structurally positive on the larger PSU banks. UCO Bank is a much smaller PSU bank, but as you rightly mentioned, unless we see a very noticeable, significant improvement in the ROA, and which is supported by good margins, because on one side, if the margins are down and if the ROA is struggling to go up, then I think such kind of banks will take a little longer to get re-rated. Although there's good demand, credit demand in the market, I think structurally, unless we see better ROA numbers, re-rating is not going to happen in a hurry, especially for smaller banks like UCO Bank.
Got that view, Avinash. Avinash, stay with us. So we'll just slip into a very short break. Come back with more on profit buzzers on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the
Benchmarks trade in a tight range amid the broader tensions. Nifty and the Sensex are largely flat in trade today, while the mid and small cap indices outperform the benchmarks.
Earnings candidate Niva Bupa shining in trade as company's Q4 net loss narrows, accompanied by double-digit rise gross premium, stock up more than 10%.
Symphony is gaining over 9% on the back of strong Q4 earnings, as well as Blue Star is slightly in the red even as the fourth quarter numbers beat estimates. Expects demand to rise between May as well as June.
L&T gains ahead of Q4 results as it expects revenue and EBITDA to rise about 14%, while the street is estimating strong revenue growth on the back of rising gold prices.
An all-party meet ends after 90 minutes. The opposition shows strong support for Operation Sindur. Well, welcome back to Profit Buzzers. Let's now take a look at some key big brokerage calls of the day. We have MRF first. That was in the green earlier in the morning, slightly slipped into the red now. And that's after the company reported its Q4 earnings. Really strong numbers at the back of, on a basis of quarter-on-quarter basis as well as YOY. The results, the revenue grew by roughly 10% in this particular time frame, while the net profit has actually gone up 30%. We have a couple of brokerages that have come in. The first one's on CLSA. They maintained an outperform rating on MRF. Target price is now 1,68,426 rupees per share. It's up 30%. It's been hiked by 30% from the previous target prices. And there are three key points that CLSA is making in this report. The first one, that they say that the EBITDA margins were beating their estimates by roughly 200 basis points in this particular quarter. They also mentioned that this could be the beginning of margin upcycle going forward, largely after being affected for the last 4 quarters. And finally, they say that bulk of the recent commodity correction could happen over the next couple of quarters, and they see that MRF is an industry leader and they will have superior capital efficiency, which will drive cash flows for them. Anand Rathi also had a brokerage. They've taken the target price now to 1,65,000 from 1,60,000 earlier, and they've said that again the outlook for the OEM replacement as well as the export market is very strong for something like an MRF. They've also said that despite higher revenue increase, there was the input cost pressure on the margins, but demand seems to be largely stable as well. Let me go to Avinash as well as welcome in Vikas Jain, who's the head of research at Reliance Securities. Avinash, first let me come to you because we've seen numbers from CIAT being positive. Another one now from MRF. Are you getting constructive on the tire space as a whole?
Yeah, Puneet, I think if you see the numbers for CIAT and now MRF, I think one clear indication is that EBITDA growth has been much faster than the top line growth. And I think to a large extent, I think, correct me if I'm wrong, I think rubber prices have softened. So I think that is one reason. Again, now, if we look at the current crude price trend, I think, that has also now become very soft. I think it's around $60 a barrel. So, unless there are some further geopolitical events which could upset the crude price, it's very unlikely that crude prices will be going up in a hurry. And that, I think, is also going to be a positive driver for earnings going forward. And hopefully, this year we have a good monsoon. So I think rural demand for pockets like two-wheelers, passenger car, tractors is expected to be quite solid, at least 9 to 10%. And if that happens, then I think, OEM players, which are largely present with most of the bigger companies like CIAT, MRF, could definitely benefit. So I think, yes, if these stocks also correct a bit, they've gone up post the results. So I think, if they correct a bit further, that would give a better kind of entry point for investors and obviously generate a better risk reward over the next, say, 12 to 15 months.
Yes, Avinash, definitely. And you're absolutely right, because the natural rubber prices have either softened, at least from a quarter-on-quarter basis, and seen their margin growth as well. Vikas, good afternoon. Thanks so much for joining in. Just specifically, definitely, Vikas, it's a pleasure. Just wanted to view on MRF first, because we've seen a 20% up move in the last 1 month. The charts suggest to stay on course with MRF going forward as well?
The view continue to remain positive, but maybe not for the fresh investment perspective, because if you look at a large cap stock delivering 20-25% in less than a month's time, and plus the volume activity is also not so being great into the MRF stock, and plus the result reaction has also been pretty positive, and we are witnessing some amount of reversal. So maybe testing near the 200-day average near to 1,35,000, 1,36,000, any retracement happens through in the broader markets, that would be a good entry point to enter to the name.
Right. Now let's shift our focus to cement sector. Now MK is bullish on several cement companies. It has initiated a coverage on Ultratech, ACC and JK Cement. My colleague Mika joins in with more details on this.
Well, we've actually seen MK resume their coverage on the cement space. Counters like Ultratech and ACC and JK Cement with a buy, and Ambuja Cements and Shree Cement with an add rating. Now, what the brokerages is saying that the cement space is gaining ground after multiple headwinds that we've seen in the last 2-3 years, especially which has impacted pricing as well as demand. Now, they do expect cement prices to improve going forward. This is on back of multiple factors. One is the toned down aggression from industry players as well as better utilizations, and these two factors are expected to drive the prices in the space. The demand, cost and price are now favorably placed for the sector is what MK states, and they do expect Indian cement demand in FY26 and FY27 to be in the range of 7 to 7.5% on a year-on-year basis. And they also expect consolidation theme, which we've seen in the past 18 months via mergers and acquisitions. They're seeing hints of a ceasefire or a pause, and the companies will now focus on stabilizing and ramping the acquired capacities and expanding probably via brownfield expansions.
Right, got that view. Thank you so much, Mika, for that. Now, Avinash, a lot of consolidation is actually happening when it comes to, cement sector. And the cement space is also gaining after multiple headwinds. Just wanted your view on the overall sector and your favorite picks.
Yeah, I think consolidation definitely has happened and will continue to happen, in the cement sector. I think clearly we believe that, in the current year, hopefully April to June and in the second quarter, the government spending on several government projects also will get a significant boost. The previous year, June and September quarter were quite, flattish because, at that time we had the elections. So possibly, cement could be one sector which could definitely benefit significantly. And we have seen a decent amount of performance, coming out from companies like Ultratech, typically large players which operate pan-India. So I think, we still believe that the larger players would be in a better position as far as pricing power is concerned. The smaller players could possibly be South players like Ramco, or typically, even smaller players like Heidelberg Cement. So our sense is that Ultratech and Ambuja Cements from the large cap, and maybe the smaller players like Ramco and Heidelberg, these could be good choices. Obviously the geographical distance for the target markets is also very important, because freight cost plays a very important role in the overall profitability. So as of now, we are positive on these companies, and we still believe that, at these levels also, if one were to take a call, the next 12 to 15 months, one could definitely expect a reasonable risk reward.
And Vikas, want to know your favorite picks from the cement sector. Also, how are charts looking when it comes to, JK Cement and Shree Cement?
So we look at Shree Cement has been a strong outperformer over the last 6 months. It is facing some amount of headwinds near to those 30,000 mark and witnessing some amount of reversal. So unless and until the outcome doesn't come through in terms of results per se, or the breakout happens, the stock can witness some corrective action near to 28,500, 28,000. From the cement space, we like Dalmia Bharat Cement because the stock has been trending pretty particularly. It is making high tops on the monthly charts. The breakout has happened through, and we believe this stock is poised for a strong amount of upmove near to 2250, 2300 levels over the next few months. So Dalmia Bharat remains a preferred pick in terms of the cement space.
Got the view, Vikas. Another stock in focus is Coal India. After the company's Q4 earnings remain a beat, but there was some concern in terms of volume growth which is still looming. Mika is still with us, joining with some of the key highlights from the results. Mika.
Yeah. Coal India opened with an intraday high of 2%. It has kind of pattered down after that. The earnings were a beat on estimates, but concerns still remain. Now, the soft demand in non-power segment and pressure for cheap imports did impact the top line growth. However, the PAT was driven on higher e-auction realizations, cost controls. In terms of concerns, the overall volume growth trajectory still remains challenging, and the company is losing market share to higher captive mines of companies. If you look at the top 4 numbers on a quarter-on-quarter basis, revenue has seen a 2.6% uptick as has come in line with estimates. EBITDA, however, has fallen 4.3% to around 11,790 crores, but beat estimates. Margins have contracted as well to 31.2%, and net profit, however, has seen a 13% rise to 9,600 crores, which beat the estimates. Now, what helped revenues was a 3% Q-on-Q uptick in sales volumes, as well as a 2.1% Q-on-Q rise in the blended realizations of the company, which stood at 1,702. However, what dragged EBITDA was a 21% rise in cost of materials, 8% uptick in employee costs, 12% rise in contractual expenses, and a 37% rise in other expenses. And the only reason why net profit saw a 13% expansion was because the bottom line was aided by a 75% increase in the share of joint venture profits, which stood at 168.73 crores this quarter. Lastly, in terms of the brokerage, Nuvama has maintained a hold rating. It's stating that triggers are missing and the company needs volumes to grow. slow, and earnings growth over FY25 and FY27 could be slow because of this. Citi also has a neutral view. They expect limited upside in e-auction prices given the coal inventory in the system. Valuations do limit the downside, however, the lack of visibility on the upside triggers. And lastly, MK, which is the most bullish out of the three, they maintained a buy rating. They expect the production of the company to reach 820 MT in FY26 versus 781 in FY25. But they do expect e-auctions premiums to normalize around 50%. And the only reason, one of the key factors that they are bullish on is because valuations of the companies remain undemanding.
Gautam, Yumika, thanks for that. Vikas, anything on the charts for Coal India? Does it warrant looking at it right now?
In holding the medium term and the long term averages, nothing per se, but the view remains positive because if you look at despite a weaker set of numbers or despite weaker guidance, the stock has not broken down. So it means some amount of strong buyers have been placed into this name. So Coal India looks pretty promising from current levels, strong support near to 365, 370 odd. On the high side, 410 to 415 could be possible over the next few weeks.
Gautam, Vikas, I just want to quickly, address Bharat Forge as well because we are expecting the earnings to come very soon now. Earnings con call is also, we have actually have an interview with the management at 3 p.m. today on the channel, so do stay tuned. But in terms of preview, it's expected to be a slightly tough quarter for something like a Bharat Forge. On a consolidated basis, revenue is actually expected to fall by 19%, while the EBITDA margins will slightly rise because of a lower base last year. So EBITDA margin might come in 20% on a consolidated basis, while the net profit will also rise to 330 crores in this particular quarter. Now, it's been a quarter where the export market has been very muted, and we've specifically seen for something like a Bharat Forge where the Class A truck market has also not been very buoyant. And on a standalone basis, though, we are expecting flat numbers, which is for the forging business. So just watch out for that one specifically because that is going to be one in focus. And because it's in market hours, we'll see that reaction as well. The other ones which is in focus is Asian Paints as well as Titan, which are expected to announce their earnings today, while Asian Paints is expecting margins to remain under pressure, something that's been continuing from the previous quarters. Titan is actually anticipating strong growth in its jewelry business. This will be, of course, fueled by the gold prices, but the studded share will be something to watch out for. Now, Mahima joins in with more on both these and what should we expect from both these quarterly results.
I'll start with Titan first, revenue growth, of course, on the back of rising gold prices. Margins might stay under pressure, is something that the street is expecting in terms of financial estimates. Revenue may rise around 9%, EBITDA may rise 13%, margins may be at 9.9 versus that of 10.6 earlier. Net profit may rise around 9.8%. In terms of Q4 business update that the company did post, Carat Lane sales are expected to grow by 22%, standalone business to grow at 25%, emerging business sales to grow at 7%, eye care to grow at 19%, which is a big win for Titan. Watch and wearables to see a growth of 22%, and jewelry sales overall expected to grow up by 25% on the back of rising gold prices. Now, what can you expect? Strong growth in jewelry, lower studded mix impacting the overall margins, rise in buying of gold and gold bullions, and a commentary on that. Carat Lane outperforming, that's been the story in the past few quarters as well. Recovery in eye care business, and the key things to watch out for will be commentary on their emerging business, especially their new stores with respect to Taneira. Like-for-like growth trajectory going ahead and for this quarter as well. And lastly, margins outlook. In terms of Asian Paints, well, yet another quarter, disappointing quarter for Asian Paints. Fall in urban demand will put pressure in terms of their revenue growth. Margins will be under pressure on the back of inflation. Revenue may fall around 1.3%, EBITDA may fall 7%. EBITDA margins could be at 18.2 versus that of 19.4, and that is the lower end of what the management has always guided. Net profit may fall around 15.6%. What to expect? Subdued demand to put pressure on top line. Margins under pressure, and this is likely on the back of higher spends, ad spends as well, because Birla Opus is giving tough competition to Asian Paints. It's not just Birla Opus, but peers like Berger Paints is also giving competition. Likely to underperform peers is something that the street is expecting. Key monitorables will be FY26 demand outlook, commentary on price hikes and outlook going ahead, and overall competition impact and commentary on that will also be something to watch out for. So these are the two things that the two companies that are expected to post their earnings today, and this is something that you can expect from both Titan as well as Asian Paints.
Right. Thank you so much, Mahima, for all the details. Avinash, how should one look at Asian Paints? Now, we all know that this quarter would be muted, and we all know the competition which is actually affecting Asian Paints. So how should an investor look at it? Of course, from a long-term point of view, should they hold it, or is it time to sell Asian Paints?
I think, quite frankly, the good old days for Asian Paints are over. Not only from the valuation side, but even from the growth trajectory side. I think today the paint market has become more vibrant. I think, your colleague mentioned about Birla Opus. I think clearly after the entry of Birla Opus, we got JSW also who entered the markets. These companies have been offering more or less comparable quality at very competitive prices. And today, even customers want to try something new. So basically, the markets have become extremely competitive. Birla Opus is not only offering a better competitive price, they're offering a little larger quantity, for the customer also. So that goes a long way. So I think, typically, even if now food prices do come down, there is going to be some benefit on the raw material side. The pricing is going to be under significant pressure because earlier it was only Asian Paints and the other smaller players. But now levels of competitive intensity have increased significantly. And I think unless we see earnings growth of at least 15-20% coming back, it's very unlikely that even the larger institutions would stay invested here, because at some point of time they would also look at comparable companies in the same sector, or maybe they may switch to some other growing kind of corporate, because without earnings growth this stock is not going to go anywhere. So I think after tomorrow's numbers we could possibly see the stock heading further downwards.
Right. Thank you for that view. And Vikas, let me come to you for Titan. How are charts looking for Titan?
In terms of Titan, this stock has done pretty well. It is being consolidating and witnessed good amount of upmove. We believe the stock is poised for a higher move because it is consistently trading above the 200-day averages with volumes. Some amount of retracement came in 2 days before with the broader weakness, but again is recouped. So we believe the stock can move further higher near to 3550, 3600 levels. If the results persist would good pretty a bit, then we could see some an extended up move. So the view remains positive.
Okay, got that view. Well, L&T is one big counter set to come out with its 4-quarter results today. The order inflow may hit 1.1 lakh crore rupees. Now, Anushi joins us with more details. Anushi, what we can expect from this counter and how is this quarter looking?
Well, firstly about the general numbers, if we see, we do expect a revenue growth of around 14% this quarter, while the margins are expected to remain majorly flat at 10.9%. This is as in comparison with the last year figure that we are looking at. Net profit may see about a 3.3% growth. Now, what are the key expectations for this quarter is firstly order inflows, which would be in the range of 97,500 crore to 1.1 lakh crore. Again, this is this higher growth that we are seeing is on account of higher international orders that we've seen, especially in the last quarter, along with a low base effect that we've seen of the last year. So that is going to support the order inflow growth. Orders to be driven by international business and the project and manufacturing business as well. The expectation is also for the project and manufacturing business to offset some of that weakness seen in the services business. So that would be something we should be watching out for as well. However, the margin expectation for the project and manufacturing business remains flat for the year. But if you go ahead and look the ahead picture, that's the FY26. FY26 guidance for order inflows, revenues and margins is something we should be watching out for. What's the management commentary on this? Especially given at a timeline when, if we see in last few months, Saudi Aramco capex had been muted. So given that, given the impact of those lower crude oil prices, what could be the order prospect pipeline coming from Middle East business, which contributes to about 35% of the mix of the company, is something we should be watching out for. Along with that, there's a domestic prospect pipeline, also something that we should be seeing. Improvement in projects and manufacturing businesses expected, and this is on the higher margin threshold that the company is expecting for FY26. So that is another area that we should be focusing on. There are expectations that the company may beat its order inflow and revenue guidance marginally. If you look at the FY25 guidance given, the expectation is for a 10% of an order inflow growth, 15% of a revenue growth, and project and manufacturing segment margin guidance set at the range of 8.2 to 8.25%. So this is the overall picture that we are seeing for not just Q4 of L&T, but also what we should be watching out for FY26.
Well, thank you for that, Anushi. Avinash, is there anything specific that you will be watching out for in the L&T earnings? Because definitely a very big one to watch out for in trade today.
Yeah, I think my guess is that, what is the kind of new order win expected? I think order inflow expected is going to be a critical number. And secondly, on the working capital side, how would they benefit if obviously as a top rated corporate, whether they would be getting working capital funding at a much more competitive kind of cost? Because if these things are resolved, then I think you could see a better kind of margin picture in the coming financial year. Overall, we are positive because the order book continues to be strong, but inflow of orders in the current year and obviously the margin picture, looking at the revised working capital costing structure, these would be points which I think the management, if they spell out clearly, that would give a better perspective on the stock.
Got the view. Avinash, very, very important points that you also highlighted. Vikas, for you specifically, I just wanted to, we addressed Symphony earlier in the show, stock reacting almost up 9%. Do you have any view on two stocks, Symphony as well as Shriram Pistons, both up almost 9 to 13% trade? Does it warrant anything on the charts for a fresh entry or wait from the sidelines?
In terms of Shriram Piston, it has broken out from its strong consolidation zone, and with strong set of numbers remaining through, the stock reaction has been pretty positive. So we believe whenever these small cap companies move up, they move up pretty sharply in the range of around 25-30%. So it is at the higher end of the range order about it, but it could extend the up move near to 2250, 2300 levels over the next few weeks. So it tends to remain positive. In terms of Symphony, I would give it a skip because we believe the stock has not seen some amount of so great up move, and it is near to the resistance area of those 1310, 1330. So I would give a skip in terms of Symphony.
Right. Got that view? Well, few agrochemical companies will be in focus on the back of anti-dumping duties, which has levied by China. Now, China will impose anti-dumping duties on a product called cypermethrin, which is being imported from India starting yesterday. Now, this product is actually used in agriculture as an insecticide for various crops. Now, why they're doing is because Chinese investigation found that India was dumping this product, and this was causing material damage to its domestic insecticide industry. If I were to talk about the duty margins, anti-dumping duties will be effective for 5 years, and the duty margins ranges from 48.4% to 166.2%. Now, let's see which are the companies which will be in focus. You have Make Money Organics, which the duty for this company is 62%, while Bharat Rasayan has a duty of 62%. UPL will be having a duty of 166%, and the other Indian companies will also have the same duty. Now, China announced this anti-dumping investigation on May 7th, and a preliminary ruling of dumping and damage was issued on January 7, 2025, and the provisional anti-dumping measures have been in place since Jan 8, 2025. So basically, China is being, imposing anti-dumping duties on this key product. Now, Avinash, we all know that agrochemical sector overall is, is under pressure on the back of China dumping, and and the pricing pressure that all the chemicals are actually seeing. Now, just wanted to have your view on this sector, because we have been just hearing from like last 2 years that FY24 will be good, FY25 will be good, but nothing seems on the right track. So just wanted to have your overall view on the sector, and if you can give your picks.
I think agrochemical sector, as you rightly pointed out, has been a big underperformer, and I think stocks like UPL, definitely Make Money Organics, these have been actually beaten down from their 52-week highs. I think overall, I would say that the current year, hopefully, if the monsoon is good, the dumping from China actually subsides, and most importantly, if most of the agrochemical companies focus more on the domestic markets and other European as well as US markets. Like UPL has got a very large exposure to the Latin American market. So I think we need to see strong numbers, here. I think clearly you're right in pointing out that unless we see a strong trajectory both on the top line and the profitability, it's unlikely that we could see a very big jump in the very near term. So I think, typically the first half for agrochemical companies is supposed to be a very good period. The second half is not that remunerative. So I think the April to June and June to September quarter, hopefully, if we see some good numbers coming in, then only I think, larger companies like UPL could bounce back. So till that time, I think it's better to keep them on watch. I don't think, the January to March quarter is really a great indicator, because April to September is the peak period for most of the agrochemical players. So I think it's better to wait for some time before taking a call here.
Got that view. Well, moving on, India pharmaceutical market came out with its data for April 2025, and IPM grew 7.8% year on year. Now this was flattish growth when it comes to month on month, and it saw 140 basis points decline year on year, and the growth was driven by price increase and introduction of the new products, but the volume growth was weak at 0.4%. Now IPM growth has been slow, rather it has been below 10% for the past 18 months and single digit for the last 25 months. Now, if I were to talk about, who are the top performers, let's just shift our focus to that. Torrent Pharma and Sun Pharma were the fastest growing among the top 20 corporates. You have Torrent Pharma, Sun Pharma, Alkem, Cipla, which have actually outperformed when it comes to, IPM. Just a quick view, Vikas, just wanted to have your view on Torrent Pharma and Sun Pharma. How are charts looking for both the counters?
In terms of Torrent Pharma, it's trading in a particular range. So no, it's a sideways move. So unless and until it continues to sustain above those 3050, 3080 levels, the view remains positive. If 3050 has been broken down, then it would see some amount of a vertical correction of 5-7% shift. From the good names, LKM Labs looks pretty promising. The stock is sustaining above the higher band of the range, and a breakout trade will be emerged above 5100 or levels. So LKM Labs looks positive. A breakout above 5050 would extend the move to 5450, 5500 levels.
Got that view, Vikas. Avinash, both of you, thanks so much for joining in, giving us a whole host of views across a bunch of stocks. We look forward to our next conversation. Thanks so much for joining us today. Canara Bank flashes on the bottom of your screen. Operating profit is up 12%, while provisions have fallen 26%. So, stock up 3% now as well. But moving on and shifting focus to some national news, the all-party meeting chaired by Defence Minister Rajnath Singh, where he briefed the opposition leaders about the Operation Sindur. Parliamentary Affairs Minister Kiran Rijiju told the reporters that the opposition has agreed to support the government and armed forces and also gave suggestions. Listen in.
एक broad information consensus सारे political parties को एकजुट में कैसे काम करना चाहिए लोकतंत्र में, और विशेष करके संसदीय परंपरा में, पार्लियामेंट्री डेमोक्रेसी में पीपल्स वॉइस होता है पॉलिटिकल पार्टीज और एमपीज, तो इसलिए सबका वॉइस ऐसे समय में एकजुट आना ही मैं मानता हूं कि ये भारत का सक्सेस है.
Well, viewers, that's all the time we have on this edition of Profit Buzzers. Stay tuned to NDTV Profit.
That's huge. That is a biggie. It's out of there.
गोल्ड ग्लास क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Anushi. Well, Anushi, not much of an action that we're seeing. Nifty is down around 50 points. Small cap is holding in green, but mid cap again, it's in red, 0.3% down.
Yes, it's a relatively flat day of trading that we are looking at in terms of where the benchmark indices are concerned. If you see Nifty 50, you're seeing cuts of around 0.19% over here. Let's in fact pull the point contribution table to see which are some of the gainers and the laggers over here. So we have M&M, Eternal, HDFC Bank under pressure, while on the gaining side we have something like a Reliance Industry, ICICI Bank and Axis Bank holding up some of those gains that we are looking at. L&T stock in focus as it reports its fourth quarter results today later on. If you look at Nifty banks, that's in green, seeing gains of around 0.32% as well. In terms of where the broader market picture is concerned, let's pull out the sectoral indices to see how that is faring up. Nifty mid cap 150 down about 0.21%, but in terms of where the sectors are there, we're seeing cuts of around 1.32% for Nifty Auto. Nifty Metal also seeing cuts of around 1.2%, while it's Nifty Media and Nifty Defense which are in the green. So it's a mixed picture that we are seeing on the sectoral side. Let's also look at the advanced decline ratio to see how the breadth of the market is good towards. So if you are looking at the advanced decline ratios, majorly we are looking in the 2:1 ratio. Advanced is around 1,400 compared to around 800 declines is something that we are looking at. But in terms of where the broader market action is concerned, we are looking at a mixed picture here as well. Nifty mid cap 150 seeing cuts of around 0.19%, while Nifty small cap 250 is seeing gains of around 0.5%. Let's in fact pull the BSE 500 chart to see which are some of the stocks in focus right now. So we are looking at somewhere like Grindwell, Norton, Apar Industries and up around 8 to 9% in trade today. KPR seeing gains of around 8%. Symphony buzzing on the back of its results, seeing gains of 7% as well. While on the losing side, we have something like CCL Products seeing cuts of around 5%. Do note that the stock was buzzing when it reported its results earlier, just a few days ago. Eternal, Siemens, another couple of hands seeing cuts of around 3% as well. Well, this is overall the broader market picture that we are looking at. But let's welcome in our guest, Prashant Tapse, Senior VP Research Analyst at Mehta Equities, to understand what's his view of the markets that we are looking at.
I think you rightly pointed out with respect to the markets, very much stable on the expiry day, but day is very different for us. Again, today evening, there may be some kind of update from the US with respect to a trade deal. It is with India or China, it's a big question. So if it is in India, so I think that will be a big gap up tomorrow morning. But if it is with China again, so we will be seeing forward when will India get those trade deal. Again, UK and India trade deal has been signed 2 days back. That is giving a lot of support for Indian markets and keeping markets very much stable. The overall strength is very much positive. As you said, advance ratio where is 1:2. Advances are almost like 1,400 shares. So that is giving a lot of strength in a positive way. Again, third would be again earnings. Again, a lot of earnings are due today. Almost 10 to 15 stocks which are into FNO, as well as the index stocks which will be going to deliver their results today, like L&T. So that will be giving markets a new trend going forward, because earnings are the only way which we can see the future. So overall, markets will remain like this only. Technically, again, 24,580 would be a resistance for the market, and I think 24,200 can be a support for markets. So it will be trading in this range only.
Right. Niva Bupa remains in focus. We spoke to the management after the company reported 11% growth in the premiums earned. Now, let's listen to what the CFO had to say on the quarter gone by and what is the outlook going forward.
So premium increase of, let's say, high single digit is what we do every year, and we would like to continue doing. We don't believe in correcting premium by 20%, 25% in one go.
Right. So in FY25, you have been able to grow your retail market share, and recently you just have launched a new product as well for the middle class and the lower middle class segment in the fourth quarter. So firstly, how has been the response for this new product in the first quarter so far, and what is your target market share for FY26?
So our market share in terms of retail health has improved from 9.1% in FY24 to 9.4%, and this is despite 1/n accounting. So we would like to continue growing in retail health faster than market, let's say 6-7 percentage point faster, which should help us in getting to double-digit market share. Let's say I can't comment on timing, but yeah, we are very confident of getting there.
Right. Vishwanath, my key question to you is, from here on, the kind of growth that you're expecting in terms of FY26, the opportunities that you have, and are you looking at a strategic global partner as well from here on to harness that growth opportunity with innovative offerings? What's the stance on that front?
Yeah, so actually, if you see our promoter, Bupa is global giant in health insurance. They are into health insurance, healthcare. So in that sense, we get a lot of expertise from them in terms of product innovation, customer service, claims management, underwriting, etc. So that need is being fulfilled by Bupa globally.
So, but then what's the outlook looking like for FY26 and the trajectory in terms of your ROEs?
Yeah, so if we just look at last year number, our return on average equity was 8.4%, and this has to be seen in the context of the investment we have made in last 3-4 years in terms of distribution network, increasing number of branches. And we feel in next 3-4 years, we should be able to get to return on equity of mid to high teens. That's the steady state target we are aiming at.
Right. Prashant, coming to you on Niva Bupa, strong growth that we have seen in the fourth quarter, strong growth targets given by the company. What's your view? Would you advise your investors to go ahead and buy this counter when it's up 9% in trade?
Not today, but I'm very much positive on the company business model. As the management said, they are very much aggressive in terms of the standalone health insurance policy in India, and the strong promoter like Bupa will help them to have a lot of deep pockets to explore and get market share in Indian market. So overall, with respect to valuation at this point of time, I may not recommend any clients to have a fresh position at this point of time. Again, anywhere between 75 and 80 would be a good range for me for a fresh accumulation for a long-term investors. Time being, my target would be anywhere between 100, but again, a fresh position is not advised at this point of time.
Okay, so well, that's the view that we are seeing for Niva Bupa Health Insurance. But another stock in focus on the back of its fourth quarter is something like Symphony, which is gaining more than 9% in trade today after posting a round overall beat in the fourth quarter. Now, if you look at the company's revenue, that was up around 47%. But to give a deeper perspective on this, Mahima joins in with more details.
Symphony definitely a beat across its financial metrics in terms of the overall growth driven by strong 48% growth in the domestic business. Overall, the rest of the world business also grew by around 44%. The consolidated EBITDA margins stood at 21.9%, and this remains highest since Q4 FY21 for Symphony. In terms of EBITDA margins, they were elevated despite of the heavy marketing spends that the company has done this quarter. Strong growth was also owing to some spillover of demand from Q3 for Symphony, and better penetration in semi-urban and rural areas has led to this kind of growth. They've also launched 17 new air coolers this particular quarter. In terms of the numbers, revenue was up almost 47%. EBITDA was up 87%. Margins improved by 475 basis points to 21.9%, so almost 22% out there. Net profit was up 90% almost for the company. In terms of recent updates, and management did mention in their earnings as well, they plan to exit KPIT Technologies and Impeco, which are their two international subsidiaries. Divestments should help overall Symphony in turning overseas operations profitable, plus sharp improvement in return ratios, that is ROC and ROE is expected. and this will probably release the management with more bandwidth to focus on their core business. In terms of outlook, management has said that they have continued focus on the semi-urban and rural areas and continued focus on modern trade as a channel as well. They're building on initial success of adjacent categories of kitchenware, and overall USA markets remains highly attractive for them, and they are aiming to leverage that as well. So this is the overall view as to how strong Q4 was for Symphony.
Okay, well, thank you, Mahima, for all those key details. Prashant, coming to you for something like Symphony, what we are seeing is an overall beat in terms of where the performance is concerned. What's your view on this counter?
Very, very positive. It was a surprise to me to see these numbers after a long time. I think from last 2-3 years, these margins were missing. The margins were almost near, numbers were like 17% to 18% from many quarters. So 22% was a surprise for me. But again, if you see the volume growth, if you see the segmental growth, I think the stock should continue to do well. The management has given a lot of comments with respect to the new products as well as the growth going forward. So for me, in terms of valuations, are very comfortable at 30-32 PE going forward. Is a great product right now when we compare with the other home-made durable stocks like Bajaj Electricals and all. I think they are trading like 50 to 60 times currently. So there is a good opportunity for new investors to freshly get into the stock as a long-term investor.
Right. Pharma industry remains in focus after Indian pharmaceuticals market comes out with their April data. That market grew by nearly 7.8%. To give us better picture about the same, Varsha is joining with more details.
Yeah, thank you for that. So yes, IPM, that is India Pharma market, grew 7.8% year on year. Now this growth was driven by price increases and of course introduction of new products. The volume growth was though weak at 0.4%. Now IPM growth, if you see overall, has been below 10% for the past 18 months, and a single digit growth has been seen for the last 25 months. Now this is excluding a seasonal spike in October 2023. Talking about the therapies, if you see growth in acute therapies areas remain weak, but cardiac, urology and hormones grew faster than the overall market. Now anti-diabetic, derma therapies also grew slower than the IPM. Now talking about the price-led growth, if you see most therapies saw growth driven by price increase of 4 to 6%, but there was a weak volume growth across the board. Now, talking about the volume leaders and laggards, oncology saw the most volume increase, while gynec and respiratory volumes declined the most. Most companies outperformed. You have Torrent Pharma and Sun Pharma, but Glenmark, if you see, grew marginally below IPM. Now, talking about the unit growth decline, Lupin, Zydus and Glenmark saw a decline in unit growth when it comes to April 2025. Talking about the top performers, you have Torrent Pharma, Sun Pharma, Alkem Labs, Cipla, Dr. Reddy's, who were the top performers. Their growth ranges from 11% to 14%, while the industry growth, if you see overall, was 8.3%.
Right. Well, Prashant, coming to you on this, 8% growth for the Indian domestic pharma, though the Nifty Pharma index is down 1%, is the domestic focused players that have been gaining in trade, be it Mankind, Ajanta Pharma, JB Chemical. What is your view when it comes to the entire pharma space? Would you prefer domestic focused players more, or US focused or international focused players? What is your top pick here when it comes to the pharma sector?
For time being, looking at the condition, I think we all should focus more on the domestic manufacturers only, like Alkem and all. So those will give you a lot of domestic driven consumption story with respect to the pharma products. But once we get into a good deal with US, and then these companies like Cipla or Sun Pharma or Dr. Reddy's looks good at this point of time, when we get a great deal with respect to the India and US pharma treaty as well as the tariff plans. So time being, I will be focusing more on the domestic Alkem stock, and when we get a great deal with US, so I think Cipla and Dr. Reddy looks good when the deal is get closed.
Okay, so that's overall the view that we are seeing for the pharma space. But let's focus on something like a key brokerage note which came out today, and that is UBS, which downgraded RK Forgings to neutral rating, reducing the price to 680 from 1,500 held earlier. We have Harsh joining us with all the details on this one.
Well, first off, they've downgraded from a buy to a neutral, and they've considerably reduced the target price from 1500 earlier. It's now 680. There's still some upside from here, but there's multiple headwinds. So just let me try and contextualize this. Stock is down 40% year to date. They're facing challenges on multiple fronts. One is slowdown in the CV segment, and the second one is the inventory write-off. Let me talk about the weakening CV cycle first off. The global CV cycle is weakening and is expected to continue to deteriorate. The American Class 8 truck orders also continue to remain weak. Plus, on top of it, there is tariff-induced slowdowns which are likely to weigh in as well. So the trend is likely to worsen is what UBS is saying. They do not expect recovery despite low expectations, at least in FY26. So that's the first headwind. The second headwind is with regard to the recent one-time inventory write-off. This could adversely impact projections going forward. The discrepancy has been reported in the annual physical verification of inventory, and as part of that, likely a 150 crore write-off is expected. They believe that this is accumulated over the years, and therefore it's going to be likely a one-time impact on FY25, but will also impact the way in which accounting will work for RK Forgings going forward as well. Fund infusion by the promoter to protect external and minority investors may be welcome, but nonetheless, headwinds galore is what they are saying. Medium-term factors dampen growth and profitability outlook. So for FY26 and 27, they've revised and cut their earnings estimates by 17% for FY26, 23% for FY27. And on the back of that, cut that target price as well.
Well, interesting note that we are seeing for RK Forgings. If you are looking at the stock price of this, it's majorly flat, about the cuts of 0.32%. In fact, let me come to you, Prashant, on this counter RK Forgings. Now, it's the medium-term uncertainties that Harsh was pointing out based on the tariff picture that is being pointed out. What is your view on something like this, or are there any alternative plays other than RK Forgings that one should look at in this space?
Alternative would be Bharat Forge. I think one should be looking at the same business model, which will be focusing on Bharat Forge in the alternative investment option versus RK Forging. Yes, RK Forging, I agree with Harsh again. All the hurdles which he has mentioned would keep the stock under pressure, and then I think until unless 1 or 2 quarters, the management should perform well in terms of better growth in terms of top line as well as in the bottom line. Then only the investor confidence will return back in RK Forging. For time being, again, if anybody would like to have a forging premium stock, I think Bharat Forge should do well. There are hurdles again. The tariff hurdles will continue to remain same. I think within this 90-day period of the US deal, I think that would also be cleared off. So Bharat Forge would be a preferred pick at this point of time.
Right. Asian Paints and Titan are expected to announce their earnings today. While Asian Paints is expecting margins to remain under pressure, Titan numbers are expected to report a strong growth in the jewelry business. Let's get in Mahima with more details on the same.
Right, so I'll start with Titan first, revenue growth, of course, on the back of rising gold prices. Margins might stay under pressure, is something that the street is expecting in terms of financial estimates. Revenue may rise around 9-odd%, EBITDA may rise 13-odd%, margins may be at 9.9 versus that of 10.6 earlier. Net profit may rise around 9.8%. In terms of Q4 business update that the company did post, CaratLane sales are expected to grow by 22-odd%, standalone business to grow at 25-odd%, emerging business sales to grow at 7-odd%, eye care to grow at 19-odd%, which is a big win for Titan. Watch and wearables to see a growth of 22-odd%, and jewelry sales overall expected to grow up by 25-odd% on the back of rising gold prices. Now, what can you expect? Strong growth in jewelry, lower studded mix impacting the overall margins, rise in buying of gold and gold bullions, and a commentary on that. CaratLane outperforming, that's been the story in the past few quarters as well. Recovery in eye care business, and key things to watch out for will be commentary on their emerging business, especially their new stores with respect to Taneira. Like-for-like growth trajectory going ahead and for this quarter as well. And lastly, margins outlook. In terms of Asian Paints, well, yet another quarter, disappointing quarter for Asian Paints. Fall in urban demand will put pressure in terms of their revenue growth. Margins will be under pressure on the back of inflation. Revenue may fall around 1.3%, EBITDA may fall 7%. EBITDA margins could be at 18.2 versus that of 19.4, and that is the lower end of what the management has always guided. Net profit may fall around 15.6%. What to expect? Subdued demand to put pressure on top line. Margins under pressure, and this is likely on the back of higher spends, ad spends as well, because Birla Opus is giving tough competition to Asian Paints. And it's not just Birla Opus, but peers like Berger Paints is also giving competition. Likely to underperform peers is something that the street is expecting. Key monitorables will be FY26 demand outlook, commentary on price hikes and outlook going ahead, and overall competition impact and commentary on that will also be something to watch out for. So these are the two things that the two companies that are expected to post their earnings today, and this is something that you can expect from both Titan as well as Asian Paints.
So Prashant, when it comes to Asian Paints and Titan, what is that key number that you'll be watching out from both the companies here, or the key commentary that you'll be watching out?
Yes, obviously commentaries are the most important part in both the companies. I think in Asian Paints, the margin outlook and the rising competition outlook, how they are going to manage this, with respect to the high competition from the Opus or any other companies which are doing very great right now. But again, I think with respect to negative expectations, with respect to the low margins in this quarter, I think the worst is already priced in the stock. I think post the result, the stock may react in a positive way. This is my expectation, because valuations are a little bit very much comfortable. And if management gives a very decent, positive, optimistic outlook on the growth going forward, so the stock will reverse in the greener zone. With respect to Titan, again, I think we all know the sales growth will be expected almost 15-20% growth from the current levels. And with respect to valuations, again, very much comfortable. I think margin improvements may see a good in this fourth quarter, and technically also I think the stock is doing great, and I think any good surprises with respect to margin improvement and the commentary from the management, the stock can go to 3,500.
Okay, well, that's the view that we are seeing for Asian Paints and Titan. But another stock which should be in focus today on the back of its fourth quarter earnings is something like Larsen and Toubro. Now, what majorly is the fourth quarter expectations? If you look at the headline numbers, revenue is expected to see about a 13.7% of a growth. EBITDA may see about a 15% of a growth, while the margins are expected to remain majorly flat at the levels of 10.9%, while net profit may see about a 3.3% of a growth. So, what the key expectations for fourth quarter is on the order inflows, which are expected in the range of 97,500 crore to 1.1 lakh crore. This is on the basis of higher international orders that we've seen in the last quarter, along with a low base effect supporting the higher growth number that we are looking at for the business. Of course, the orders to be driven by the international business and the projects in manufacturing business as well. The expectation is also for the projects and manufacturing business to offset some of that weakness that is seen, or rather the softness seen in the services business which are there. However, if we talk about the margin expectation, margins are expected to be majorly flat due to the projects and manufacturing business as well. Now, coming to the key expectations and the commentary that we should be watching out for FY26 is firstly on the guidance for the order inflows, revenue and margins. In fact, if you look at one of the brokerage notes, that's HSBC, they expect around 7 to 10% of an order inflow growth, 15% of a revenue growth, and a 30 to 40 basis points of improvement in the EBITDA margins for the project and manufacturing division. The other important focus area would be on the order prospects pipeline, especially in the Middle East division, which contributes around 35% of the revenue for company. And also considering the Saudi Aramco capex, which just came out a few months ago, wherein we had seen overall a muted capex given the impact of lower crude oil prices that we are building on. So management commentary on the order prospect pipeline from both its international and domestic business would something that we should be focusing on. Along with that, improvement in projects and manufacturing business, margins are expected to be better this time because of higher thresholds expected over here. So that is something we'll be seeing. Just to reiterate the FY25 guidance given, the expectation is for a 10% of an order inflow growth, 15% of a revenue growth, and project and manufacturing segment margin guidance set at 8.2% to 8.25%. So that's the overall roundup that we are seeing for L&T for this quarter. But Prashant, coming to you, the major key focus area would be the commentary for the Middle East division, considering the crude oil prices, the effect of the capex that we have seen in Saudi Aramco. What's your view on something like L&T?
So I think margin would be the highly focused point in the Q4 earnings, but the worst is already discounted in the price. So I feel a 10 to 11% of EBITDA operating margin can also give a stock a good boost towards 3,500. But overall, I am expecting the order book comment will be highly focused. It may be crossing even 1 lakh crore for next quarter in terms of commentary. So that will be giving a lot of push to the push and confidence to the investors to take the stock at this point of time also. So overall, my outlook on L&T would be very much optimistic towards 3,500 as a target. But again, Q1 earnings will be most focused rather than the Q4 earnings.
Well, Godrej Consumer is the stock that remains in focus. It reported its numbers, Q4 numbers, a couple of days back. We spoke to the management to understand the company's growth projections and strategy, listening to what the management had to say.
See, our priority as a company is volume growth, not value growth. We price to recover costs and not price for growth. Our idea is to get more penetration in more years. So whatever the price growth is, that's the price growth. Our hope is that we can move from big single-digit volume, which we had last year, to high single-digit volume. This is what we would like to do in FY26, which means a little bit more growth. And then that's what we're aiming for.
Right. And in terms of margins, you did mention in your press release this time that they were below normative range. But from what I understand is that, we were discussing earlier as well, that palm oil prices have now started to ease. That it's not the case how it was 2 months or 3 months back. How are you seeing margins improving, let's say, from a longer term perspective by FY27? What is going to be the normative range in which margins will be at? And secondly, what will be the levers that will be auguring the growth? One thing is, of course, palm oil prices going down, but what are the other levers that you think will augur the margin growth?
Sure. So I think firstly, as a company, we've delivered a strong margin profile of 21% at the company whole level. And these are on the higher side of the range which we've historically done. So we are in a good kind of shape in terms of the overall shape of margin. Within that, the India margins have been mildly lower. They've been around 150 bits lower than a normative range in last quarter, primarily coming on the back of the palm oil prices which were higher. We're seeing early signs of palm oil reduce. There is a possibility that palm oil prices will be subdued over the next few months, and hence more towards the latter part of the year, we should see margins improve and get back into normative range. We are not worried because these are not structural. These are short-term fluctuation in commodity prices, and hence we're quite reasonably sure we'll get into.
Well, that was the management of Godrej Consumer, and with that, it's a wrap on this edition of Top Trades. Keep watching NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Hello and welcome to India Market Close. A very good afternoon to all the viewers. I'm Hiral Datia and with me is Harsh Saita. In fact, I'm the one who's with Harsh Saita on the regular. But clearly, you know, there was no excitement in the markets when we started off the day, Harsh. Right now, you're almost at the day's lowest levels. You are seeing cuts. And what's interesting is we've broken that 24,400 mark, which Kush was alluding to. And I think it's great. It's going to be great to have him as well. That what from here on. So 24,300. We are seeing cuts. It's broken the support of 24,350 as well. So tomorrow's day is going to be absolutely interesting to watch out for. Bank Nifty as well, similar kind of cuts that are coming in there. 54,600 is what we've broken, so 54,570. But pretty flattish on that front. You're not seeing major pressure, and it was yesterday where we saw buying interest that did come in terms of Bank Nifty as well. Let's just quickly pull up either the sectoral or the Nifty 50 components, because that will give you an idea of what's happening and where the pressure is. There you go. The advanced decline ratio, which was slightly in favor of the bulls, is turned in favor of the bears right now. Zomato, the top loser today. Tata Consumer, again, iSure, M&M, Maruti. So it's the auto pack which is taking a beating. Though you have a Tata Motors which was absolutely resilient, which is now seeing gains of 0.8%, but some cooling off has happened on that front as well. IT is very interesting as well, because you have a HCL Tech which is on the gaining front, Tech Mahindra is on the gaining front, and TCS. But if you have to look at an Infi, or if you have to look at a Wipro, they have been trading under pressure. So no major sectoral trend emerging here as well. And if we can just have the sectoral heat map, and then Harsh can take us through the broader markets. Media, IT, private banks and defense. That's where the juice is right now. But apart from that, auto, metals, healthcare, real estate and consumption taking a knock as we speak.
Yeah, autos had a couple of good days of trade here. So honestly, I'm not sure how much one can complain because 1.6% isn't that substantial either.
I mean, it was mainly Tata Motors and M&M who was supporting. TVS was another one from the two-wheeler pack who was supporting. Yeah, I mean, but the others, very somber.
Yeah. And yesterday was obviously on the back of the FTA, but autos done fairly well. Metals down 1.5%. Within broader markets, realty is the other one, which is down around 1.2 odd percent. Pharma also taking a bit of a knock, 1% lower. That's how it's shaping up, at least with regard to how sectoral indices are looking. Let's look at the intraday heat map on the Nifty mid cap and small cap, because that's where it's starting to get really interesting. We're sitting at the day's low now when it comes to the Nifty mid cap, and you see a sharp fall in that sense, 0.8% lower on the Nifty mid cap. The Nifty small cap too, very similar chart structure, but down around 1/5% thereabouts. So pressure seen there as well. I'm gonna again pose this to Kush as to what one can expect, especially from the broader markets as well. Let's look at the advanced decline quickly, and we'll see how sharp that reversal is with regard to the advanced decline. And you know, at one point sitting pretty with regard to the breadth. Now the breadth absolutely tough, 1:1, and we'd be lucky to go home at this with this kind of a breadth as well. So it's looking
and the
increasingly
individual,
difficult.
NSE 500 is going to be important to understand
Yes.
the smaller sectoral trend as well.
Yes.
I mean, Grindwell, KPR is interesting, Apar Industries earnings, Jindal worldwide interesting, Symphony again its earnings, but CCL products sharp up move on the back of earnings, and now you're seeing that profit booking.
Yes.
Devyani, Torrent Power. So it's a pretty mixed trend that you're seeing. You know, UPL is interesting because in spite of that China anti-dumping duty, the stock was up in trade, and now it's gone down to the tune of almost 3 to 4%. I think now is when the markets have digested that anti-dumping news from China, but no major trend in terms of sectors emerging from the broader markets as well.
Yeah, Polymed and 197 were two stocks which were buzzing in trade yesterday. You're seeing a bit of a cool off on the kind of gains that they saw yesterday. But let's go across to Kosh, Hiral, and let's take a quick check. Kosh, so 24,400 breached. What's the next support? 24,200 is what you had suggested earlier this week. What's the likelihood of that happening? Because every time we've spoken about 24,200, we've not touched it. We've been extremely range bound. Is that the theme at this point?
First of all, very good afternoon, guys. Hi, Shahidal. Well, I think, what's starting to play out is something very interesting. Most of the data points that looked rather pretty or consolidative in nature up until yesterday are starting to turn, mildly negative. And, I say that with very cautious view, which is mildly negative. As you've seen, the breadth has just turned positive. Mid-cap and small-cap spaces weren't really, firing all guns, but they were still holding ground and they're starting to give way. And also, if you see the India VIX, which was up until about 18 and a half odd levels, has again risen and, is now hitting the doors of 20. Now, what is this pointing to? If you'll recall, there have been recent instances in the past where up until Thursday, market has digested, some bad news, be it local or global, in a manner in which it seems as if, we aren't really as badly affected by it. But come Friday, and once the expiry hangover is over, you've seen a sharp reaction. So the Indian markets have had a delayed reaction to some of the news, as I said, global or domestic, in the recent past. Now, what this is suggesting is that we might be shaping up for one more cautious, perhaps even a downward Friday move. So I will be a little cautious. As Hiral and you rightly pointed out, 24,400 was the level that we were looking at in terms of support, because the next week, weekly expiry was seen as, or rather the put as a 24,400, for the next week expiry was seen as having a good base. Now what that is turned into is a straddle. So you've got a good base near 24,400 call and put option, and the range for that comes to about 400, 450 points. That brings us to the levels. 24,200 is more of a line in sand, which is, it's a mild support, nothing very serious or nothing very meaningful. The actual support comes in at the 24,000, 24,050 mark, because the next put base for next week is at that level. The 200-day moving average support comes in at that level. So, it could be a bit of a delayed reaction that we have to, the action across the border. So I'll be a little cautious. I still maintain the view that 23,800, 24,000 is the zone to watch for. As long as that is protected, I don't think there is anything to worry about. This could well be, a very normal reaction to what is happening, in the geopolitics side of things. So all in all, still constructive, but yes, a down move, perhaps even a sharp one, cannot be ruled out.
So, Kush, 24,300 needs to be protected from here on as well. But what would your strategy be with regards to Bank Nifty? Because if you see, it actually started to see some buying interest only in terms of yesterday's session, and that's what actually gave it strength. The immediate resistance that we were tracking was around 55,000 on Bank Nifty. And the support that the market is looking at is somewhere around 53,890. According to you, at the current level where we are, what should that strategy be?
So quite rightly pointed out in terms of levels, Hiral, I might push the resistance level a little higher to 55,200 perhaps, but yes, that's the number that even I've got on the upside. On the downside, the 20-day moving average itself is at 53,850 odd. So yes, that is the immediate support, and we did allude to that yesterday. The Nifty came very close to, or the Bank Nifty rather came very close to that also. What's interesting is that for the past 4 sessions, we've had a lower high, lower low formation which is just a confirmation of the kind of pressure that the bank nifty already is in. I think out of the last 10 sessions, we've had only 2 or 3 sessions of positive close. And yesterday's positive close also very interestingly has been a lower high formation where, the index where bank nifty wasn't even able to take out Tuesday's high. That's not a good sign if you're looking for momentum or strength in bank nifty. While I do remain, fairly constructive on bank nifty as well, the 850 mark that we spoke of, I think that might just come in play. And if the market were to react to the news and the delayed reaction that we're speaking of, I won't be surprised to see that tested. So wait for any further, major deployment of funds, in a market like this. Sure, you could take opportunities of, swings here and there, but any major fund deployment should be done with caution or perhaps on a limited ticket size. Bank Nifty could perhaps go and test the 53,850 mark that we just spoke of.
And Kush, your picks therefore in this market?
Well, still braving, a long position, but has to be hedged with a short one at that. SFWL, Steel Tips Wheels Limited. The moves on this one for the past 1 week have been phenomenal. What is more interesting, and I give more weightage to that, which is the volume action. If you see the volume action for the past 5 days has been nearly double of the last 20-25 days of volume action on this one. Right now being unfazed by what happened in the market, albeit some of the highs of the day, but I think this momentum could well continue. So from a near-term perspective, 231, 236 are your targets, 219 is where you place as stop loss. On the short side, I think the metal stocks are starting to see some cracks. JSW Steel dearly trying to hold on or regain the 200-day moving average, but hasn't really been able to. Today also you're seeing some downward pressure on this one. So for targets of 950 and 940 with a stop loss around the 970 mark, could consider a sell on JSW Steel.
Right, so that's a sell call coming in terms of where JSW Steel goes. Kush, stay with us. In fact, let's also welcome in Dilip Bhatt, founder at Pedigree Advisory. Dilip Bhai, good afternoon and welcome to the show. Hiral on this side. An interesting day to speak to you as well, taking into consideration the geopolitical issues that we heard of yesterday in terms of Indo-Pak. You have a positive in terms of the India-UK FTA. And now you're talking about US-UK FTA as well, which in some fashion could benefit some of the sectors. Taking the way markets are panning out and the way the earnings season has panned out, where would you place your bets in terms of valuations currently? Do you think this is the time to look at stocks and start nibbling in?
Hiral, always a pleasure to interact with you all. And it's nice to see you back. Hiral, I think overall we are seeing a lot of developments. So there is bound to be some knee-jerk reactions. So like you mentioned about the India-UK FTA deal, and possibly the buzz is that maybe US also will sign a similar one with a deal happening with UK. So I think some of these may generate a knee-jerk reactions, but the real point to be seen is that how much of it, if you go through the nitty-gritty, how much of it is really going to be very beneficial. Very early days to really make a call on that, because even regarding UK FTA deal, I think there's only a summary which is available. There is no details which are available at the moment. Of course, summary gives a very broad idea. Now, looking at the geopolitical state that we are into and looking at the valuations, I don't think that one need to be really in a hurry to commit into this market, because valuations certainly are not cheap and geopolitical issues are yet to play out properly. Not that I'm thinking that it's going to deteriorate or I think it's going to go worse, but we do not know. These are, these are the realms of uncertainties that we are talking about. So what I would say is that looking at the overall picture, looking at the valuation, of course, the positive side is that the dollar has stopped appreciating. Rupee has stopped depreciating, to put it in a better way. I think that is a positive. Oil is a positive. But I think even the GDP revival is quite nascent at the moment. And here I'm very firmly of the view that if all said and done, if the GDP growth is between 6.5%, I don't think that it will have any great impact positive impact on the corporate earnings. So I would say that India needs more than 7% on a very sustainable basis if the corporate earnings have to revive and roar back. But otherwise, given the situation, I think I would prefer to wait and watch, let the things play out. Even if let some certainty come amidst so much of too many moving parts, after that maybe one can take a call. But right now, I would prefer to be a very passive spectator on an overall basis.
Right, Dilip bhai, this is Harsh also joining in, and before I ask you my question, I just want to quickly point out to viewers, you have Bharat Forge's numbers flashing at the bottom of your screen. There is a consolidated number which is flashing. There's also a standalone number which is flashing. The console number largely seems slightly below estimates from a PAT perspective. The PAT on a standalone basis as well is down roughly 11% on a YOY basis. Revenue seems to be a strong number, especially on a console basis versus estimates. We'll give you better perspective on these numbers. Puneet will come in and speak about them, and we will have Amit Kalyani as well come in and speak with us. But back to you, Dilip bhai. Just trying to therefore understand, you've summed up the geopolitics extremely well. But how do you look at flows, and how do you look at the debt returns versus equity? So the equity risk premium in that sense, especially from an FII inbound perspective. When you're looking at the quantum that FIIs have put in, it's very, very solid. And large chunk of that is within financials at this point. Now, where will flows go in your view? And given that there are no rate cuts which are coming through, even from a US perspective, do you expect this kind of a rate of inflow from a foreign investor perspective to continue?
So Harsh, I would say that on an overall, if you see from an overall point of view, the FI inflow is a good relief after such a long spell of unabated selling. But what I understand is that the selling which happened and even the buying that is happening is largely on an ETF basis, on an index basis. It is not confining itself to any particular sector or as such. So I think that always is, the FI inflow is always more a function of how they view the US, how they view, on a relative basis, the opportunities. Like, just to take this point, we all were shouting from the top of the roof, all of us, that's what I mean, that India is the best place to invest, including all the FI broking firms were all telling us, and we all endorsed that. But look at the way the FI sold, unabated selling for such a long time, not just one-off kind of selling. So I think looking at this FII flows at the moment, yeah, it gives a good relief. And they always take it as a very tactical one, maybe on a relative basis where the valuation looks a little more attractive, rather than on a very secular basis that this is a very good place to invest. Having said all this thing, I would think that the FII flow has come back and it appears to be for real and it will be sustainable. That's what we think. And that, of course, will give a good support. Now, whether they are backing financials, largely what we have seen in the last couple of last 2 months, especially when the FIs have come, is that the Nifty has been pretty stable. So it is very clear that their focus is mainly on the frontline stocks, and with finance and bank contributing to such a big weight into the Nifty. So possibly they are buying one of those, they are buying, focusing on that also. So what I would say is Nifty has been pretty good, largely because of the good FI support. But market on a broader basis, apart from the Nifty, I think they are all over places. There is a good divergent trend. There is no definite trend available. So I would say, Harsh, that the FI will give a good support to the Nifty, but the broader market also needs a very good support, because that is where the large spell of retail investors are also positioned out over there.
Dilip, one interesting point that you made about FIs is, yes, they've come into the markets, but the trend that we're picking up is financials is where they've come in as a support. And it's not only FIs, DIIs have also come in a big way right now in the BFSI space. The second best bet usually when the FIs start coming is IT. What's interesting is that between March and April, FIs have seen an exit of almost $1.8 billion in terms of IT as a sector. Does this tell you, and the DIs have been positive though on IT, do you think that BFSI probably could be a sector for someone who's sitting on dry powder right now and they can start nibbling in? And if so, would it be private banks versus or PSU banks?
Sure. Hiral, as what you said about they're putting in a lot of money in the financial sector. So my take on this basically is that they are basically investing on an ETF basis, maybe in the finance sector also. And I think it's a top-down kind of an approach which they are taking, rather than on a stock-specific basis or on a sector-specific basis. So I would say one has to view the FI buying and the way the Nifty has held up also because of that. It has to be seen from that perspective. And as far as your observation on IT is concerned, yes, I think IT still continues to be presenting a somewhat a hazy, a nebulous, incohesive kind of outlook at the moment for everyone. Because once again, there are a lot of things happening out over there, and the US is certainly one of the strongest reasons, whether it's H-1B visa, how they are going to, whether they are going to spend so much on outsourcing. All those questions have come up right in front and staring at us. So what I would say is that IT is something which always merits a look, largely because they're very well-managed companies and their conversion to free cash from the PAT is from EBITDA to free cash is phenomenal. And they're holding on to their the ROEs, they've been coming down, but they're holding on to the ROEs. So I think all those factors gives you an attraction to buy some of these IT companies, possibly because they're well managed and may give some kind of resilience. But on a proactive basis, I think, say, for example, Coforge or I would say something like Persistence, they possibly give a good visibility in terms of the growth. But by and large, I think the IT also will not be a great place to get a proactive returns from this market.
Okay. Now, Dilip bhai, interesting, because I wanted to go domestic, and we've got an interesting view or a take which is coming through. How rural India's FMCG demand continues to outshine urban markets. It's grown at 8.5% in Q4 FY25 and versus the sluggish 2.6% which cities and urban areas are seeing. Let's bring in Sesha to give us better perspective. She also tracks FMCG quite closely. Sesha.
Demand in India's rural areas grew at a slower pace in the March quarter compared to the previous year. However, this growth was still 4 times higher than that in urban markets. Overall, the consumer goods sector grew 11% in terms of value during the quarter. Other than rural, 2 other trends that played out were higher demand in the e-commerce channel as well as small players gaining share over the giants. Now, most of the companies have disclosed their quarterly results, and we have already seen this trend with companies including Hindustan Unilever and Tata Consumer Products posting low to mid single-digit volume growth. Interestingly, low base, rural growth and easing inflation are helping small players to outpace these giants. Now, within the categories, while volume growth is slowing across categories due to price hikes hikes like in staples, non-food segments are still outpacing food. Nielsen also pointed out that the FMCG industry saw higher unit growth than the volume growth, which indicates a preference shift towards smaller packs amid price hikes. Urban metros are also experiencing a shift towards e-commerce led by higher online shopper penetration, more purchases online and larger basket sizes. The growth in e-commerce in metro cities, which is up nearly 40%, is volume driven and is outpacing traditional trades 2.2% dip and modern trades 7.7% decline.
So thank you so much for that, Sesha. Dilip bhai, coming straight to you, one of those very large trends that's playing out at this point is consumption. With this extremely large 1 lakh crore which has been freed up and put in the hands of consumers, consumption still doesn't seem to be picking up. What's your sense? Is it going to take more time? And if so, what are the pockets that you're looking to play consumption through?
So I think a very interesting analysis I just saw right now, and I mean last 1 month we have been trying to analyze this and trying to read this also. So I think the real good point is that the rural demand seems to be coming back. And at one point of time, if you remember, the rural demand was almost outpacing the urban demand. It was 1.7x times. So that was a kind of the difference. And somewhere over the last maybe 5-7 years, the rural demand started dipping because of the rural pain, whatever it was, and also because of the inflation. So I think all that now is behind us. Now, as what we said, that though the urban demand is reviving, albeit very in a very muted way, but more important is as the inflation sobers down, I think that will prove to be a good tailwind for the FMCG sector and especially for the consumer staples. So what I would think is, I would take these 2-3 factors into account: the volume growth becoming in the rural as well as in the urban, the softening of the commodity prices, and as usual, there will be some kind of small price hike being taken across during the year. So I think all that will get reflected in a larger EBITDA margin and also will play out good way on the bottom line. Yes, FMCG as a sector and consumer staples within that can give a good 15-20% return over next 12 to 18 months is what my broader guess is. And possibly some of those returns will get compressed in a possibly 1 or 2 quarters in the next 5 to 6 quarters.
Dilip, your view in terms of auto as well as auto Ank, taking into consideration the opportunities that are coming their way. I mean, Tata Motors, fabulous story right now on the back of the FTAs. But overall, how are you looking at this space if you have to divide it between passenger vehicles, two-wheelers and CVs?
Well, I think as far as the auto sector is concerned and narrowing down to the passenger car segment, I would still wait for more details to emerge. Yes, the first round with UK has been good for something like Tata Motors and maybe some of the auto ancillaries also. So I would say that in a way that has been good. But the valuations still continue to be very rich. And if you were to listen to what Mr. Bhargav of Maruti Suzuki had to say, and that also played out in a very interesting way as he analyzed why the demand can't really go up. And CM, which is their main body, is also talking about 3% growth. So somewhere I think this money which has been given in the hands of the consumers, even that possibly will not play out the way what at that moment of time we all thought it's going to. So putting all that into account, taking into account that the valuations are not cheap and most of the stocks are, they haven't really come down in any serious way. Auto sector is something which I will stay away. I'm not looking at it at the moment. I will prefer for some serious correction to happen before committing into auto sector, whether it's Maruti, whether it's M&M has done exceedingly well in the last 1 month and the last 1 year too. But still, I would prefer to stay away from most of these from the current levels. And as far as two-wheelers is concerned, I think a revival in the rural demand and maybe even the urban demand bodes well for the two-wheelers, especially the motorcycles. So that's a segment which one should look at, because the exports also will continue to the rest of the world, will continue in a good way. So I would say that Bajaj Auto or something like even TVS would look pretty good and interesting from the current levels on a longer term basis.
Okay, thank you so much, Dilip Bhai, for coming in, speaking with us and giving us all of those views. We'll let you go on that note. What we're also going to switch focus to, or rather bring back into focus, is Bharat Forge. Numbers came out, Puneet here with a perspective. Puneet.
Well, thank you for that. So for Bharat Forge, it's important to look at both the consolidated as well as the standalone numbers because the defense as well as the export markets are coming in the consolidated numbers. It's largely a miss on the consolidated side, specifically for numbers. When you look at the revenue, it's down by 7.5% at 3,853 crores. This number, the revenue number, has largely met estimates of roughly 3,300 crores, but the EBITDA, that's a miss on that front versus estimates. It's coming at 681 crores. The overall margin henceforth has fallen to 17.7% in this particular quarter, while the net profit is come at 282 crores versus estimates of 330 crores. So there could be some more details on fine print will be in the presentation, specifically on how the export market has performed for the company, because we have seen 3 subsidiaries of the company are loss making in the export markets. One's in the US, one's in the EU, and one's in the rest of the world. So all 3 are loss making as of now. So there could be some more details which will come in the presentation. It's not been uploaded yet on the NSE, but could be something to watch out for. On the standalone side though, which is the forging business, it was expected to be an absolute flat quarter on a year-on-year basis, and that's what's happened. Revenue, it's down 7% at 2,163 crores. The EBITDA at 28.5% is largely in line with estimates of 28.1%. With the net profit down at 346 crores. That's led by operating deleverage in this particular quarter. On the segmental side as well, the forging business is down 0.8% in terms of revenue, but the defense business has come down by 49%. So we'll have to talk to the management, and we are going to at 3 p.m. today on what led to this fall, or was there any exceptional item, because there's nothing mentioned in the results. But largely, the standalone numbers for the forging will be something to watch out for, because we've seen the Trump tariffs come in now. What will be the outlook? That will be something we'll quiz the management on. And if there's any kind of potential that fall that they've seen in April, specifically on that aspect. But results for standalone largely in line. But for the consolidated basis, there seems to be a couple of one-offs, when we'll await for the presentation for that.
Thank you, Puneet, for getting us the details. Harsh was just discussing as well right now that clearly the stock had taken a beating. It's revived a little bit as well right now. But in the last 1 month, 15% is the kind of gains that you've seen on a Bharat Forge as well. And if you see from an expectation perspective as well, the expectation was that your defense business would be a drag this time around on the domestic segment side. And it was mainly the passenger vehicle segment that would partially offset that kind of weakness in the CV business. So these were the 3 aspects we were considering, but we will get a clarification from the management as well at 3 o'clock. Let's quickly slip into a short break. Up next, we'll bring you the chatter behind the dealing room in our segment Heard on the Street with Samit Sarkar.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers. Welcome back. You're watching India Market Close, and it's that time of the show where we bring in Somit, who gives us a pulse of everything that's happening in dealing rooms. Somit, I'd be really interested to know that in the last half hour or so, we've seen a bit of selling pressure that's come in. Anything that you're hearing specifically from a larger market perspective, of course, apart from all the stock insights that you always
Well,
give?
from larger market perspective, the only reason that is worrying the market is the India-Pakistan conflict. That's the only thing that is worrying the street. There's nothing other than that. Obviously, stock-specific reactions that we see based on earnings is completely different. But yeah, broader perspective, the India-Pakistan conflict is the only thing that is worrying the street, and hence people are sitting on the sidelines. But stock-specific action, if you look at Paytm and Zomato, both the stocks are down in trade. The potential buzz on the street is that there could be a potential block deal that could come in from Anfin, which is the Alibaba Group company. Now, Anfin owns close to 9.85% stake in Paytm, while in Zomato or Eternal, it owns close to 1.95% stake. So keep an eye out for both these counters. For Paytm specifically, what I'm hearing is that the discount on this block could go as deep as 8 to 9%. When it comes to Aditya Birla Fashion, there are buy flows on mutual fund desk, and dealers are expecting some potential positive announcement to come in, or positive development to happen when it comes to Aditya Birla Fashion. For Aarti Pharma, there are buy flows in the counter on anticipation of some long-term order that could come in for its key product, Zenthia, I guess the name of the product is. When it comes to Chambal Fertilizers, dealers are indicating that large HNIs have been selling this counter at higher levels. In fact, at one point of time, Chambal was trading at around 730 rupees, and currently it's trading below 700 rupees level. Shakti Pumps and Zaggle, delivery-based buying seen in the large HNI counter, large HNI desk ahead of the Q4 numbers for both these names. Shakti Pumps and Zaggle will be reporting their Q4 numbers on May 9th and May 12th. So keep an eye out for both these counters in trade. And lastly, Goldem International. That is one counter where influential investors have started to accumulate this counter. Now they believe that this stock could be one of the beneficiaries of the India-UK FTA and the potential India-US trade deal, which is expected to come in anytime soon. So Goldem International is one stock that we need to keep an eye out for.
These are interesting names that one should be tracking. But what's interesting, Somit, is with regards to Aarti Pharma as well, because a long-term order for Xanthin will mean a big deal for the company, taking into consideration.
I was speaking to Varsha, and they said that this is the key product for the company.
Exactly, this is a key product for the company. So the stock, which is up almost 2.5% today, watch out for this one pretty closely. And the other two, which is Paytm as well as Zomato, a block deal by Anfin on both of them is also very interesting.
At least that is what they are looking at. That's what I've heard from the dealers.
So is that the reason why you have both the counters which are under pressure today?
Yeah.
So interesting ones there. In fact, before we welcome in our guest Pankaj Pandey, Head Research at ICICI Securities, and we have Khushbu with us as well. Asian Paints, margins at 17.2% is the number that you're tracking. Net profit at 692 crores versus an estimate of 1,075. That's something which is worrisome right now, the stock taking a nosedive as we speak, and that is a concerning area from a profitability perspective. EBITDA has come in at 1,436 crores versus a 1,565. So not a major miss on that front, but the profit number is concerning. Margins have also taken a beating, 17.2% versus an estimate of 18.2%. So a downtick coming in from a margin perspective as well. And Asian Paints considerably has been ruling under pressure, taking into consideration the market share erosion that you're seeing as well. So the expectation was of a muted quarter. There has been a fall in terms of urban demand, and the margins were expected to be under pressure. But this is something which is absolutely, I think the reason why the profit has fallen is what we need to see, because the versus number is a 1,275. So it's nearly halved, in terms of the profitability on a year-on-year basis. The margin number in the previous quarter was 19.14. The stock is coming back to positivity. So I think something is amiss over here, but clearly the demand that is subdued was expected to put pressure in terms of the top line. Margins at 17.2 versus a 18.2 is what you're tracking in terms of the estimates. So profit miss in terms of estimates, your margin miss in terms of estimates, and in terms of the revenue, the expectation was 8,612 crores. That number has come in at 8,359 crores. So all the across parameters, an absolute miss in terms of Asian Paints. Let's welcome in Pankaj Pandey and take his view as well. Pankaj, good afternoon and welcome to the show. A quick view in terms of Asian Paints. Three numbers which we have already seems to be an absolute miss across parameters. How would you look at it?
So I need to sort of look at the current quarter numbers, but off late, if you look at even last quarter, the volume growth was quite tepid at about 2% if I recollect it right. And on top of it, there is a margin challenge for not only Asian Paints, but most of the players, largely because the Grasim is offering 10% lower prices. So our sense is volume growth could take some more time to sort of recover, which is what we look at it from the commentary from some of the ceramic companies, the players in the home building segment. And overall sense is that for a company like Asian Paints, while yes, the valuations look attractive compared to a historical perspective, I think it's about less than 40 times at current on forward valuations. But from a top line growth perspective, earlier we were looking at mid-single digit kind of a growth and a flattish bottom line for the next 2 years. So at this point in time, we are still not sort of looking at this company from a constructive perspective. I think probably may not be more of a price correction, but time correction is definitely expected in the stock. So I think there would be better opportunities in the market than sort of chasing this stock at this point in time.
Right, Pankaj. Pankaj, what's the sense like with regard to how much would the price to earnings multiple need to correct? And I'm not talking about stock price correction, maybe a time-wise correction as well, for it to become reasonable in your opinion?
So I think, typically from a growth perspective, I think long-term growth for a paint industry is somewhere about 10-12% odd. And in case with a real estate cycle from T+2 or T+3, if you look at, and if the numbers come to say 12-13% odd, somewhere down the line, 2.5 or 3 times peg is what we would look at. But for that, I think the growth needs to come back first, and we are still not sort of seeing signs of it. Till the time that does not happen, I think we would not be really looking at it even from a 2.5 or 3 time peg.
Right. In fact, we have my colleague Mahima, who tracks this space pretty closely, joining in as well. Mahima, what are you picking up? I mean, a major miss in terms of profitability, margin front, and the top line. What has not worked?
Right, so absolutely, it's a miss on all fronts for Asian Paints. In terms of revenue, it's down by 4.26 odd %. The estimated number for revenue was around 8,600 odd crores. It has come to 8,358 crores. In terms of the overall numbers, EBITDA is down 15 odd percent, which was expected around 1600 odd crores, which has came at 1436 odd crores. Net profit down 44%, almost 45% at 692 crores. But there is an adjustment of exceptional item of around 183 odd crores. So adjusted PAT is down by about 30 odd percent. Margins were expected at 18.1 odd percent, which has come at 17.18%. So disappointing numbers yet again for Asian Paints. In terms of key highlights, the decorative business saw volume growth of around 1.8 odd percent. The management has reckoned to the fact that muted demand, consumer sentiment and down trading and higher competition has impacted revenue. Higher competition is important to emphasize because now they're acknowledging the fact that competition from Birla Opus as well as peers like Berger Paints is coming in. Industrial business has grown 6.1 odd percent in Q4 on account of good growth in general industrial and auto segments, and overall home decor categories saw muted performance with pressure on household disposable income. Lastly, in terms of international business, that has registered a value decline of around 1.5 odd percent. Headwinds from challenging macroeconomic conditions in Africa are playing its roles. In terms of key markets of Middle East and Asia, they did well on a constant currency basis. International portfolio overall revenue growth was at 6 odd percent for this quarter. So this is the overall view as to how Q4 has panned out for Asian Paints. Of course, not a very good quarter for Asian Paints yet again.
Absolutely, Mahima, because clearly, I mean, their estimation was that FY25 they will see double-digit volume growth, but does not seem to be the scenario, because in the first 9 months itself, the volume growth was around 3%, and this quarter numbers are not anywhere alluding to that kind of a number. And if you see in terms of the value growth as well, the first 9 months was around negative 4.8%, so that's a concern on that front as well. And very lastly, if you see in terms of the FIs, they have been reducing stake. Promoters' pledge has been increasing. The only aspect over here was that the stock has been trading below the 5-year average of 57 times. The trailing 12 months was at around 43 times in terms of Asian Paints, and 5-year average of around 57 times is what you should be looking at Asian Paints. So that is what is below, but does not seem to have any buying interest, taking into consideration the way numbers have panned out. Kush, very quickly, what are charts indicating on this counter? Because 1 year the stock is already down 13%, around 10 to 12% away from its 52-week high as well, and it was trading below its 200 DMA.
I think more worries continue for this one, because even on the way up, it wasn't a tearaway rally, especially on a big name like Asian Paints. Right now, it's just slipped below the 50-day moving average. But what I'm more concerned about is the resistance, which comes in at 24.75 for the last 15 odd sessions. It's not been able to take that out. Negative divergence is popping up and high volumes on the way down. All these factors suggesting that it might, even if it does kind of hold ground, after this kind of fall that it's seen over the last 3 sessions, including today, it might just consolidate sideways. So the levels to look for are 22.50 on the downside and about 24.75 on the upside. This could perhaps be the broad range for the stock going forward.
Okay, so that's on Asian Paints. Escorts also, the numbers coming out, flashing at the bottom of your screen. No reaction on the stock per se. Okay, you're seeing that reaction on the stock. It's a strong beat with regard to where numbers are concerned. Profit after tax is a strong beat. 293 crore is the EBITDA number versus the EBITDA estimate of 273. So a marginal beat there. And net profit at 297. Rather 200, the revenue is at 2,430 versus 2,423 was the estimate. EBITDA at 293 versus 273 was the estimate. And margins at 12% versus roughly 11.3 was the estimate. And I'd wait for that profit after tax number to come through. Just going to wait for that. The estimate was 239.
It's above.
The actual is 297. Correct. So thought I misread that. Yeah. So 239 versus 297. So strong beat with regard to that number as well. So very, very strong numbers coming through with regard to Escorts as well. But, I'm going to go across and Kush, take a view with regard to a Niva Bupa, because that stock is perked up in trade around 12 odd percent. I know it's a newly listed, maybe you very, very limited, a time frame in terms of giving us data. But what's it saying with whatever less data that we have? And thereafter, I also want to take a view, because we're talking about standalone health insurers, about Star Health, because plenty of buzz around that stock as well.
So, Harsh, starting with Niva Bupa, I think this stock has its has had its share of consolidation, good base around the 70 mark, and then reviving from there. From a very near-term perspective, I think there is a good support zone at 85.5. As long as that is maintained, I think the stock could perhaps resume that uptrend. That started somewhere in the early April phase, and then with market wisdom, the stock has corrected a bit. But I think as long as 85.5, that zone is respected, I think the stock could perhaps head higher. Today, also on the back of very good volumes, the stock rose, but it's come off the 93 level highs that it was seeing. But that's all right, considering where the rest of the market is. I think if you have a position in this, you should continue to hold on. Keep a slightly deep stop loss close to the 82 mark. For any fresh positions, I think that could act as a stop loss with targets around 93 and about 99 odd levels. So I think this is poised for a nice up run after the kind of consolidation it's had. Star Health, on the other hand, has given way from the rally, but on the back of very strong volumes. The volumes in the last 4 to 5 sessions have been very, very significant. So I would suggest wait and watch on this one. And the level of 340 is a very crucial one. If that gets broken in this kind of a downturn, then I'm afraid that so much lower levels of 320, 325 will also come into play.
Pankaj, do you have a view with regard to standalone health insurers? Star Health, of course, relatively older in terms of its listing than a Niva Bupa, but either or, would those at all come on your radar?
So within non-bank space, what we like is more of AMCs. So while insurance companies do look attractive, whether you look at life insurers or general insurers, valuation definitely is attractive. But say, for example, in auto, we are still sensing a good amount of price competition. Health is somewhere, this is a far more better growing segment. But sum total, I think somewhere down the line, feel that the AMCs are far more better, easier businesses to sort of understand from a customer perspective. And since we are bullish on market, I think this looks that space looks a lot more better to us with players like HDFC AMC or Nippon AMC looking attractive to us.
Pankaj, stay with us, and Kush, stay with us as well. We're just picking up an update from the Ministry of Defence, where Indian Armed Forces targeted air defence radars at a number of locations in Pakistan. Indian Armed Forces have neutralized the air defence system at Lahore. This is what we are picking up so far. In fact, Sajid is joining us to get us more details. Sajid, what are you picking up from the statement that has come in from the Ministry of Defence so far?
So, last night, Pakistan engaged and attacked some of the military installations. If you remember, the statement made by the Indian government was that it was non-escalatory in nature, and none of the military installations were touched by the attack that we did as part of Operation Sindur.
Correct.
But last night, there has been an engagement by Pakistan at a number of military targets in northern and western India, which includes Avantipura, Srinagar, Jammu, Pathankot, Amritsar, Kapurthala, Jalandhar, Ludhiana, Adampur, Bhatinda, Chandigarh, Nal, Phalodi, Uttarle and Bhuj. So all the way from line of control to international borders, some of the key installations of Indian military installations were attacked by Pakistani drones and other missiles, and this was thwarted through India's air defense system. And as part of today morning's action by the Indian Armed Forces, India also retaliated in the same measure, leading to some casualties which happened at the Pakistani side, including it is learned that the air defense system at Lahore has been neutralized, and that's something, some of the reports, which unconfirmed reports which we were getting since morning, that there has been some explosions seen in Lahore. That's coming in from there. Pakistan has increased the intensity of its unprovoked firing across the line of control using mortars and heavy caliber artillery in areas of Kupwara, Baramulla, Uri, Punch, Mendar and Rajouri sector in Jammu and Kashmir. So the proportionate of firing has also gone up, and now artillery and heavy artillery is getting used. The army statements or the MOD statement says that 16 innocent lives have been lost, including 3 women and 5 children, due to Pakistani firing. And India has been compelled to respond with mortar and artillery fire from its side to Pakistan, so that it comes to a halt. So Indian Armed Forces reiterate their commitment to non-escalation, provided it is respected by the Pakistani military. So it's an equal measure response coming in from the Indian side after many of the military installations were attacked, which was defended by some of the air defense system of the Indian Army.
So clearly, I mean, the attempt that Pakistan has been making in terms of escalation, it seems that has been negated as well right now. Now, whether this is Operation Sindur Phase 2 or not is something we need to know. But let's also get in Aishwarya, my colleague, to get us more. Aishwarya, what are you picking up in terms of the statement that has come in from the Ministry of Defense, where Pakistan's bid to escalate seems to be negated?
Well, this is huge in terms of response to Pakistan retaliation. Rajnath Singh, Defence Minister, while chairing the all-party meeting today, stated that it is Operation Sindur, which is ongoing and it has not ended. And these are the details of Phase 2 of Operation Sindur. Very, very important to note is what the official release from the government which has come out, that it was specifically mentioned, remember yesterday in the press conference, that India's response was not against the Pakistani military, but India's strike was on the Pakistani infrastructure of terrorism. The terror hubs were demolished by India's strike, but it was reiterated that any attack on military targets in India will invite a suitable response, and India has responded very, very strongly. These details are huge, as it stated that on the night of 7th and 8th of May 2025, Pakistan attempted to engage a number of military targets in northern and western India. It has been stated about the cities that were under the attack by Pakistani military establishments. The cities, namely Avantipur, Srinagar, Jammu, Pathankot, Amritsar, Kapurthala, Jalandhar, Ludhiana, Adampur, Bhatinda, Chandigarh, Nal, Falodi, Utralai and Bhuj. These are cities from Punjab and Jammu and Kashmir, and these were under attack using the drones and missiles by the Pakistani military establishment. They were neutralized by the integrated counter of UAS grid and air defense systems as well. The government has also stated that Indian armed forces and Indian defense radars and systems of a number of locations in Pakistan had been demolished. India's response has been in the same domain with the intensity in Pakistan, and it has been reliably learned that Indian air defense systems in Lahore has been neutralized. That's very, very important target that India had used. The air defense systems and radars have been neutralized in Lahore in Pakistan as well. It has been also stated that India is giving a befitting reply to the artillery action along with the line of control we are witnessing on every day, and since last 2 nights the artillery response is being given by the Pakistani troops along with the line of control. The ceasefire violations are happening and India is reacting it very promptly. Also the release states that because of these ceasefire violations, 16 innocent Indians have lost their life. This involved at least 3 women and 5 children due to the Pakistani firing. So innocent civilians also losing their lives because of the ceasefire violation, along with the line of Kapurthala, Baramulla, Uri, Poonch, Mendar and Rajouri sectors in Jammu and Kashmir. And the last line, which is very, very important to note in this release by the government, Indian armed forces reiterate their commitment to non-escalation, provided provided it is respected by the Pakistani military. India has already made it very clear that India had not attacked the Pakistani military. In the phase 1 of Operation Sindur, it was the Pakistani terror hubs that was demolished, and no military area was under attack by India. But in the response that Pakistan military establishment has used, cities of Punjab and Jammu and Kashmir was under attack, and India has retreated and reacted in a very prompt way, effectively, and demolished the air defense system, the radar system in Lahore in Pakistan as well.
Thank you, Aishwarya, for getting us all the updates. What's interesting right now is you have the Pakistan stock trading, which has halted as its frontline index slides almost over 7%. Pakistan's Karachi 30 index has fallen 10% in the last 2 days as well. And if you see in terms of Indian markets, we are at the day's low. The border areas are remaining on high alert. VIX has seen a significant spike as we speak. Can we just get the VIX up on the screen right now? It's over 10% actually. It's exactly. This VIX is up over 10%. We've gone beyond that 20 mark, 20.86 at the day's highs, a 10% up move coming in terms of VIX. And that's actually indicating the kind of volatility and the kind of cautiousness that is coming in terms of our markets, the nervousness that is coming in as well. Sajid Harsh, clearly, I mean, this is something which was anticipated, that yes, there could be something that could be coming in, but it's a strong retaliation that India is giving to Pakistan's response as well right now. And I don't think so this is going to stop.
If you look at the statement that came out yesterday after Operation Sindur, they made it very clear that it was a non-escalatory in nature. They haven't touched either public places or military or economic facilities. And while it was anticipated that, if Pakistan is to react to this, there isn't any, terrorist camps in India. So the only thing to attack was military facilities in India. And that's what happened last night, the night of 7th and 8th, where they have attacked almost all frontline posts or military facilities along the line of control and international borders. And what has happened today in the morning is the retaliation from India's side, and in equal measure, and that led to neutralization of the air defense system in Lahore, which is a very important base for the Pakistani military establishment, and it's also very close to the border as well. Earlier in the day we saw National Security Advisor Ajit Doval meeting the Prime Minister and and he was trying to inform the Prime Minister of what is happening there. We were not aware of what kind of measures has been there, though in social media and other things there has been a lot of talk about explosions heard in Lahore. It was not clear where it was coming from, but now we understand that it was a countermeasure which has happened from the Indian side after all the military installations were attacked.
And in spite of all of this, if you see Indian armed forces, they are reiterating their commitment to non-escalation, provided it is respected by the Pakistan military.
And they were very, and this time they are very categorically stating the military. You look at the statement; it's not saying the Pakistan government or something; it's saying Pakistani military.
Correct, because clearly Pakistan has increased the intensity of its unprovoked firing across the LOC, using mortars and heavy caliber artillery, and this is in areas in Kupwara, Baramulla, Uri, Poonch, Mendhar, Rajouri sectors in J&K. And because of this, you have 16 innocent lives that have been lost. This includes 3 women, 5 children, and this is on the back of Pakistan firing. India has been compelled to respond to bring mortar and artillery fire from Pakistan to a halt. And what Indian armed forces, I reiterate, are saying is that their commitment to non-escalation continues, and this is provided it is respected by the Pakistani military. Now, here clearly you have Pakistan, which is not really, setting themselves aside. They are engaging, and that is what is going to be the concerning area from here on, and that's what is being reflected, in the markets as well, because 20.82, a 10% up move coming in terms of where the VIX goes. Let's get a quick view from Pankaj as well. Pankaj, how are you reading into this, taking into consideration the kind of reaction that we are seeing in the markets as we just discussed from what's happening on the line of control?
So what we have been advising to our clients is that it is very much possible that if this escalation continues, there could be a knee-jerk reaction or some downtick in the market. But our sense is that over a period of time, next coming months, most of this would be recouped given the strong macros which we are carrying. So according to us, it's a sort of an opportunity to sort of build portfolios if someone has missed the opportunity of not really participating at the bottom of, say, 21,700 kind of a levels. Probably this could be one of the last opportunities which could be available. Otherwise, structurally, we are quite, or trajectory-wise, our sense is that markets are headed higher only.
Kush, what's your sense with regard to levels at this point?
Fairly similar, Harsh. I think this is what the subtleties of the market were indicating that we spoke of at the beginning of the show, where the breadth was worsening and the VIX spiking up. I think some of it was getting priced in a little early. I maintain the same view where 24,200 is more of a line in sand. The more meaningful support comes in close to the 24,000, 24,050 mark, and the 23,800, 24,000 other zones to watch for on the downside.
Okay, interesting. And
yeah, I was just talking, Kush, anything that the VIX is indicating right now, because 20.71 is what you're tracking. It's again cooling off to some extent. Any cues that you're picking up on that front?
About 15 to 18 weeks is something what I consider healthy. You need that kind of a move for the markets to remain volatile and traders to make money. 18 to 20 is that orange territory where things start to heat up a little. Beyond 20 is where you have to be a little more cautious. The cooling off that you've seen just now is perhaps more on account of expiry. I think once that is over, we'll get a clearer picture tomorrow. But if this sustains above 20, I think the fear factor in the market will remain slightly elevated. So that's the level to watch for. 20 is the level which should not be exceeded, or it should not be exceeded for more than a couple of days. Else you will see some elevated tensions in the market as well play out.
Pankaj Murarka also joining us, CIO Renaissance Investment Managers. Pankaj, hi, Harsh here. I want to quickly try and understand from you, what is it that you believe will play out, and what is it in the sense that how do you believe markets will respond? Because there's just so much money sitting on the side waiting for a likely event which could see a correction. Do you believe that we could see a substantial correction at all?
Hi, Harsh.
Hi.
Well, Harsh, it's an evolving situation. We need to watch out for it because, yes, the situation is fluid and fragile. Having said that, I still believe that we don't see that this issue escalating into a full-fledged war. But having said that, we need to acknowledge that there is a new normal in terms of India's defense doctrine. And especially given the fact that we have a troubled neighborhood, I don't see this event, or I think probably the new normal could be a sustained escalation. I don't see that having a major impact, economic impact on India. India as an economy is extremely resilient, and now we have the fifth largest economy in the world. So we're pretty large from a global perspective also as an economic enterprise or as economic power. I don't see that impacting India's economy in a meaningful manner in that sense. And I think India has the resilience to withstand this. So given that context, I think there could be some short-term pullbacks in the markets, but investors should take a slightly more medium-term view. And that pullback should be used as an opportunity to put money to work, taking medium-term outlook or keeping a medium-term view in perspective in that sense.
Right. Pankaj, good afternoon, Hiral on this side. Now, taking into consideration the escalation that Pakistan is looking at right now, though the Indian armed forces have been able to neutralize the same, do you think this is going to be something that the markets will be worried about from here on, and you will not see that dry powder which is lying being deployed and it is going to be consumption that is going to be taking a beating then?
Well, I'm not a defense expert, but my base assumption from what we are seeing, or all of us have seen and read about in terms of situation, I think there is a new normal, because we have been and will continue to have a troubled neighborhood. And it's always challenging because we are the only country in the world which shares physical borders with two nuclear powers. No other country in the world has that kind of geographical configuration that we have. So I think probably the new framework is probably a sustained escalation. So we have to get adjusted to it. And in that context, I think there could be, given the fact that from an equity market perspective, I think given the fact that we've had a very sharp rally in equities in the last 4 weeks, people might want to take profits, and there could be some pullback in the market. But as I said, I think that's a good opportunity for people to put money to work. I don't see this in any meaningful manner impacting India's economic prospects over the medium term or long term. So I don't see this spiraling to an extent where it can have a negative rub-off effect on India's growth prospects or long-term growth prospects in that sense. So I think all of that, in my base assumption, still remains in place, and which is why I say that any correction should be used as an opportunity to put money to work into markets.
So Pankaj, which are the sectors would you say where money should be deployed, taking into consideration the current correction that you're probably seeing?
We've been positive on consumer as a sector. We've turned positive after a long gap of almost 3 years. So consumer is one where we see a gradual recovery in consumer spends in India coming back over the course of this year and over the next 2 years. We have quite a few drivers of that. One, aggregate consumption is on a low base, and given the fact that we have inflation which is moderating in India, we've already had 2 rate cuts from RBI and probably another 2 rate cuts during the course of this year. We see a meaningful recovery in consumption spends in India. So consumer as a sector from an equity market perspective looks attractive because the sector has underperformed in the last 2 years, and valuations are pretty much in line with long-term averages. So that's clearly one we like. Also, it's a defensive as a sector in that sense and has downside protection. Apart from that, we like financials as a whole, both on the lending side, which is banks, and on the non-lending side, which are capital market-oriented franchises and insurance, right, because the underlying tailwind of growth in India.
Pankaj, I'm going to interrupt over here. We also have Major General G.G. Dwivedi, retired Army veteran. Sir, good afternoon. From the information that we are picking up from the Ministry of Defense, you have Pakistan who tried to escalate, but that bid has been negated and a proportionate response has gone from India. What would you have to say to this?
Well, first and foremost, I think this response was required because India has been faced with this proxy war for the last about 3.5 decades. And mostly their strategy was to fight this proxy war, mostly on the line of control or in the hinterland. And I have operated extensively in these areas. But the current issue is that Pakistan has not mandated trade. So therefore, there has to be change in strategy. And this time around, after the Pahalgam massacre, the Indian government has gone in for a very holistic strategy. That is, that we need to tackle it at the multiple levels. Diplomatically, of course, a number of actions were taken. Politically, we also isolating Pakistan. But more importantly, until there is a matching punitive response, means military response, it won't have taken a message through. So this response is very calibrated. There's no sense of alarm. We have chosen very specific targets, which are basically terrorist infrastructure. We also ensured there's no collateral damage. And the response has been very, very, I would say, calibrated, means that it's not overwhelming. Only 9 targets have been selected. And therefore, I don't think there should be any sense of alarm as far as the economy dimension are concerned. Because the Indian economy, is primarily consumer-driven economy. And our vital are doing very well. And internationally also, there's no panic or alarm. So I think the situation is very stable. It's only defensive action we have taken. The international community also understands our compulsion to take the action. And more importantly, we have drawn a new red line and given a very strong message to Pakistan And in case they don't mend the ways, then we will be now taking the war across the line of control and hitting at the very nerve centers of the terrorism. Over to you.
Major General Dwivedi, we also understand from unconfirmed reports, and ANI is reporting that India had to use S-400, missiles, missile systems to neutralize some of the incoming missiles from Pakistan. This seems to be a major escalation and beyond the artillery or high caliber artillery which is currently being used. Do you think that there's a chance that the escalation will now increase, given that the kind of weaponry now is being used by Pakistan?
Sure, very right, because so far our action has been, as I said, primarily around the line of control. And there mostly weapons used were infantry weapons or light artillery. But now this, threshold has been crossed. And today it is a shooting war across the line of control or the international border. So therefore, when in such a situation, currently it's mostly aerial strikes. And you have to use all your weapon systems to ensure that your airspace is well protected. And India has acquired a very potent weapon system, S-400, which gives you high degree of security against the hostile aerial strikes. So to that extent, yes, the threshold has been now elevated. And from the purely, artillery and ground weapons or the weapons, now the weapon system has been escalated, and this is escalation. But then again, please remember that it's very selective. It's not all out. It's very selective targeting, very calibrated. Targets are calibrated. Weapon systems also are very specific. So therefore, when you talk about the escalation ladder, the bottom line is like what you said, artillery, infantry weapons. The next comes the aerial strikes. Now we are somewhat, I would say, at level 1 or 2 escalation, and there can be many more. But right at the moment, I think it is very well calibrated. It is under control. Hello.
Yeah. We also are getting reports that the Lahore US consulate has already advised its citizens to leave areas of active conflict or shelter in place, and especially if they are near the Lahore main airport, the area should be evacuated. This seems to be a larger escalation in place, especially with respect to the kind of response that has come in from Pakistan, which has targeted almost all frontline military facilities along the LOC and international borders, and as a result, India had to respond in equal measures.
That's right, because military installations or military defenses assets are firstly along the border, and then also they are in the interiors. And you cannot actually, let's say the big cities, you cannot have a very clear-cut, line as to where the military assets are, where the civil assets. And also, as far as the airports are concerned, they are used for both purposes. What we call dual use, even civilian assets are used and the military assets are used. So, as a precautionary measure, because you don't want your civil population to suffer, you don't want your civilian citizens to be affected. So, as a precautionary measure, you take certain actions, and those areas are points where there is a close proximity to the military targets. There's always a procedure to either thin out or relocate the civilian population, or at least warn them and take certain civil defense measures, which India also practiced, that in case there is strike on civilian targets, but then civilian population must know how to act. And one more important factor, you see, we have targeted the infrastructure of the militants or the terrorists. But India has no such, infrastructure, because we don't believe in terrorism, and we have no such locations. So Pakistan is going to find it extremely difficult to pick up the targets. So in that case, they are quite likely to engage in civilian targets because we don't have any terrorist-related targets. So to that extent, India also has to be very, very cautious to ensure that our areas which are vulnerable or which could be targeted, they are specified, and we take necessary actions as civil defense measures, right?
Okay, sir, stay with us because we have Mr. Manmohan Bahadur also joining us, Air Vice Marshal, retired Air Vice Marshal of India. Now, in terms of Mr. Bahadur, first off, welcome. Thank you so much for coming in and speaking with us. So I want to first understand from you, India has had this stance all throughout that we do not want an escalation. Does this tip the balance in your opinion? Is this now gone to a phase where it could be called an escalation, or could we expect something like a prolonged escalation as a result of everything that's happening?
Thank you for getting me on the program.
It's absolutely our pleasure. Thank you.
What you need to do is read the government handout which has just been given out by the PIB, which states that we have taken these measures, which is due to the fact that the Pakistanis attempted to strike military installations last night, the night of 7th and 8th. And we have very clearly stated that this is not an escalatory, and it's not an escalation of us. It's actually news to almost everybody. The fact that they attempted to strike Indian military installations all along our western border, down south to Rajasthan. So, and they were intercepted. The missiles were intercepted, including their drones, by the integrated air defense setup that we have now got. And that's a very effective setup that we have. And the fact that there has been no damage on the Indian side, neither claimed by the Pakistanis, shows that how effective our response was.
So apologies, sir, your audio is not coming through fully. So what we're going to do is we're going to try to repatch your line, and while we are at it, let me go back to Major General Dwivedi with the same question. So what's your sense? Do you believe that a prolonged escalation is now a very real possibility?
Well, first and foremost, we must understand that what is India's political and military intent, and that is to deter Pakistan and defeat the proxy war, which I said has been there for the last about 3.5 decades. So if that has to be done, it's likely to be prolonged. It's not going to be one odd strike like tit for tat, because Pakistan also is a nation which has very hostile and very aggressive stance. So therefore, they have tried to react, and as I was mentioning that in India, we don't have any targets of terrorist-related targets. So therefore, they would like to target either civilian assets or target our military assets, and that's exactly they try to do. And our air defense system has been very effective, especially S-400-based system, that we have been able to neutralize most of the hostile strikes. The point is that I think 2-3 things must be understood. First and foremost, India has decided that we need to deter Pakistan and we need to defeat their proxy war. So therefore, it's not going to be 1 or 2 day affair. It will be a long affair. Secondly, Pakistan is a nation which is aggressive, a rogue nation which doesn't have any very logical strategy. They will do tit for tat, and therefore India will respond. But overall, I feel that it will remain at a certain level of escalation. I don't think it will turn out to be an all-out war, but it is more than the previous escalation, which are only specific to the borders. But today, it is specific to the other assets which are in the hinterland. So we can expect, more such action, more such strikes until Pakistan makes the base. We are not the aggressors. It's Pakistan. So world community also has to come in and put some sense into the Pakistan head that this is not going to go. And that's exactly the message India is trying to communicate to Pakistan. Either you mend your ways or you face the music. Over to you.
Right. Thank you, Major General G.G. Dwivedi, Army veteran, retired Army veteran, for getting us your views as well. But clear indication that this is not something that will end here. A couple of more days where this will continue until sense prevails, within where Pakistan goes. But let's quickly slip into a short break. We'll be right back with all the market update, where VIX is up 10%, Nifty and majority of your sectors are at the day's lows. Please stay tuned.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back to India Market Close. We have Rajesh Palvia joining us on the show from Axis Securities. Rajesh, good afternoon. We're just around 5 to 7 minutes away, but the key levels you should be tracking currently, taking into consideration the kind of downtick that's happened in terms of markets on the news from the Ministry of Defense. But 54,275 in terms of Bank Nifty, and we are below that 24,250 mark on Nifty 50. What should the strategy be?
So there is a sharp, knee-jerk reaction in the market, and now Nifty is approaching towards its critical support area of 24,200. If any breakdown happens below 24,200, can take Nifty further lower to 24,000, even 23,800. That's the next major support area on the near-term perspective. Put-based concentration is placed at 24,200, 300 strike, and now looking at the data, we believe that if we sustain below 24,300, I think there is a possibility that we may break 24,200 and downward target can come towards 23,800. Even for the Bank Nifty, the major support area was at 54,500, and we are trading below to those levels. So if Bank Nifty also sustains below to 54,500, there is a possibility that Bank Nifty may also slide further. 53,700 to 53,600 would be the next target on the lower side. As across the board, there is some serious profit taking is happening in the market, as the market is a little cautious due to this geopolitical tension. So I think this volatility and some profit taking would continue further in the coming days also.
Okay, so that's with regards to Nifty as well as Bank Nifty as well. Rajesh, in this kind of a market, would you have any BTST, STBT calls?
So I think there are two STBT calls again on the banking space. Union Bank can be looked at to go short, as stock has broken the important support area and now trading below to previous swing low. So Union Bank can be short for downside target of 109 with stop loss of 119. Another stock again on the short side, that is REC Limited. A stock has broken its 50-day moving average in this fall. Looking at the structure, we believe that furthermore weakness we may witness towards 380. So 380, 375 are the downward target for REC Limited. One can go short with stop loss of 402.
Interesting. So those are the calls coming through as well. Now, in terms of where the pain is absolutely real, it's within the broader markets, and let's pull up some names, some stocks where we're seeing some real pain. I'm going to just quickly look at the Nifty mid cap, which has now slipped 2.1% as we speak. CCL products now 6% down. Poly Medicure is down 6%. Paytm is down 5.5%. Varun Beverages down 5+%. Rajesh, while we are at it, quick take with regard to a Varun Bev on charts. How is it looking?
Again, stock is also shown the same reaction. Looking at near-term structure, I think stock is now trading near to critical support area of 480. If any supply pressure comes below 480, then the lower side target around 460, 450, we may see in the continuation of this down move. On the higher side, 500 is the major supply zone at this juncture. So keep eye on 480. If it breaks below, then I think 450, 460 target would come.
Regards to where Varun Beverages go, 5.5% downtick coming in on that front. How are you looking at the heavyweights in terms of the banking names? HDFC, Kotak, Axis, ICICI. What should the play be?
So I think in the private banking space, still ICICI Bank and HDFC banks are still, both banks are still holding the near-term support area. And I think here strength is still visible. But some of the stocks from the PSU banking baskets are showing the weakness. So from the private banking space, ICICI Bank and HDFC Bank can be, buy in the decline. So for ICICI Bank, the important support on the downside is placed at around 1390 for 1380 zone. So if that level comes, one can review around those level. And if it's not break, it's again, buying opportunity in the stock as overall structure is bullish. And for HDFC Bank also, if stocks corrects further towards 1900, 1880 zone is again, good support area. That is coincide with the bullish gap area for the HDFC Bank. So that may act as a support for this decline. But time being, I think one should wait for this correction to happen. Let the market to settle down because the selling pressure is very intense at this juncture. And I think these stocks may also, witness some profit taking. So wait for, stock to settle down around support levels.
Okay, thank you so much, Rajesh, for coming in and giving us your views. And of course, it was a very delayed entry even for you. So thank you for bearing with us. But just in terms of how markets have taken shape today, Hiral, it's a fascinating intraday chart. If we could pull that one up, 1% lower on the Nifty. We've now slipped below 24,200, which was a critical support point, mind you. We've slipped below it. Now the question will only be that is this only going to be for a few minutes and do we open gap up tomorrow or not? But for the moment we're below the 24,200 mark and sliding fast, 1% lower. Let's pull up the contributors as well, and it'll likely be the heavyweights because pretty much everything's sitting in the red as it is. HDFC, M&M, Bharti, Eternal are the four key contributors in terms of how the Nifty has shaped up today. Let's look at the heat map as well before I toss it across to Hiral for the broader markets. Look at the carnage. I mean, we've seen 2% plus, around 12 stocks sitting in the red. But if I just take it 1.7 to 1.9, we're seeing nearly 10 odd stocks sitting in that range. So plenty of pressure, and more than 1.7%, nearly 20 stocks are down more than 1.7% on the Nifty 50 index. No direction per se, no themes playing out. It's just a little bit of pressure that markets are under, given everything that's evolving between India and Pakistan. Hiral.
VIX is seeming absolutely interesting. Yes. We were at above 20, it's cooled off below 15. Is this telling you anything, or the number? I mean, 21.
It's
okay,
15% higher
right now, right?
Yes,
21.86. So there is a major spiker, and this is telling you the story of what's happening. With this, let's look at the mid cap and the small cap index, because that is where you'll see the correlation and the pressure building up. There you go. Major cuts there. More than 2% is the kind of cuts that you're seeing in terms of Nifty, mid cap 150 on closing, and the small cap index at the day's low, 1.7% is the kind of cuts. So, that broad-based buying that you are seeing in the broader markets, that's where the fear has also gripped in right now as we speak. So that's what the pressure point's looking like. Let's quickly look at the sectoral picture as we speak right now, because no trends, but it's only media which is just on the borderline. But real estate, metal, healthcare, auto, you name the sector taking a beating. Defense, let's see what defense is doing. 1.3% is the kind of downtick, but you're seeing worse sectors. It's pretty much in between there, but clearly a sea of red right now.
IT has settled 0.25% higher.
So 0.2% higher in terms of IT. If we can just have the NSE 500 or the BSE 500 stocks as well to understand that one. Yeah, there you go. I mean, the names almost remain the same in terms of the broader markets. That pressure has continued over there. And if you see in terms of the names which are gaining, Grindwell, KPR, Symphony, same names. But clearly, the key point being over here is, in terms of Nifty 50, the level, the support has been broken. Whether we will be able to revive back in terms of tomorrow's session or not is what we need to wait and watch and see, because the VIX is something which is spiked. Bank Nifty, another aspect we need to consider, because at those levels also you've broken supports.
I want to quickly highlight two things, Hiral, which I found fascinating today. Let's pull up the advanced decline and look at the breadth, because the breadth, which was well in the green, has reversed extremely sharply.
I mean, when we started off, we were here.
3:1 in the red.
This is where we started off.
Yes.
And see where it's gone.
Yeah, it's 3:1 in the red, and that's what really stands out for me. The other one is the IT index. Let's pull that one up, because absolutely solid. It's been a rock solid day for the IT index. No major gyrations, maybe one or two spikes, but outside of that, it's been rock solid. So this is the one index you want to look out for. And just the advanced decline, extremely sharp. But all eyes will be on everything that develops over the next maybe 12 to 15 hours, which will then thereafter determine where markets go. In terms of global, well, far and few. You'll have the UK monetary policy report, which will come out, UK interest rate decision, which will also come out. But outside of that, nothing much on the global front. Those are things that you'll want to keep your eye out on. Most importantly, it will be India-Pakistan on the global front. Those are some dividend-related actions for you. Again, nothing major per se. Bajaj Finance, there's that interim dividend, there's that special dividend of 12 rupees. ESAF, Small Finance Bank, 20% shares to exit lock-in. You want to keep your eye out on that one tomorrow. And those are the earnings as well tomorrow.
You have ABB, which is important. I think Dr. Reddy's becomes important. So two names, and a Thermax and Swiggy. I think these are the ones which are catching, my eyes right now.
Manappuram's numbers may well be weak. That's the anticipation at this point, given the fact that there is pain in MFI.
Yeah, and this aspect is what we need to consider is May 12th is a settlement holiday. So stocks that will be bought on the 9th will be delivered to buyers' demat accounts on the 13th of May. So this is something which everyone needs to keep an eye out as well in terms of tomorrow's session, that being a settlement holiday because of Buddha Purnima, settlements will only happen on the 13th and not the 12th.
Okay, so that's that. Completely out of time on this edition of India Market Close. From Hiral, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side. Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with.
Hello and welcome to Market Express, your half-hour pit stop for everything you need to know from the world of markets to big and national and international developments. I'm your host Himakshi Bahugna. Now let's get straight to the show. Viewers, the Nifty 50 and BSE extended their losses to end the session with cuts of over 0.5%. The losses rose during the last leg of the trade after the Ministry of Defence said that it has neutralized Pakistan's attempt to target sites in North and West India. Now, most sectors ended with steep cuts, with realty, metal and auto falling the most. The top losers in the Nifty 50 basket were HDFC Bank, Mahindra & Mahindra, Bharti Airtel and Bajaj Finance. India VIX, the volatility index that measures the volatility in domestic equity markets, jumped over 12%. The advanced decline ratio stood highly skewed in favor of the declines. Rupee closes over 1% down against US dollar and settles at 85.72 rupees. Now, this is after India striking a response to Pakistan. Pakistan retaliated to Operation Sindur last night, attempting drone and missile attacks on multiple Indian military targets in northern and western India, which were neutralized by India's air defense systems. In response, India targeted Pakistani air defense systems, including one in Lahore, matching the intensity of Pakistan's actions. Pakistan also intensified unprovoked firing across the line of control, killing 16 civilians, prompting India to counter with mortar and artillery fire to halt the aggression. Bharat Forge reported a 7% yearly revenue drop to 2,163 crore rupees in Q4. EBITDA fell 6.4% to 617 crore rupees, though margins slightly improved to 28.5% from 28.3%. Net profit decreased 11.3% to 346 crore rupees. Despite the downturn, the board recommended a final dividend of 6 rupees per share, signaling confidence in financial stability. Blue Star outshines Voltas in Q4. Its electromechanical segment trumps Voltas. The Blue Star numbers beat estimates. Voltas numbers were a slight miss but showed strong domestic growth. If you look at the revenue trend, Blue Star's revenue has grown 21% and beats estimates, whereas Voltas' revenue has grown 13%, marking a slight miss versus what the street was expecting. Coal India posts a strong Q4, surpassing earning estimates. Net profit jumps 13% quarter-on-quarter to 9,604 crore rupees, driven by higher e-auction realizations and JV profits. Now, revenue climbs 2.6% to 37,824 crore rupees. Though import pressure weighs on top line, EBITDA rises 4.3%, but margins dip to 31.2%, while sales volume sees a 3.4% uptick. Soft demand in the non-power segment and a decline in captive market share pose challenges. Dabur delivers an in-line Q4 with volume growth at 4% and value growth at 3.5%. Market share remains strong across 90% of its portfolio. Revenue holds steady at 2,830 crore rupees, but EBITDA dips 8.6% year-on-year to 427 crore rupees, dragging margins to 15%. Now, net profit also declines 8.4% segmentally. Healthcare and beverages see declines, while food segment grow 14%. Niva Bupa health insurance shares soared over 14% today, the stock's strongest level since December 11. Now, the rally comes on the back of the company's Q4 results, which showed a significant narrowing of its consolidated net loss to 56 crore rupees, down sharply from 850 crore rupees in the same quarter last year. Now, this improved financial performance has sparked strong investor optimism, driving the health insurer stock to standout gains in today's market session. Symphony delivers a stellar Q4. Domestic business growth 48%, while global operations expand 44%. EBITDA jumps 43%, pushing margins to 21.9%, the highest since Q4 of FY21 despite elevated marketing spends. Looking ahead, Symphony plans to divest stakes in Climate Tech and IMCO, aiming to turn overseas operations profitable. With that, Symphony also becomes the stock of the day. Now, shares of Canara Bank surged as much as 4.35% today following the release of its robust fourth quarter earnings. The state-owned lender reported a stellar 33% year-on-year jump in net profit, rising to 5,003 crore rupees despite a slight dip in net interest income to 9,442 crore rupees. The bank showcased strong operational performance with a 12% increase in operating profit. Asset quality also improved, with net NPA dropping to 0.7% from 0.89% quarter-on-quarter, and gross NPA declining to 2.94% from 3.34%. Jindal Drilling has clinched a new 3-year contract from ONGC for its rig Jindal Explorer at an effective day rate of $35,138. This follows the completion of its current ONGC contract with Q1 of FY26, with the new deployment expected to commence in Q3 of FY26. Now, the deal strengthens Jindal's partnership with ONGC and bolsters its operational outlook. Shares of Harsha Engineers fell as much as 4.3% to 355 rupees after the company posted weak Q4 earnings. Now, the revenue slipped by 2% to 373 crore rupees. The net loss of the company came in at 2.4 crore rupees. EBITDA decreased by 35.5%, and the margin contracted to 9.4% from 14.3% earlier. The company also recommended a dividend of 1 rupee per share. Pharma company Lupin has now launched drug for seizures in the United States. Being one of the first company to file the application, Lupin will have 180 days of shared generic exclusivity. It will be equivalent to Sumitomo Pharma's Apitomi tablets. Now, Apitome has an estimated annual sale of $395 million according to the latest data of March 2025. Agrochemical companies are buzzing in trade after China imposed anti-dumping duty on insecticides from India. China says that Indian dumping was causing material damage to domestic cypermethrin industries. Now, the anti-dumping duty ranges from 48% to 166% for a duration of 5 years. Companies like UPL, Bharat Rasayan, Meghmani are most likely to be impacted. The Indian pharmaceutical market grew by 7.8% year-on-year in April 2025, driven by price hikes and new product launches, but saw flat monthly growth. Volume growth remained weak at 0.4%. Over the past 18 months, growth has consistently stayed below 10%, with single-digit increases for 25 months, barring a seasonal spike in October 2023. UBS downgrades RK Forgings to a neutral, reducing the price to Rs 680 from 1500 rupees. Now, the company is facing challenges on multiple fronts. Several factors like weakening global CV cycle, tariff-induced slowdown to weigh, one-time inventory write-off may also adversely impact projections. CLSA maintains an outperform rating on MRF, increasing its target price to 1,68,426 rupees. Now, MRF's EBITDA margin rose to 15%, up 337 basis points on a quarterly basis, signaling the start of a margin upcycle. Now, benefits from recent commodity price corrections are expected from Q2 of FY26. MRF's industry's leadership and superior capital efficiency continue to drive steady cash flows. MK Global initiates buy coverage on Ultratech, ACC and JK Cement, and an ad rating on Ambuja and Shree Cement, citing a recovery cement sector. Now, after facing headwinds, the industry is poised for growth with improving cement prices, favorable demand and cost dynamics. MK forecasts 7 to 7.5% demand growth for FY26 to 27, while noting a potential pause in consolidation. Asian Paints reported a challenging Q4, with revenue down 4.26% and EBITDA falling 15.09%. Margins contracted by 219 basis points to 17.18%. Now, net profit also tanked 44.9%, which is nearly 45%, and adjusted net profit dropped 30.36%. Now, the Indian decorative business saw 1.8% volume growth, but a 5.2% revenue decline due to muted demand, weaker consumer sentiment, down trading, and rising competition. Industrial business grew 6.1%, driven by general industrial and auto segments, but home decor categories struggled amid pressure on household disposable incomes. L&T is all set to post its Q4 earnings, revenue and margin to increase